What is up, team? What is up? Good morning, good morning, good morning. I was up pretty late last night. Actually, I was up till about 4:30 or no, 5:30 this morning. I watched CNBC this morning. Um, so if you could, please, with all the joy and passion in your lovely heart, hit that like button and subscribe. Um, I'm Justin. It's the Ivy League live stream. I've been training for about 10 years. So let's go right on over here to Twitter. I was really like, remember how I said I was wanting to be long yesterday? Do you guys remember how I told you guys, the Chinese European markets were red? Let's see, we're starting to see them shift green. I want to see us shift green. I want to look for an upside day. I told you that jump last night or yesterday, that pullback and the immediate reversal is a sign. Upside tomorrow into Thursday. That's my guess. This was 6 hours ago. It's almost 9 o'clock right now, so we could probably do the math on that. That was probably 3:30 this morning. Hello, 4:49. That's where I think we go to. That's where I think we go to. It's oddly enough, I do, guys. I think this is where we're headed. That's where we're headed for a few different reasons, and I'm going to cover that right now. So again, no. Gotta go up. So again, if you would be so kind as to subscribe, hit that like button. We're trying to get to 1,000 subscribers. We do a lot of great educational things here on this channel, and that's the only way we can reach out to other people and actually start the community that we're looking to start. We don't charge a dime. We charge you likes. That's all it is, and all it does is take a click. That's it. A click. Subscribe. And if you have any questions, throw them in the chat. We would love to help you guys out, man. We would love to help you guys out. So we have FOMC minutes. At 2 o'clock, the decision, the rate hike or no rate hike, the FOMC minutes will be released. We're going to get the summary of economic projections. I'm sorry, I was wondering why it was like, it was on cap locks. Sorry, team. Just give me 1 second. I gotta promote this thing somehow, right? And do you understand how many people are bearish right now? That should really help you for the upside. It's things like that, and understanding, being able to look at the chart and say, hey, but this is, I've said we're oversold. Let me do this real quick. Forex, the dollar, futures. That's one, right? Trading view. That's another one. But what was the other one we were using? FOMC. That's good, right? Let's see here. I am so not ready, guys. I kind of just hit the stream and I'm just I'm just going. I'm just going with the flow. Let me see. Browse this guest. I gotta get my Squawk Box started up. There is a major short on the 2-year Treasury. So if something were to happen, you could see a massive covering and a massive spike on the 2-year, and I'll get into that. I want to see if we're able to pull this thing back. I was looking to get this level here. I knew we weren't going to get it, though. I knew last night I was watching this, right? I was watching it here. No, I'm sorry. Let's see, we pulled back. Yeah, I thought it was this here that we were going to pull back and at least get like on a 5-minute chart. Yeah, we are on a 5-minute. So when I was watching last night, I mean, I was literally watching futures and watching the SPY here, off of this rejection, and that what's that 245. Um, because what I was doing last night, I was learning. I was going through because I need to learn. I want to learn how to edit. So I was learning how to edit. I was just going through a lot of things. I was really frustrated that I missed the move yesterday. So I really tried to work on um, a lot of things with like not getting stressed out about it, missing a move because it's going to happen. So let's go. Let's just get our levels and get ready to tear the hearts out of this market. So if you could just hit that like button for me, I greatly appreciate it. And it is just it's just honesty, right? Come out here to help you guys for free. We don't charge anything. That's all we charge. Real quick, upgrades and downgrades. Upgrades: Pinterest, Western Digital Workshop, Sonos. Downgrades: Chewy, Dollar General, Skyworks, and Zebra. Not sure. That actually goes into one of my things is to being able to be long uh, those type of those type of names. So if we know, hold on one second. All right, I'm here. So come on. I'm just trying to get my scanners and stuff up. How are you guys doing this morning? Is anybody here today at all? I'm kind of curious if there's anybody here that's even joined us. Um, Probably not. No, nobody's watching it. Go figure. All right, so let's go to a 30-minute chart here. This is the S&Ps. I need to look at TLT real quick. I knew I was too early on TLT. I just had a weird feeling that I was pushing this trade, but I have time. I have time. We could see it. Look, there is a nice double bottom here on TLT. I took some profit on it, but I feel like, I have enough time. We'll see what happens. But I also feel like I don't have enough time. All right, so the S&Ps, I want to see if we can get up to 449 right here. That's the level I'm looking for. Yeah, that's the level I'm looking for, guys. I want to see if we can get up into this level here. We have not made this level at all resistance at all. This level is going to be 449. Right, 449 is the level I'm going to look for. This will be the target. 449 is going to be the target. And what would that do? That would take us right to about this area. Um, it made a lot more sense last night too, by the way. If you guys want to see something, look at this. Okay, look at this. So this move here, if you measure the move, we have literally retraced the majority of the move. And I did this all last night. I said, let me measure it, blah, blah, blah. Um, I did it with the SPX and everything else too, so we could either go there. And look at this, right? There's your 50% retracement, 50% retracement. You work yourself up, and what's it do? We're literally just bouncing off the 38.2 Fibonacci. We just right? You just bounced off it. Now let's see if we can get a pop, and then see if we can hold this 23.6 fib at 447. So you did have an order come in last night, yesterday, or 2 days ago, and hit this. This is either a block fill or a misprint, and I feel like it's a it's a whatchamacallit. It's a order that had to be printed. Um, I think it's all going to depend on Powell, but I think we have upside, and I'm really upset that I couldn't, I couldn't get along and hold on to it. I kind of because I didn't do the work like I did last night to get comfortable enough to do that. What I'd like to do is be able to catch pullbacks and be a buyer, right? Ultimately, I'd like to see if I get a pullback to 443. So if we get a pullback to 443, so this whole range is 2% probably. So it's only 1.5%. Shit. Um. All right, so I gotta leave those levels there. Not that I think we get there in one day, but let's see here. If you're just joining us, if you could please do us a solid one. Hit that like button, subscribe. We do this for free every day. We actually trade here live every day as well. Let's see. I was up a little late, so you guys, I do apologize, as I'm trying to learn how to edit, and I'm trying to, I was working. I was working last night. Um, this is unbelievable. I hate to have a ton of charts, guys. I do. But this range is like only 1.5%. Like, we could go back to 449 today. First target I would look for off of yesterday's close would be the 50-day moving average. And that's 1% away. And we've already gapped up. So it's rough. That's rough. Come on. Yeah, that's our target, guys. We got to bounce to the upside. We're going to look for the 50-day moving average. Let's do that. Let's look for the 50-day. Give me 1 second. Let me take this sweatshirt off. So today I'm going to take my time, obviously, and I'm going to show you guys a couple things that it is that I do as far as, just putting, putting in the range of the day, um, and seeing how we trade in the morning. Give me one sec. I'm just trying to get everything up and running here. I gotta change this. I gotta change it. I gotta change it. I gotta remember these things, right? And what else? What else? What else? What else? We'll just say Amazon, and that's about it. Hold on. Let me see here. I know I shouldn't do this with you guys on there, but the market's getting ready to open up. Um, I want to see us. I want to see the. All right, man, guys, this stinks, man. That sucks. I couldn't grab that long. I didn't grab a long yesterday. Didn't grab the long. Let me throw this to live chat. I don't know why YouTube's been doing this. So let's go. If we think we want to be long, what is it that we want to be long? Um, and again, I'm going to be looking at the daily chart. Alright, I need to go back and look at the banks and stuff like that. That might be where I want to be long. Did you guys know? Yeah, I wonder how many people don't know this. The fact that cruise lines are your number one, pretty much probably the winner. They're like Carnival Cruise this year is up 100 and something percent just in the stock alone. It's actually pretty unbelievable. So we're here at Tesla. We're here at the Tesla Giga factory. I'm just kidding. Let's make sure. Let's make sure we get our moving averages correct. I can't believe I'm still somewhat awake and alive after last night. I'm still under the impression that we're going to get this. I'm still under the impression we're going to get a higher low for Tesla, and that's where I want to be. That's where I want to be. I want to be short Tesla. I want to be short Tesla up here. I do. I want to short it up here. Let's see here. Let's look at the 2 year. Or we've got a couple minutes. And remember the watch list yesterday, guys, with Disney. Disney was one that we looked at and called it out the night before and just seen the setup that it had and was like, hey, There's something going on with this thing, with this name. Okay, so that's the 2 hours. So as do you guys notice as we're bringing it in to the time, shorter time frame, it's getting like overbought and overbought and overbought. But on the daily, it's overbought. Let's go to the 4 hour, right? 4 hour is, you know what I mean, oversold. Let's see. So did I make that a line? I should have probably put 272. Boom. So that's a gap fill, right? That's pretty much a gap fill there. So let's look for Tesla to see if we can get Tesla. Nope, it's not. It's not. It's not going to, unfortunately. So Tesla's still oversold on the smaller time frame too. You have this gap fill here. Right here is would be the level on Tesla that I'd be watching. No, 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 no. So I already did mark that. Hold on. That's fair. That's a good area right there. I like this 270. Two, Tesla 270. We're gonna see if that turns into resistance, but we know we have a gap fill up here. We have a gap fill up here. And that would. Yeah, we gotta watch the gap fill. What I'm gonna do is I'm gonna put a dotted line to give me the area of the gap fill. So this turquoise line will be the gap fill. That way we can. I can leave that there, but we know where it's at. It's pretty much at that level. And I don't have a line there. All right, let's see. Let's see here. Do you guys have any suggestions? If you could be so kind to us, hit that like button. So what I want to look for is a lower high. If we're able to get it. Or this thing could go reversed. We could just start reversing now. Right? And get the downside over with. Say hello to the 50-day. That's also an option. Man, I cannot wait until the day that we get people in here and can actually sit here and talk about stocks and stuff. And have like a group chat. Like, I really wish I would have started this a long time ago. You know, I mean, I'm gonna be honest. Here I feel like the value you're gonna get here is you're not gonna find it anywhere else. You're really not. Understanding intraday things that happened, like that move yesterday, and how that's a change in, that is a trend reversal, right? Putting in a huge down day, not huge, but you know, we put in a fair amount. We pulled back fair amount. We sold off a fair amount, only to reverse it and come right back up. That was the sign. That's all. That's all the sign that you needed that the bottom was in. So what am I going to look for SPY? First level I'm going to look at is 268. Or Tesla, I'm sorry. For Tesla. Tesla 268. Now, I could be wrong, but I still want to see if we can... You know, it's like... It's oversold, so... I think this thing may continue to pull itself up. Right? Maybe we find support back down here. And then it bounces higher. right? We need this thing needs to sell off to get higher. It needs to put in a lower high. So I look to be long Tesla at 260, 265.35. What is this? 265.35? 265.25. So that's a failed break of yesterday. So yeah, I want to see this thing pull it back. Um, yeah, this 265.27 area is the area that I would much rather see Tesla get to. You know, this is it there. I'm gonna see if we can get there. I don't know why I did that. No. So I want to see if Tesla puts in a lower high and then is able to put in a lower, or a higher low and then put in a lower high. I do. I want to see if we can get ourselves a bounce up here. So Tesla, I feel like I want to be buying the pullback for a long to see if we can get up in here to fill this gap. At 271.36, 271 area. 260. So I have it marked here. 265.50. So what is that? 265.38. $265 and then go long to 271.50. Sorry, I didn't know what that was. 271. I mean, that's a 6-point move. This is my move, so I feel like we're going to go from here to here. And that is a 2.2% move. Let's see if I'm correct. And then we have Apple. It's been trending to the upside. I've missed this move, and I called this out early, guys. I said Apple is looking pretty oversold. I should have just gotten long this name. I should have just gotten long as a trade to the to make an attempt at the 100-day, which is this blue line that you see here. If you guys could be so kind as to also hit that like button for me, we're trying to get our not our subscriber base really, but we're trying to get to 500 subscribers. But we're also trying to get a community going here, and it would really help. Apple is at a resistance level. Apple's at a resistance level. Let's see if it broke up above it. I have so many lines I need to get rid of. Um, please take your time today. Take your time. Seriously, take your time. It's not worth getting hurt and wasting capital over, a move that you shouldn't even be wasting capital on. Yeah, I feel like we roll it over and get back, and we test this 177 level again on Apple. 4 hour, 6.5 minutes till we have the opening bell. So let me get my charts together, and I'll kind of just scan around what it is that I want to look at, or be long or short. Is this the 50-day? No, that's just resistance. So this is AMD here. Yeah, this thing's oversold. Maybe it's time to put on a long one. AMD. Man, that's a ugly bear flag, guys. That is a ugly bear flag. So I want to buy the dip. All right, I want to start buying the dip because I'm not gonna fall for the old like get long right off the bell. It could. Listen, it could. If this market's gonna go long, that's fine. It could just go in a hurry. It could, right? But that's not my. I just can't. It's not my style. I can't get into options and then immediately like, think that I'm gonna be smart enough to. Let's see. So the 50-day and 100-day is up there. That's my level, right? That's my level there. That's my level. We break and hold up above this level here, right here. We break and hold up above it. That'll be a break and retest. We got 5 minutes left. A break and a hold, a successful hold of 102.75-ish, this red box. Yesterday's high. All right, yesterday's high. And then I want to see if we can pull ourselves up to 104, maybe even 105.50. That'll be the target on AMD. 105.50. Come on, I gotta hurry up. Let's do this. We break above this level, this triple top here. Come on. We can do it. We can do it. If anybody can do it, we can do it. If you don't know, BDO. And here's our 50-day and 100-day. Let's see if we get, this will be a take profit at 105, 104.60. And then we will see if we can get to 105.50, which will be up here. Man, that's a huge area there. Let's get this dip. Let's be able to, let us pray that we can buy this dip. That just sounds weird. It sounds so weird. Let us pray we can buy this dip. JP Morgan was another one that's on our watch list. JP Morgan. Man, what a break and retest yesterday for JP Morgan. That was it. We missed it. We didn't look at it and we missed it. Man, I got to do a better job of this. I got to start setting alerts. I felt like I started to try and set alerts and it never would alert me. Maybe it's me doing it wrong. Here's our reverse head and shoulders on Bank of America. Boop, boop, boop. Starting to turn itself up and around. Looks like a break and retest for gold. Looks like it's going to the upside. Possibly. Who knows? I don't know what the hell I got going on there. This yellow line needs to go. I need to just get the SPY up and get everything ready. So again, if you guys are just joining us, please, if you could, tell a friend. Hit that like button, subscribe if you haven't already done so. We're trying way too hard right now to get likes. And I will continue to do that. You know. Let's see if we pull it back to 443. I gotta see if we can get a pull back to 443, guys. We broke above it. Let's pull it back to 443. So I'll be watching Tesla. Of course, there's 1 minute. Alright, guys. Good luck today. Take it easy. Don't get over your skis. You know what I mean? Don't get hurt. Don't get flipped up upside down and whatnot. Come on. Oh my gosh. Come on. Come on. Come on. Why are they so amped? They're so amped at the market today. They're so amped. Alright, let's get it, guys. Good luck today. Dude, they're so amped today. I don't understand why. Clavio. Clavia. I don't know what it says. Sounds like a... Never mind, I'm not even going to say it. Come on. Come on, come on, come on, come on, come on, come on. Give me that. Dude. Give me that Oris. Ah. Alright, good luck today. Let's go, folks. Let's get it. Alright, here's our pullback on Tesla. There's the market pulling back. Let's pull it back. Let's pull it back, S&Ps. Let's pull it back. Let's pull it back, S&Ps. Let's pull it back. 443's our target. Yo, they're doing way too much. I don't know. I don't understand what's going on.
POC halted on a circuit breaker, Delta Tango Oscar Charlie.
Yeah, right. I am. I don't know what you're talking about, Kramer. Oh shit, Tesla. Tesla, Tesla, Tesla. If we're going to be right, it's going to be here, guys. Damn it. Alright, I'm going to take a long on Tesla. See if we can get this thing back down to 270, 271. What was the target? The target was 271. Wow. That's way too much. That's completely way too much. That's insane. That is seriously insane. Because you're talking about, like, up here at all-time highs. That's crazy. There's no way. There's no way. And what's today, Wednesday? The calls and puts are pretty much going for the exact same price. Why are they still going nuts? I don't understand. Does anybody have any clue on what's going on at the NASDAQ? I mean, I understand there's an IPO, but So I did not take a long yet on Tesla. I did not take a long. Let's see here. Let's see here. Boo, boo, boo. So we're up 0.2%. All right, so Tesla's still holding up pretty weak. Let's see what the Qs are doing here. Shit. It's really hard for me to sit here and tell you guys what's going on when I'm trying to do a couple other things here. Come on. Let's go. Let's go 445. Let's go 445. Let's go. Let's go 445. There we go. All right. Let's see. I wonder if I should be patient or if I should not be patient. So we broke above that. Let's see if I can get a pullback to right here to 443.38. And get, what is this? September 20th, September 20th. There's still these are way too expensive. Wow. Tesla didn't hold that level, guys. Maybe it did. You got to give it a little bit. See what I mean by you got to give it a little bit, but that's not a sign you want to see. That wasn't a sign you want to see for Tesla. Right? You get above that level, that's a bit different. Come on. We need to hurry up. So I'm still got these spy calls up. I haven't taken them. Tesla, I'm watching this level right here at 266.88. It just broke it. And look, see how quick it went? See how quick it went? Damn, look at that, guys. Look at that rip. Shit. Ah, my goodness. What just happened there? I guess we called this to a T, right? We literally said 265. It's what we wrote down. 265.38 was the low, and we want to look for a pullback to get long. It was let's see. Let me also see what this looks like. That was a big move, guys. That was a big move. I still feel like we have a lot more on deck. Oh, Pinterest had an upgrade. Was another one, so let's look there. Pins. Yeah, it's this stock is just I don't get it. Well, Pinterest is. I mean, I get it, but I don't get it. It's like they could have upgraded something better that at least had some liquid options. Let's pull it back, Spy. Let's pull it back. That's what I'm looking for, guys. I'm looking for the push up here to like 271.50 on Tesla. I'm telling you right now, that's what we're looking for. You gotta break above that level, though. This level is so key. This prior resistance, the high of day. It's very important, guys. It's very important that we got to break above that. All right, so there is the wick. I'm watching this level here. I'm watching this level right there. There goes the spy. Fuck. There goes the spy. So that's awesome, right? We've called it. Everything that we've said has worked out. Everything we've said has worked out. Let's see if Tesla can get up there. I feel like it needs to pull back again. I think Tesla needs a bit of a pullback to get some strength. It's a bit overdone. There's the rejection. So, longer term, right? This is a longer term. I'm looking for a lower high. Because if you see this daily chart, guys, look how overbought we are, kinda. We're at 56. We got to get to a level of, where they're going to come in and sell this thing. And I think we need it. The stock needs to go higher because that would bring it would bring them in to be a seller. That looks like a well, never mind now. Let me take that back. Take that back. Okay, there's actually the retest of that. Let me look at this. So there's a couple things I'm looking for. So you did just get somewhat of a break and retest of this support level of 266.91. But this level up here at 268 is going to be the more important level. Um, it's going to be more important. If you guys are just joining us, if you could hit that like button. It only takes just a minute. We're trying to do something great here, guys. We've been giving you guys winning trades all morning long. Um, Look at AMD. AMD might be the one team. It might be the one. AMD might be the one. Keeps trying to move on me. I think AMD's the one, guys. Wow. Wow. Blast off. Level 2, time and sales, level time and sales. Level 2. SPY working its way up.
SCS Steelcase following their earnings report.
Wow. I missed it.
$78 at the high of 20.
Did you guys see this?
Charlie Sandy.
Did anyone else see this move?
SCS.
Where did we say we were going to take AMD to? Where did we say it would go to? I mean, that is a nice resistance level, guys, for AMD. If it does break up above it, the next resistance level is 105.50. That was the other one we said this morning. So if you're just joining us, we called these out this morning. AMD 105.50. If, and look, CNBC just called it out. So it looks like we're breaking up above that 103 area right about now, guys. Looks like we're breaking up above it right now. Give me a 2 minute maybe. Come on. Nope, that's a failed break above. Tesla's struggling. Look at the tails on Tesla. What are you guys watching this morning? You guys have your eyes on anything? There it is. There it is. Let's go, AMD. I do not want to be the sucker that buys the high on this. It's struggling to get up and hold up there. It really is. It's struggling. Let me give it a 1 minute, because that's really going to tell me if we start to get some sellers to step in here. So Tesla's still making pre-market resistance. Wow, very fortunate to be on like that this morning. Really nice call-outs today, team. Really nice call-outs. And here goes the SPY. It's still working itself up. Still. That's relative strength. So there goes Tesla on the drop. I felt that coming. We felt that coming. Could get a long, but man. Shit. Shit. Gotta perform, team. Gotta perform. I'm watching AMD's level 2 in time and sales. This is a 1-minute chart because I want to see what starts to happen here. It's gotta get up above that level if it's gonna have some type of strength. Fuck. What's up, Chris? How you doing, man? A1 on these calls, bro. A1. I see this purple line. Literally put that there this morning. I said this is the pullback that I want to get long Tesla. They were a little too pricey for my liking that early. You know, at 9:32 in the morning, 9:33. You know what I mean? So we'll give it a minute. See if we can put in like a nice little double bottom here. And understanding why I came up with that, right? Understanding why I came up with this. I think it's really important that people don't do enough, right? I don't think people understand really how to come up with like seeing like, you know, how the charts, the ebbs and flows of the indicators and the charts and everything, man. But I hope you're doing good this morning. AMD, it doesn't feel like it wants to get up and break above this 103.75. You break above 103.75, you could be on for a really nice move. Let me make sure that I'm concentrating and making sure that I'm seeing all it is that I need to see. That's right, Tesla. Bring it on down. Bring it on down. And the S&Ps, I still think the S&Ps can, you know, I'm going for 449 on the S&Ps, but I would like to see if we can get a nice pullback. Right? See if we can test 443 and pull it back. Let's see here. I know how it is, bro. I know how it is. I know that shit happens, bro. It's all good, man. It's all good. We'll have more opportunity today. We'll get some opportunity today. And after what I did last night, I was up late, man, working hard on just like a lot of things, emotional, like you know, it's a little frustrating yesterday. I mean, as you've seen today, right? You know, this is a really nice call, but I cannot buy these calls because I'm telling you guys right now, if you just sit and look at the options and see what they look like when they opened compared to where they're at 10 o'clock, 10:15, 10:30. If something goes wrong here and this thing just drops, dude, you're getting crushed, especially on weekends. Like, I'm not going to pay over $200 and some to get 271 calls. I mean, it kind of does make sense, but I just can't do it. I'm good. I would much rather let a little bit of time go by, let those premiums get ate up, and then sink my I just want to pick my spots. Especially for like the SPY. Same thing. I would much rather just wait a little bit unless there's a clear directional move. And then sink my teeth in on a long or a short. You know, because you're gonna help yourself make more by when you're paying less, especially when you're wrong. You're gonna lose less when you're wrong too if you can pay for it. You know, if you can pay less for it. Let's see here. I need to look at NVIDIA. So this is the level we're looking at. We're looking at two different levels here. Pretty much this level here that we've already broken above, and it looks like we're coming back in to retest it at 103. And then you have this area, this wick area. Uh, just hold on 1 second. Okay. Wonder if it starts to put in a lower high here on Tesla. Let's see. Bang. So the daily charts oversold Tesla. I'm telling you guys right now, Tesla's coming in. The only reason I'm looking for a long on Tesla is because I wanted to pull back. I wanted to come up here and put in a higher low. This line is my target. Like, I think we get to 271.50 today. All right, SPY is actually pulling itself back up as well. Um, Sorry, let me get this chart back on track. Let's pull it back to 443 for sure. It's for sure it's gotta pull itself back. I mean, technically it doesn't, the S&Ps don't have to do anything, but I'm going to assume that we pull it back to 443. I wouldn't mind actually probably starting to get on the short here. And I'm on 3 minutes, 3 minutes, 3 minutes. Yeah, I mean, you did. Were you able to take any profits at all? Oh, come on. Yeah, I'm just wondering if you I hope you were able to take some profits. If you did, man, it's all good, bro. As long as, you know what I mean, if you're able to have a nice trade on. I've noticed that Tesla's been doing that the past couple days. It's been having a nice run. So, pre-market, we're battling this pre-market high area right here on Tesla. What do I want to do? What do I want to do with Tesla? I feel like it's going to make a move. There goes the SPY. Motherfuck. Wow. They're getting ahead of this move. I know what they're doing. They know what the move is, and they're getting ahead of it. They really are. They're getting ahead of this move. See how overbought it is on the 30 minute? Tesla going to sell off. Hello, 264. If we get 264 on Tesla, that's going to be sick. Do you understand how much? That's going to be sick if we get 264 on Tesla. If this thing can sell off like I think it wants to. Oh no, come on. Give me a 1 minute. I don't know what to do. I'm sorry, guys. I'm sorry. Let me focus here. Let me focus.
2 p.m. the FOMC rate decision and the conference at 2:30 p.m. Eastern time.
So Tesla's just gonna put in a pennant. It looks like I can already see what it's doing. So it looks like it's just gonna sit up here and consolidate in this range from 268 to 266.50, maybe a little bit lower. But it looks like Tesla's gonna just sit there and put in a range. Here's AMD. Let me zoom out on AMD. It's pulled itself all the way back. Unbelievable. I think AMD's got um it's got more room to go. Here we go. We're pulling back into it right now. 102.75. 102.75. Come on, come on. I think this is the long that I think this is the long right here. 275. If it's gonna go, oh, it's still over. It's overbought. Medium term. Same for the SPY. I'm gonna look to see if we can get a pullback. I'm gonna look at Disney again, because it had a really nice setup. We looked at that Tuesday night, I think it was, and it had a really nice setup. Hold on one second, guys. Let's pull it back. Hold on one second. Very nice, Chris. Very nice, bro. Resilient. The SPY is being resilient. All right, Tesla. What are you gonna do, buddy? What are you gonna do here? What do you want to do? I think Tesla might try it for the upside. But again, it's going to consolidate here, so I got to stay away from Tesla. Tesla, no play. AMD has some nice volume. Dude, the SPY is just being resilient right now. It really is. Exactly. I agree. I love how they post. Thank you guys for those likes. I love how they post specific things like if you were to buy on the 19th, it's the worst time of the year to buy historically, blah blah blah, just to keep you from going long, and everything on the chart is screaming long. um, so it looks like ARM is selling off right now. If you guys haven't seen that, I think there is I think they added options on these too, guys. Arm is selling off big time. Big time selling off. Let's do this real quick. Um, um, I don't understand. I don't understand a lot of power. I don't get it. DG Len Pins Cart Dow. Oh, I was just looking at airlines. That's so funny. I seen the news there. Let me recap. Let me see if I can go through this real quick. I gotta go back to 2 screens. It is what it is. No big deal.
President Biden expected to announce significant military aid package for the Ukraine on Thursday. That's from Reuters, citing a U.S. official.
This motherfucker just don't care, does he? A significant Ukraine package. What a fucking idiot. Yeah, just keep feeding the war. Why doesn't he go the fuck over there? Why does he not go over to Russia? I understand that Putin doesn't like him. I understand he doesn't like Putin, but it ain't about either one of them. They need to figure something out. I don't care what he's got to do. I don't care if he's just got to play him and just act like he's, you know, well, we all know he's a crook, but you guys know what I mean. It's just crazy. Let's see here. Let's see here. So there goes the SPY pulling back. I want to start seeing a pullback to 443. Alright, let me see here. Let's go. Let's go, SPY. Let's go, baby. Let's go. Let's go, SPY. Give me a bounce. 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 Give me a bounce. Shit, we only have $1 left on those. Shit, there ain't no way I'm paying 92 cents to get $1. You guys gotta watch out for that and understand what it is that you're doing. That's a pretty clear double top. You could call it a triple top, but they're charging 90. They're charging 90 cents for a 443 put. A 443 put that expires today. They're charging 90 cents. We're trading at 444 right now, but 439.90s or 443.90s. You're literally your break-even price. You're paying $90 to get a break-even price that's down here, right? So that means it's going to watch these options, and I guarantee you they do not move. They're at 95 cents right now. Watch when this SPY pulls back. Let's see how far these options do not change. You might get 50 bucks on them. You might get 50 bucks. You're gonna start getting into some theta too. I gotta do this so you guys can see, and I can see your guys' comments and stuff. What the hell? Canopy growth. Canopy growth's pulling back. Okay, yeah, I thought that was my little Abby girl. Thanks, dude. I gotta get better at it, man. I appreciate that, Chris. I appreciate it, bro. I appreciate that. I gotta get better at it, though, which I will. I will. You know what I mean? As time goes on. I was really up late last night working on a bunch of things. And stuff. I appreciate that, though, man. You know. Hold on, Turkey. Please, hold on. So I think, oh my gosh, the spy is not. The spy is hilarious. I'm wondering if these people are going to try and just get long like ASAP and not miss this move. So we have pins, LEN, DJ,
Good futures
Cart,
trading
Dallas,
highs of the day now,
pins.
trading down 8 cents.
This thing's going to pull back to 26.89. Excuse me. All right, let's do something here.
BTOC halted on a circuit breaker. Delta
Oh,
trading
come on.
early.
Yeah, so I've been pretty lucky, not pretty lucky, but you know, as far as cash tickets, six one and one, 6-1-1 right now. And the tie was on Carolina. That's both between NFL and college. Yeah, this might be a short here because that's a major resistance level. It's got some small support down here at 26.88 for pins. Um, Wonder if you're gonna get some buying coming into here. You might. We might get some buying. So low volume pullback. And I don't know what the news is with Delta Airlines. So what I'm probably gonna do is at like 10:30 or not 10:30 but like 11:30 ish. I'm gonna go run and grab her some food. Um, and then I'll be back. She's been being really picky about eating and stuff here as of late. Goes. Spy's still catching a bid here. It's just kind of sitting flat, which is kind of good. It's not. Where's AMD? I don't know how. It's so weird, but like, just randomly saying, "Yeah, what's AMD doing?" And just like always being on these stocks that have the like some really high decent volume. All right, there she goes. But I don't expect it to go. It's like they're just stepping in, buying the dip. So you may not get much continuation. Oh, there it is. And again, right? Understanding what's going on. Now, you had that quick move. Those options are at 106, 107, 1010, 1010, 110. When you're paying 90 cents for a 90 cent move, you may want to get the next dollar under. Just because it's, you know what I mean, you're getting dollar for dollar.
AGRI, AgriForce,
It's what you're going to get. You're going to get dollar for dollar.
44%.
And that's pretty much what it was. And what you got, bro? And I feel like I'm killing it with online sports betting. My state still doesn't allow it. Wow. Um, that sucks. That sucks. That sucks, Chris. See if I don't want to tell you to do anything. But like, I mean, if you really want to, um, you could always do one of two things. You know what I'm saying? You could tell me, I could do it for you. Um, or you could go, because I have a friend in Florida who will call up here, and but this was before Florida got it legal, and I would put in stuff for him. Um, you could you can always go the online route, but the thing is like with like Bet365 and other places and stuff like that. I think some of them are starting to like use Bitcoin, and there's ways to do it, but it's I kind of I kind of like going to the casino, like where I go. They have enough space, right? There's a plenty of space. It's a horse track also, but they have TVs that it just runs down the like whole, like half of the building, well, like a quarter of the building. They've got like 20 TVs, right, on each side. They have leather couches. They have a bar, and you can just order food and everything there. And I feel like they're not utilizing everything that they have there to bring people in. And I can attest, like back in like 2017, 2018, 2019, Sundays there was lines, lines, lines. I'm talking downstairs, the middle floor, the third floor for football, and it was just packed because the boys would go up there and just they would sit at the tables, and you have a bunch of places for TVs, right, for horse racing. Like they have this whole table on the third floor. It's like big, they have like round tables, and then like smaller tables and stuff, right, in the grandstands and stuff. And then like the TVs are like, it's not like TVs, but it's like a big long like plasma like, or like a which, like, if you were to have like one of those things that you pull down, and then it would like play from the machine, and it would shine on it. It kind of looks like that, right? It's a huge, like, 70 foot, 80 foot long, and they have different. They have all different games on throughout the whole thing, from horse racing, football, whatever. And I'm telling you, man, and they have it on two sides, and there's a bar in the middle. So on the left hand side, they have that TV here, and there's another one here, and all the seats are in the middle. And then you go over to the other side, and it's the whole wall. Is like they have every game on it with tables and everything. Upstairs, and then downstairs, where all the horse racing takes place. Huge plasma screens, right, with like everything, TVs. You actually have your own, literally, like the picture I put in the thing. Um, you literally have your own desk with a free TV that you can go to, right? Kind of like this. And it's bigger than these. Like, it's bigger than these here. But you see these desks here? They have this, and they have a bunch of these desks with free TVs and stuff. Um, but so they have all this stuff, right? You can watch all the games. They have all the seating. I swear, God, I swear, bro, there's not even a quarter of the amount of people that are there anymore. There's not. And I mean, this place used to be jumping on Sundays because they would go there, they would do their parlays, whatever. They would eat pizza, smoke weed, hang out with the boys. Like, it was just a good time. And there's nobody there anymore. Like, it's bad. There's nobody there. And like I was saying last night, I think that's why they're starting to charge before kickoff. Like if you go there Monday morning and maybe it starts at like 10 o'clock, right? And they flip the switch to minus 110 on these games. And as soon as like the morning games kick off, all the afternoon games that are minus 120, they get dropped right back down to 110 because there's nobody there and they got to get their money. And it's kind of sad. It's yeah, projector exactly. But it's not a projector. It looks like a projector. Like it's I don't. It's you know. So it's just it's crazy what it's came to because I feel like they have a really good opportunity, and I think if they offered more like live betting for games and prop bets for like the actual Sunday games, they would get more, and even college. They allow certain prop bets for like Monday night games and Thursday night games is when they do it. But I don't know, man. I've been going there since like I said like 2016, 2017, and it's changed. The odds have changed, and it's just it's not like it used to be. And it's a shame because it was like something fun to go do too. Even though I take it serious, right? I'm here to make money. I'm not here to play around. Um, at the end of the day, because I've proven to myself year after year, it's something that can be done profitably. If you're a person that likes to do parlays and stuff like that, then that might be a different story. It can be done. I have pictures of it. I've done it myself. That's actually how I started out single betting. I had a really good couple years there, and I have all the pictures on my phone. And I think I hit a little over $1,000 on two different parlays for $5. It was like I think it was an 18 parlay, and then it was like a six or seven team half point parlay, and I was damn near over $1,000. I gave the waiter $50 because we had over $1,000 with like 10, $15. I think I spent like $25 is what I would spend, right? And I would mix up the parlays. I would do the ones that I was real confident in, and then I would switch it up a little bit. And people don't know, man. Once you start getting over like seven or more, that's when parlays get pretty hard to hit. Um, and I've noticed over the time, man, that the a lot of the line movement the past 2 years because all these states getting legalizing sports betting, like these line movements and like the numbers have been really, it's not like it used to be. It really isn't. It's not like it used to be. It's hard to trust certain line movements and stuff. Yeah, this is it's actually it's a racetrack too. And what it is like the whole casino, like cuz it's a racetrack, but like so like the grandstands and stuff for the racetrack, like that's where the casino is. It's actually pretty badass. It's pretty badass. They have a poker room, and they have 3 floors. And even on the second floor, um, like it depends on which side you're in. Like on the opposite side of where I was telling you where they have the leather seats and stuff like that. Well, on the other side, like they have little desks and stuff like that. They have a bar, but they also have the poker. Uh, where you can play poker, and then they have TVs in the center, um, and whatnot. But it's a shame, man, because they do have a lot there. There is a lot there as far as being able to have access to like watching all the games and stuff like that, and having a nice comfortable seat, and you could have your own desk and sit there and run through numbers, right? And watch football, right? You could be there college football watching all the games at your own desk while you're doing math for NFL or something. Like I don't know, it's a nice place to go and hang out. They have craps, they have roulette, and then they have all the gaming part, the aspect to it too. It's a shame, man. It's a shame that nobody goes there anymore. I don't understand why they don't. I don't know if it's because New Jersey. It may be because of New Jersey and people from New Jersey and Maryland coming into Delaware, and that's where it's at. That's where I'm at. I'm in Delaware. They maybe since they've started to legalize it, that's killed business. That may be it. And I think that's why they haven't fully like legalized like books here. You know what I mean? Like you can't just open up. I don't think you can open up a DraftKings yet or anything like that, or like FanDuel or Bet 365 or anything. I don't think you can do that yet. And I think that they're trying to, because I think it would really hurt and damage the casino, the horse track. I think it would really hurt the horse track. And they may not, it may come to a point where they don't have a horse track because this place has been getting sold. It's just been getting bought and sold over and over. Somebody's just got to come in and know what they're doing. But again, it's kind of hard because you have these states that are all legalizing it. So that's also putting a footprint on traffic. People don't want to leave their house if they don't have to. You know. He said, "I think I'm." That's hilarious. Oh, come on. That's funny. Oh shit, my stomach. I wonder if they have. Yeah, and even just explaining it here, like talking to you about it, it's actually like looking back, it's like it is pretty cool. I think people take it for granted, like the amount of space and the amount of even TVs and like different areas you can go to watch whatever you want. It is pretty cool. It is pretty cool. Because there's three stories, right? There's three stories to it. Um, and it's the whole length of the track. So, you know, yeah, the other states getting legalized really put a hurting on money going in and out of there. I'm sure. I'm sure. I'm sure. That doesn't surprise me. It doesn't surprise me. That doesn't surprise me. I've never played blackjack. Never played it. I've played craps and pretty much poker. Um, I got really good at craps. What was funny is, and I would go in with $40 to $60, literally, every other day, like whenever, right? Whenever I had like free time, me and my girl would go there. I would wait, right? And people get mad when you play seven and whatever. I'm like, yo, I'm gonna play six, eight, 6, 7, and 8. I'm gonna play 6, 7, and 8, and I'm gonna take this $40, $60, and I'm gonna ride this wave for about 2 hours, if not 45 minutes, and I'm gonna come out of here with about $450, right? 350 to 400 some dollars, because because at the time there was like a lot of people that you had like the people that consistently would come in and play craps and stuff. So you kind of knew, you had an idea who to fade and who not to fade, but or like how you should really play. Like, because what I would do at craps is like, if somebody's on there and they're rolling the dice and they're at their like fourth, fifth, sixth roll, I'm playing seven. That seven's coming and they're going to be out. It's only a matter of time. Doesn't mean it's going to come. They can still go for two, three, four, five more. But I know consistently, right? Just like the markets, if I'm consistent on getting that seven to come out after someone has done like, again, like 4, 5, 6, 7 rolls, instinctively it would also come to me too. How it's just weird, and I would play seven, right? Now I'm betting against them. They've gone way too long, right? And the thing about craps is that you can take your money off the table, right? You can put like 5, 6, and 8, 5, 6, 7, or 5, 6, 8, and 9, and they roll the dice twice. Maybe you hit twice, right? Pull your money off. I would always hit. I would leave, like, it all depend, right? It all instinctively would depend. I would like pull it down, and then maybe on like the third or fourth I would play the seven. And like, you know what I mean? So I would sit there for like 45 minutes to an hour and a half, and I would take 40, $60, and just take everybody's money. Not take everybody's money, but like turn it into 450 bucks in about an hour's time, and then I would go take my other half out. And we did it over and over and over and over and over again. Sometimes it took a little longer, and it wasn't that I couldn't take her out. It was just something that we were doing that we kind of like we had found this like we literally had found this like this free money grab, right? If you did it correctly. Um so I haven't been back to the craps table since 2020, man. So ever since COVID and stuff, but um yeah.
Crude, a draw of 2.1 million. Gasoline, a draw of
Yeah.
851,000.
Mine's also not too far away. Mine's about the same. I'm probably 5-10 minutes away from mine. I just go there for football, for college and stuff. It's really nice too in the mornings because they do have horse racing in the summer, and in the mornings, like Saturday mornings and Sunday mornings, they have horses that are running around the track. So it's kind of cool to go out there early in the morning and like have a coffee and sit out there on the stands and I mean, just going through games, doing math or whatever it is, right? Going through injuries and doing a parlay, having coffee, and it's really nice. It's a way to just get away and whatnot. And I don't know, I enjoy it. I enjoy it. It's sometimes it's like, uh, I like to pick my spots and really, if I don't see anything, I won't play anything. Like the past couple weeks, it was tough on me because I felt like I was kind of forcing myself to pick some plays and stuff. But you know, we get the first 3-4 weeks under our belts, and it's really uh, that's when I really start shining, right? Start seeing who's decent at scoring first halves, and seeing where the number is and where the casino wants you to play, where they want you to side with. By the corner store, rules. Yeah, yep, yeah. They are different. It's a fun game. It's fun. You have to have a lot of people at the table, right? Especially if you go somewhere on like a Friday night or something like that too. Um, Sometimes it can work against you, but you just have to know what you're doing. You gotta, and I felt like, a lot of it was instinctive, right? Saying it here, all right, now's the time. Now's the time we put it on come, and then or don't come, and then the person rolls it. They throw you on a 4 or 10. Listen to this. So you know how you have the numbers. What is it? 4 through 10. Um, I don't think it's two. Hold on 1 second. Um, Swear to God, I hit every single roll. I had two left, right? I hit, I hit every single roll except like the 4 and the 10. I had 1 4 and 1 10 on there, and I can't remember which one it was. I was so close to getting all the buttons, which is rolling like on a six. You can roll it 3 or 4 times. 3 times you can roll a 6 and 8 3 times. Abby, baby, hold on. I know. Poor baby. I know. I sat and watched all these people, and it's okay. I sat and watched all these people just get handed two, five, six, $8,000 because I hit just about all the buttons. Because once you get like, I think it was like anything past 2 or 3, right? If you roll all the eights and sixes and the fours, anything after that, like it's an automatic payout. I think it's like once you get 2 buttons or something like that. I hit all of them. I think it was the 4 or the 10, and I knew I'm like, there's no way I'm going to be able to get that. Um, Not one single person tipped me for that. You know how sickening that was? I'm like, yo, these motherfuckers are real assholes. That's hilarious. That's hilarious. I'm talking five, six of these people just got handed over from $2,000 to $6,000 in chips, and not a single one of them even cared to throw me a $20 bill. Or, like, not that I asked for it, but it was just a simple fact that I sat here on that table and I sat there for 20 minutes, 30, like 20 minutes rolling, 15 minutes, 20 minutes or so. And just to see not one, not two, not three, but like four or five people just get like, so what it is you can put on, it's called like a hot roll. I forget what it's called, but you can put like two, three, four, or five, whatever you want on the button, so that if two numbers get rolled out each time, each way that they can be rolled, you get paid a lot of money. And they're always like throwing a little bit on them. And I couldn't believe it, man. I was one number away from getting every single roll. And it's because I watched this little Italian thing. Dude, it was sickening, bro. It made I actually I actually felt like disrespected. It was so crazy. I'm like, you gotta be shitting me. Not one motherfucker offered to give me a 20, 30, 50, 100 fucking dollars. After all these people, just the least person got paid out $1,200. I'm like, you gotta be shitting me. You gotta be shitting me. It was insane. It was so insane. I couldn't believe it. I'm like, wow. So then I really seen like how I'm like, it's probably because half the people that were on that table couldn't afford to be on that table in the first place, right? I just bailed them out from whatever money it is that they've lost for the past month. You know, it was something else, man. It was something else. But I haven't been back. I haven't played any games or anything like that since COVID. Just after COVID, there hasn't been anybody. It felt like everything changed, and that's fine with me. But I remember at work having $50 and just using it on the craps table, and was telling them I'm taking this thing to 5 grand. And I don't know. I don't remember how far I went, but um, you know, it was. You got to go on where you have, the most edge. You know what I mean? Where the house isn't. Where the house doesn't come into a play. The thing is with craps, if you play it the wrong way, the longer you play, eventually it starts to goes against you because of the payout amount. But again, you can once you get paid again, you can take. It's because people don't take their profits off the table. Like once you get paid, you don't have to keep your chips up there. You can take them off. So some people fail to really, lock in the profits like in the markets. So it's 10:30. I think we're going to start going sideways a bit right now. I'm going to give it another half hour. Then I'm going to go run and grab my cat some food. I'm gonna go get her a couple cans of chicken, and then we'll get ready for this FOMC meeting. I'm gonna leave the stream up. I can. I don't right now. I haven't. I could. But I thought about it. It's funny you said it because I was thinking about that yesterday. I was thinking about poker yesterday. Maybe one. I'll have to go sit up at. It's been a while, but I have played poker. There was a time when I was playing poker online, and that was years ago. But I might think about that. Poker can be fun, and it's another thing that's about probabilities, right? How about yourself? Do you play poker or anything? I've been just sticking really with sports and stuff. I should I could go over there while college football is on, but I like to watch football and kind of know what's going on and stuff. I was wanting to get a newsletter and stuff. I just want to get a lot of stuff going, and it's like I don't know. It's a lot. That's a lot. I start. I started it. It's just I feel like I need to get more educated on some of the things that are out there and some of this software and stuff like that. It's just going to take a little time. But not that that has anything to do with poker or anything, but so I'm still going to watch for 443 to see if we can slowly get there and then get along. Let me go feed her real quick and I'll be right back. All right, guys, I'm going to be right back. I'm going to watch this on my phone, but the pet store is like 10 minutes away. I'm going to go run over to the pet store real quick and go get her some food. We'll have the FOMC live, and then I don't know. We're gonna play it live and stuff. I'll be back in like 15 minutes. I'll be back in like 15 minutes, and we'll see where we end up. But I'm gonna be watching this market. So if we get to 443 while I'm gone, for some reason we just fall out of bed and we hold this level, this previous double top here from yesterday, I'm gonna be looking to buy. I was hoping we could get back down here at 442.30. That's another area. So we'll see. But I would like to start buying in this area to get up here, to get to the upside of the range. I gotta fix this. Yeah, man. I'll see you, Chris. Like I said, I'll have the FOMC minutes on, and I'll be ready. Looks like Tesla's getting ready to roll over. It just stopped putting in higher highs. It's getting ready to roll over. I think it's getting ready to roll over. I'll be right back.
Marketing software company Klaviyo going public today. Priced at the top of its range, 30 bucks. Indications 34 to 36 right now. Let's go over to Bob Pisani, of course, because Bob, you focus so much on the IPO market. We've gotten these three important offerings. Where do we stand?
Well, it's opening slowly, but very selectively, and there's 800 unicorns that are out there. These are the early ones. We'll see. Early trading of them, frankly, is not that great. Now, of course, it's great that they're pricing above the range. We're talking 19.2 million shares at 30. The price talk was 27 to 29 for Klaviyo. And prior to that, just a few days ago, it was 25 to 27. So I guess that's good news that they're getting more prices. But look what's been going on with the recent IPOs. Take a look at ARM. Remember what happened here. Priced at 51, opens at 56. It goes to 69 on the second day. And look, here, we're at $53. But that's nobody got in except the insiders at 51. The average price on the first day of trading, the average viewer, CNBC, bought this around $60. They're underwater, as you can see. Take a look at Instacart. Remember, priced at 30. It got to $42 yesterday, right after the open. And there you see, it's been basically down here in the $32 range. Now, you say, okay, it's still above $30. There's the initial price. But the average investor on the first day didn't buy in on that. They bought in the mid 30s. So that average investor bought in yesterday is still below water. After market returns, remember, these aftermarket returns, they're a self-correcting mechanism. People will stop buying these if they don't work. And that's what my concern has been. This has been the concern during 2020 and 2021 when the market moved up. Let me just show you some old ones. Remember, for example, Oddity Tech, remember that one? That was the big lipstick company. They did cosmetics, okay? Remember that one? We were all agog over that. July, they priced at $35. They opened at 50. It's now 32. That's below the price. And remember, it traded in the 50s for most of the first week, so everybody bought in around $50. How about Cava? That was the one that first opened up the market. Remember that? The restaurant chain? We were all agog. It priced 22 and opened at 42, it's right around there, went all the way to 50. So everyone was buying this at 42 and 50 for the first few weeks. It's now 33. So the average investor is below water, and this is what I keep talking about. I divide the IPO market into two pieces, first day and after that. So just look at the first day of trading. This year, up 19%. Great news. But after the first day, it trades down 7%. So the average investor that got in on the first day, you say, well, the insiders, they're still up on the year. That's true. But the average investor is down who bought in on the first day. And so here we got, here's what we're at. 77 deals so far. We have 16 billion raised. Is the market opening up? David asked me. I said, yeah, but look, only 16 billion. The average year we're doing 50 billion. So we're raised 30% of the average year, 3/4 of the way through the year.
Yeah, I mean, it's better than last year, but it's not good. And you seem a little worried about the aftermarket performance of many of these stocks.
Well, you should be. Look at those numbers. By the way, on the numbers, just put up the year's big IPOs. ARM, 4.9 billion. 1/3 of all the money raised is ARM this year. Kenvue is 3.8 billion, and everybody else. So two companies are almost 60% of all the money raised. So my point is, your question is the right one. Is it opening up? Yes, but it's still pretty moribund right now. We've got to have an awful lot of business in the fourth quarter, even to get close to an average year. And in my opinion, the valuations are still too high. I want the average investor who buys in on the first day to say a month, 2 months later, they're up. And this is still not happening.
The average, you keep talking about this average investor. Who are we talking? We're still talking about institutional investors to a certain extent, aren't we? Or are you thinking retail when you say that,
I'm
Bob?
thinking retail. I'm talking about the viewers who buy on the first day, the people who buy in on the first day. They are buying in at the higher prices on the first day.
I
and they don't make money.
But maybe they just shouldn't participate in the IPO
Okay.
market.
Well, that may be the correct.
But you're still going to get a bid because it's still going to be, the other people who, the institutions and hedge funds who line up.
I'm happy that
you need retail
Goldman,
for aftermarket?
Yes. I'm happy that Goldman and JP Morgan gets higher prices for their clients. That's their job. That's what they should be doing. But I'd like the average investor who watches our shows, don't get in on the inside price to be able to buy it on the first day or the second day and still say a few months
But
later.
what's the market
to make
done
money.
in
And
that
the trend
time?
doesn't work that way. So the interpretation is the valuations are still too high for the average investor.
It's been a tricky market too, though, Bob. You have these flare-ups with inflation, and the bond yields go up, and so it's not exactly smooth sailing, even though the equity market is higher.
I know, but we have to deal with the markets as they are. I mean, it's true. Everything, stuff gets in our way all the time from an average market evaluation. Yes, we have these weird events that happen, and we have these weird economic events, but we have to deal with the markets for what we're given. And so is it too much to ask? Like, this has been going on for years. The average
bring down the
investor
valuation,
the whole
Bob.
SPAC craze.
Yeah,
That's right.
But you bring down
Yes.
the valuation, Bob, and these things are way under their last, when they last raised capital. And that makes it difficult for these founders and the other ones to say, I'm going to do it.
Good. So let's let. I like the public markets. I don't like people hiding in the private markets for 10 years like these companies. And now they have. They're middle-aged companies like Instacart that have come out. They would have come out 5 years ago. Maybe things would have been different for them. So let's get younger companies. Let's make it easier for people to go public. Faster, easier.
Nothing gets you quite as emotional as IPOs,
Well,
Bob.
it's the
Thank
greatest
you.
thing ever to stand here and watch the
Yeah.
families. It's my favorite thing of all time, and I want to see more of
We
it.
love watching you do it. Thank you, Bob.
Okay,
Bob
pleasure.
Pisani. Coming up next hour, Airbnb shares an outperformer this year, and some fresh product news today. CEO Brian Chesky joins us to break down the business next hour. Don't miss it. Squawk on the Street will be right back. Dow's up 150. General Mills is a mover today, reporting a beat on the top and bottom lines this morning. Higher pricing, again, helping to offset lower volumes in the quarter. Also, the company reaffirms its guidance for the year. The company's chairman and CEO Ed Harmening saying, quote, the external environment is highlighted by moderating inflation, stabilizing supply chains, and a resilient but increasingly cautious consumer. Shares are off more than 25% from their highs back in May. The story here, guys, is strong humans, weak pets, because they have a big pet food business, the Blue Buffalo business, which they bought, and they are seeing a decline. They're not alone. We've seen it in Chewy and others in buying habits of pet owners, especially in treats. Treats went negative. Wet food was flat. Dry food was a little better, but the economics of that consumer is changing a little bit. On the food side of things, higher prices is still helping. Volumes were down 2%. The street is focused. The biggest question for all these food names is, as prices moderate, first of all, is it going to hit margins? And second of all, will volume start to come back? Because they need that for growth. It's one worry of why these food stocks have been weak all year.
Yeah, price has been the key here. Sarah, thank you. Squawk on the Street continues with Sarah and Carl right after this.
Good Wednesday morning. I'm Sarah Eisen with Carl Quintanilla live from the floor of the New York Stock Exchange. Stocks are higher ahead of the Fed decision this afternoon. Guggenheim Partners CIO Ann Walsh joins us in just a moment with the number one thing she is watching from today's meeting.
Plus, Airbnb releasing some updates, including lower pricing in an effort to take more share from hotels. An exclusive with Brian Chesky is ahead with the stock up 66% this year.
And we continue to await the opening trade of Klaviyo. What ARM and Instacart's price action will tell us about this debut.
Topping the tape for us this morning, fairly obvious, and that is the Fed decision. Ahead of that, rates retreating a little bit with oil holding pretty steady. B of A today did up its year-end price target on the S&P to 4,600. It's about 7% upside, while Citi says that global growth is likely to come in higher than predicted. Let's bring in CNBC senior markets commentator Mike Santoli. And that bullish note on growth is probably one reason why yields haven't fallen much.
That's for sure. The Fed's message of higher for longer. And, just in general, it's all the things we see as headwinds are, as I've been saying, coming against an economy that's already been humming pretty well. Also, the Fed in a pretty good spot, you would have to say. The fact that they basically communicated a likely pause, the market internalized a likely pause, rates are roughly where they need to be. If the whole debate is about what's the pace of potential cuts next year, that's not a terrible place to be, at least in terms of the market. Now, obviously, we could have complications to that story. We could have another hike in there. We could have a surprise on inflation. But I think it all fits together okay in a very low conviction, low momentum market that really kind of doesn't know what it's next supposed to be pricing in. I think the S&P is like 3% up or down from even giving a hint at the next real directional move.
What's the leadership in the market right now, and how has that changed?
It's grown a little bit less cyclical, a little bit less optimistic, a little bit less kind of risk-seeking and a little more defensive. So that's one of those things you say as this consolidation period in the market goes on. It's going on 2 months at this point. You've really lost a little bit of that sense out there that we have a strong belief in the underlying momentum in the economy. That's the market's message. Credit is saying no real big problems here, but in terms of the rate of change, it seems like we're starting to worry a little bit more about how the consumer and the economy are going to be able to absorb rates and oil prices where they are.
A couple external factors are being talked about that would buffet the Fed. One is the strike, pretty obvious, depending on how long it lasts. The other, as B of A says, if a shutdown happens, no data. And
That's
they
true.
said the Fed would be flying blind, probably means net, they would be more likely to stay pat in November.
Yes.
Except for the private surveys, I guess.
That's right. And it's a few steps down the line before you get to that point. You have to make some assumptions about where we're going to be in October. The one comfort I would take is the strike, something like a government shutdown, even to a degree, supply-driven oil prices going up. I'm not going to say they're self-correcting, but usually once they go back to work, you have a catch-up in auto production, right? Once the government is no longer shut down, you have a catch-up in the fiscal side. So the point is, it's not like the new run rate of growth. It's more just this complicates a potentially already vulnerable growth story.
I think the UAW strike thing, though, is not a risk as much for growth, which sure it is, but it's really on the inflation story.
Yeah.
And could exacerbate supply chain issues and car prices, which have been an important input into the lower inflation.
There's no doubt about that, but to me, it's like when you know the actual cause of the spike in inflation, it's going to end.
Transitory.
And if you no longer have a Fed that's looking for excuses to continue to raise the alarm on inflation, if they want to say we're where we need to be, they'll de-emphasize it.
I don't know. It depends how far along they are in that.
That's true.
Not wanting
and
to.
we don't know.
I mean, they're still sort of paranoid about inflation. Mike, thank you.
Yep.
Let's stay on top of the Fed's decision. Our next guest believes the Fed is done. Hikes are likely over. And the bigger story she's watching today will be the updated economic projections. Joining us now is Guggenheim Partners Investment Management CIO Ann Walsh. Ann was named to Barron's list of 100 most influential women in U.S. finance. Welcome, Ann. It's good to see you.
Oh, thank you, Sarah. It's nice to see you as well.
So talk to us about what you are looking for as far as the economic projections in the dots.
So I think we're going to get a sense of where the Fed believes they need to go at this point in time. We believe that the Fed's probably on hold. Whether they signal that with a bit of a hawkish tone is probably to be expected. They don't want to have to reverse course and start raising rates again, but we don't see that in the projections. I think what will be probably more informational is where they see the future neutral rate to be, and whether they can start lowering rates into 2024. Before we even get to that, I think we're going to see continued slowdown in the economy and lower inflation. And, that's the trajectory. But nothing moves in straight lines. As was just noted, oil prices have been increasing, and that, of course, is going to have an influence on inflation in the short run.
So, Ann, how are you guys positioning at Guggenheim around the soft landing story? Are you gearing up for a more pronounced recession?
So our view is that we will see a slowdown in the economy. Whether it's a full-blown recession or a type of rolling recession or just a significant slowdown, I think that's ahead of us. The Fed has done a tremendous amount of tightening into this and through this cycle. 5.5% Fed funds with quantitative tightening, i.e. the reduction of the balance sheet. That is still ongoing in the background. And so I think conditions continue to be tightened for investors. As a result, we're really thinking about how to position coming through a slowdown. And that means being more defensive, particularly at this point in time. Now, the opportunity set exists very nicely in investment grade fixed income. You're getting yield, which we weren't getting last year or the year before. And so investors are getting rewarded to be patient and defensive into this cycle, particularly in investment grade corporates and structured credit, where you can get 5.5, 6% yields. Very attractive at this time.
What about the equity market? Anything look attractive there?
Equities are a bit concerning because I think they are overbought at this time. PE ratios were really, PE ratio expansion was really the, multiple expansion was really the driver of performance this year. And that concerns me with regard to the broader markets. As we were just listening in earlier, you were talking about the shift towards defensives. I think the market is moving in that direction, albeit a little bit slowly. And so I think that being thoughtful with regard to positioning at this point in time will hold investors in good stead. I mean, we're seeing even in high yield, though, there's still investment opportunity, but we're going up in credit quality there and being more defensive in terms of covenant protection, investor protections at this point in time. The Fed's really trying to slow the economy down, drive down demand, and ultimately usher in this slowdown of this recession that we're projecting. And so being thoughtful and being defensive at this time makes a lot of sense.
And, you know, a lot of skepticism among some that you can actually get back to a real 2% target. I would argue maybe you think it's, of the people who are watching this closely, you think that is possible maybe, or getting at least close to it by the end of 24?
Absolutely. I think the Fed is going to continue to remain tight. The higher for longer story is playing out right now. The Fed's not likely to want to pivot very soon. They don't want to repeat of the 1970s where they would lower rates and then inflation would rear its ugly head again. So what they're really looking to do is to hold steady to make sure that inflation is managed. And we do believe that they can get to the 2% target sometime in 2024. At that point in time, they're going to reverse course and rates will fall. The long end of the curve will fall before that because of the expectations on inflation. That trades with inflation. And so as a result, we would see that the 10-year Treasury, which of course is at record levels right now, it will reverse course and work its way back down into the lower part of the trading range. We've really been in a trading range of about 3.25 to 4.25. Obviously, we're a little bit on the high side of that right now. But as we go through the 2024, we would anticipate that the 10-year would retreat from these levels back down at the lower end of the trading range. Probably not through that trading range. There would have to be some sort of really severe financial event, which we're not projecting, to cause any kind of move of the 10-year Treasury well below that.
In the next, what, year or so? Is that what what's the time frame there?
Time frame is we'll start to see the 10-year reverse course probably later this quarter, certainly into the first quarter as we continue to see the economy slow down and these recessionary elements really come to the forefront.
Got it. And really good to hear from you. Get your sort of worldview, market view. Appreciate it. Ann Walsh, CIO of Guggenheim.
Thank you.
Getting a news alert this morning on Bank of America. For that, we'll turn to Leslie Picker. Hi, Leslie.
Hey, CQ. Bank of America is hiking its minimum wage to $23 per hour next month. That means the floor for annual pay for full-time employees increases to nearly $48,000, the firm said in a press release. Thousands of employees will be impacted by this. Bank of America doesn't break out a specific number, but the increase is $1 higher than the Bank of America's prior minimum wage of $22. Bank of America has said that it plans to raise minimum wage to $25 an hour by 2025. That's a 121% increase increase since 2010. And $23 an hour is broadly higher than almost all of Bank of America's banking peers, although some banks do adjust their minimum wages based on location. It's also more than 3 times higher than the federal minimum wage. The majority of U.S. states have their own minimum wage laws that are more, but 21 states default to that federal level. Working 40-hour weeks, that minimum wage amounts to just over $15,000 a year, guys.
Having just come off a discussion about wage growth and inflation, Leslie, thank you. Leslie Picker on B of A. Meantime, UBS staying bearish on retail, but picking a few names they say can outperform in the near term. We'll get to that next.
Plus, the CEO of Airbnb with us after some new announcements related to prices. Those cleaning fees may finally be dropping. All that and more when Squawk on the Street comes right back. We're holding on to a gain and pushing a little higher here, up 185 on the Dow.
Go to FabLetters.com.
Some retail calls to get to this morning, including JP Morgan downgrading Dollar General to underweight after hosting the company's CFO at a conference. Concerned about consumer spending. A bit of a catch-up part of the story here, considering the stock is already trading at the lowest level since 2019. But Carl, the dollar stores have been weak, but overall retail lately has been weak. The S&P Spider Retail ETF near 3.5-month lows, potentially because of some of these headwinds like student loan payments and higher oil prices.
Yeah, we went through the ringer on some of those earnings prints on the recent quarter a couple of weeks ago. Another retail call on our radar is a soft line slump from UBS. The firm says it expects a slowdown in the sector to play out over the next 6 to 12 months. Sees more downside for a number of names. Joining us this morning, UBS Managing Director, Senior Retail and Specialty Soft Lines Analyst, Jay Soul. Jay, it's great to have you back. Fascinating note, which we talked about yesterday. You've done some survey work basically looking at holiday spending intentions. And I wonder if you think we're getting to a point now where the consumer is starting to make some tougher choices.
Well, Carl, thanks for having me on the show. And you're absolutely right. You know, the consumer in our survey work is telling us they feel a lot less optimistic about how much they want to spend this holiday season. In July, they were relatively positive. In September, that positive attitude went away. And people are now getting really cautious about spending. They're cautious about spending overall, not just on holiday, but really over the next 3 months.
Talk just a bit about the spread between the respondents who say they're going to spend more versus less.
Yeah, so one of the questions we ask in the survey is, you know, do you plan on spending more or less on Christmas gifts this year? And in July, we got some answers. And in September, we got more answers. And typically, you know, the amount of people who say they're going to spend more doesn't change from July to September. But this year, we saw a big jump in the percentage of people who said they're going to spend less, and really very little change in the percentage of people who say they're going to spend more. And that sort of sequential change, that change from July to September is really notable to us. That says that sentiment for consumer spending on apparel, footwear, and accessories is really falling.
So then how do you determine winners and losers in that kind of environment?
Well, Sarah, I think it's going to be tough overall. You know, we have a bearish call overall on the soft line space, and that's because we think if consumers are pulling back and feeling like they have to make choices in their budget, one of the main things they're going to pull away from is apparel, footwear, and accessories. That's what the data tells us. And so it's not going to be great for anybody, but there are some companies that have been taking share that have great momentum, like Deckers, which is the owner of the Hoka brand for sneakers, On Holdings, that's On sneakers as well, and also companies like Ralph Lauren.
Yeah, we've seen some pretty constructive comments on RL in particular lately. Some of that's been around cleaner inventories, margin upside, and I think what cotton has done, right, over the last, say, year and a half.
Well, Carl, that's right. You know, there's a lot of nice cost savings that are going to be helping Ralph Lauren's margins because cotton costs are down, freight costs have fallen. But at the same time, you know, Ralph Lauren is a company that's really been through a lot of changes over the past 10 years. And really the work the company has done to reposition itself for today's consumer environment, you know, being in places where consumers want to spend with the right kind of products and a brand that's regained momentum is really something that the market isn't quite kind of paying attention to. And I think we're at a point now where the company's going to start to show a lot of growth, surprising growth, not just in the US, but really all over the world. And that's what we think is going to make the stock go up. They've really done a great job and they're on the right track.
But everybody, you know, you have a pretty wide range of retail in your coverage universe, from the department stores to the more higher income brands like that Tapestry would have, to the dollar stores. Are you saying universally everybody's going to weaken here? High end, low end categories?
Well, Sarah, what's interesting about what the survey data shows is that it's not just lower income consumers who are feeling the impact of inflation and sort of feeling the impact of having to start to repay their student loans. What we're seeing is really all consumers of all demographic types are starting to say, hey, we're feeling a little bit less good about our financial situation and about how much we want to spend over the next 3 months and into holidays. So it's really not just focused on one group of consumers or one group of stocks. It's really across the board.
Jay, fascinating, and we're going to find out pretty quickly here how this shakes out as we get closer to holiday. Thanks for the time, Jay Sol at UBS.
Early indication from Nike next week when it reports earnings on the strength of consumer. We're getting some breaking news now out of Stellantis. Phil LeBeau has the details. Phil.
Sarah, take a look at shares of Stellantis. The company has announced that it is going to be laying off 68 people at its Toledo machining plant as a result of the strike that is taking place down at the Jeep plant in Toledo, Ohio. In addition, it says that it is likely to lay off an additional 300 at its Kokomo transmission as well as Kokomo castings plant in Kokomo, Indiana. So this is the knock-on effect, guys, that we've heard about, that we've already heard news from Ford and GM, that because of these strikes, if work or parts are not going to a particular facility where there's a strike taking place, they're not going to continue cranking out whatever product or having the people who are working on stuff that would be going to that plant. It's just not possible. So as a result, Stellantis laying off 68 immediately in Toledo and likely laying off another 300 in Kokomo, Indiana. Guys, back to you.
But just to be clear, Phil, they're temporary layoffs, right, until the plants come back?
Sure.
Yeah.
Sure.
All right.
Yep.
Well, that's something. Phil, thank you. Phil LeBeau. The past week has been a big one for IPOs. ARM, Instacart going public. Street reactions to those debuts and some of the price action since those IPO days. Coming up.
Still awaiting Klaviyo's first trade at the NYSE. Indications 35 to 37. We're going to bring you that as it happens. Stay with us. Got some news in the pet food business to get to. Oppie cuts Chewy to perform and removes the target. General Mills also concerned about the pet food industry. As part of its results, executives say return to office has led to headwinds for the treats and wet food segments of the pet food category, as people are obviously home a lot less. Also new this morning, Walmart says it's testing out a pet telehealth business. Chewy and Petco obviously having a rough morning. That is an all-time low, by the way, Sarah, on Chewy, half falling below the $20 mark.
Everybody was wondering on some of these stocks when the COVID give back would happen, right? Everyone adopted pets during COVID. They spent a lot. These stocks went up so much, and then they came down pretty sharply. And it feels like it's been a delayed reaction, and it's really been the economic weakness that's hurt the category even more. Meantime, European stocks set to close in just a moment. Up across the board with retail stocks leading the charge here as UK inflation numbers surprised investors this morning. Both the headline and core numbers fell below expectations. The numbers pointing to a drop in hotel prices, also airfares dropping, as well as food rising less than versus a year ago. The unexpected move throws the Bank of England pretty big curveball. The central bank is set to make their own decision on rates tomorrow at 7 a.m. Eastern time. The Bank of England has issued 14 consecutive interest rate increases. If they raise by 25 basis points, the 5.5% rate would be the highest borrowing level for the UK since going back to December 2007. Deutsche Bank out with a note moments ago saying they expect the BOE to hold rates steady following today's data. That maybe gives them some breathing room to see about those lags and let inflation come back down naturally. It was thought before today that they would raise because their inflation is higher than the rest of the world.
Could you argue that it's removing one of the most hawkish central banks of developed economies in the world right now?
If they actually pause.
Yeah, if they do pause.
If they do pause, although they'll probably still sound pretty hawkish because it was a miss, and it's good to see that decline by more than double on the monthly rate, but it's still elevated inflation.
6, 7 year
They've still got to be standing guard. So not in the clear, really, in terms of hawkish central banks, I don't
think. No one wants to go there yet. Yeah. A couple hours into trading, we are holding on to opening gains. Dow's up 180. Let's get post to post with Bob Pisani. Hey, Bob.
Good morning, and we, of course, are waiting for Klaviyo to open here. Let me just show you some indications. We've got some new one right here, 35 to 37. Remember, we're talking 19.2 million shares at $30. So, again, following the trend, not only upsizing, the initial talk was 27 to 29, but even indications higher than the initial price here. So let's figure out what's going on here. Glenn Carell, my old friend, known for many years, done a lot of big IPOs down here on the floor over the years. How's it looking?
It's looking pretty good. I mean, you can see right now our indication is 35, 37. So, we're excited about that here at GTS and for the Klaviyo team. So, it takes time to build that book, and that's what we're in the process of doing right now.
And those of you who want to figure out what time this might open, 19.2 million shares. A general rule of thumb, would you say is fair? They wait for roughly 10% of the float. So you want to see about 2 million shares that are offered. How many do we have offered right now?
Close to that. I mean, we want to see anywhere between maybe 1.5 million and 2 million. So, we're getting close. We're maybe around 1 million or so. So we still have a long ways to go. And we're still building that book. So again, we want to make sure everybody knows exactly what's going on. All investors have that opportunity to participate on the opening price. So we're waiting.
You're very involved in the meetings with these IPOs that are coming through. They're talking to you. They're talking to the NYSE. They're over talking NASDAQ. They're talking to a lot of people. You're in these meetings. What's your sense of the IPO market? We're talking with David Faber and the guys about whether the market's opening up. Do you sense that it's opening up?
Yeah, I kind of get a sense, right? We've had 3 big ones, recently. So, with the ARM IPO, with the Instacart, and now we got the Klaviyo. So, it's exciting, and hopefully this will open up, the market for more to come.
We'll see. And, of course, as we were talking with Sarah, with guys earlier, a number of these big deals, Kava's now has been rather poor recently. It's still up. Oddity Tech is down from its initial price. Kenvue's down from its initial price. So it's good news that they're pricing them at the high end of the range and getting a lot of money for the initial investors. But it's the aftermarket returns that you want to look for at this point.
Sure, and we'll see what that aftermarket brings. So right now we're just focusing on Klaviyo, and we're excited here at GTS and for the team.
And of course, the Klaviyo team is outside, guys. We're having a very big little social event outside. They'll be inside in the next few minutes as we get closer to that opening. I'll be here for that as well. Guys, back to you.
Yeah, well, they already did their CNBC interview.
Yeah,
so they're chilling now, waiting for that opening price. Thank you, Bob. We'll be coming back to you often, Bob Pisani. Speaking of IPOs, let's check in on 2 other major debuts in the last week, because we've seen some weakness post that IPO pop. There's ARM. Continues to fall despite a 25% pop at the open last Thursday. The stock has dropped at least 4% every day since its debut. Remember ARM last week, price 51, started trading at 56. We're at 53 now. Instacart also is lower this morning. That stock popped 40% on the first trade, ended up only 12, pricing at $30 per share. Remember, it's now hovering below $32. More than 2/3 of IPOs this year are trading below their IPO price. And just on Instacart, for reference, priced at 30, opened up at 42. We're now at 31.90. So we're watching this. It's such an important sentiment barometer for the overall market.
For sure. Getting them to market and then the follow through for sure. Let's get a news update this morning with our Contessa Brewer. Hi, Contessa.
Hi there, Carl. Happening right now, Attorney General Merrick Garland is being grilled by the House Judiciary Committee on Capitol Hill. It's his first appearance before the committee since the plea deal for President Biden's son collapsed. Garland asserted this morning he has not interfered in special counsel David Weiss's investigation into Hunter Biden's case.
He knows how to conduct investigations, and I have not intruded or attempted to evaluate that because that was the promise I made to the Senate.
The company that owns Budweiser reportedly will stop cutting off the tails of its iconic Clydesdale horses sometime this year. PETA and other animal activists have pressured the company to stop that. There's no time frame for when the so-called tail docking will end. That's according to the Wall Street Journal. Kraft Heinz is recalling more than 83,000 cases of its individually wrapped American cheese singles. The company says 6 customers reported gagging or choking when eating the cheese because of a manufacturing problem that could cause the plastic film to stick to the cheese. That's the news. Sarah.
Can't say that hasn't happened before to us. Thank you very much. Those plastics are sticky. Contessa Brewer, the CEO of Airbnb, coming up next. Some new announcements surrounding pricing and fees in focus. The stock's been a big winner this year, up 66%.
CNBC's delivering alpha just 8 days away now, and there is still time to register. You can scan this QR code on your screen or just go to cnbcevents.com/deliveringalpha. We're back in a couple of minutes.
Welcome back. Airbnb announcing it is cracking down on some customer complaints that are common, including fake listings and high cleaning fees. Our Deirdre Bosa joins us with Airbnb CEO Brian Chesky for today's Tech Check segment. Deirdre, with more on the news.
Sarah, thank you. And Brian, hi, thanks for being with us. It's good to see you.
Good to see you.
A lot of the updates that you announced this morning focus on more transparency, better affordability. I want to show our audience this chart, which you guys published. It shows that prices are now rising faster at hotels versus Airbnbs. Brian, this is great for people renting on Airbnb, but less so for the hosts, right? The people renting out their homes. How are you making sure that they, the hosts, continue to benefit from being on the platform, that they're not losing money here?
Yeah, I mean, it's probably good to say that, like, over the last year, hotel prices globally are up 10%, while Airbnb prices are down 1%. This is data as of July. Now, we want to make sure it's a win-win for hosts. And what we've actually found is if hosts charge a better value, they often make more money because they don't run at 80, 90% occupancy rates like hotels. And so one of the best things they can do is provide more value so they can book more nights because their occupancy is much lower. So we're able to see within reason, this can be a win-win for both guests and hosts.
Do you expect this current trajectory to continue? That is, do you think that nightly rates for Airbnbs will continue to fall?
I think that what's likely to happen next year is hopefully Airbnb prices will not go up. They'll either be the same, they could go down a little bit, and I think hotel prices will probably rise. The reason I think that is because on the last earnings calls, a lot of the hotel CEOs expressed optimism that they would be able to raise prices. You know, Airbnb's always been known as an affordable alternative for a hotel. So long as we are that affordable alternative, I think we're going to all continue to thrive.
Right, and so something that you focused on the recent set of updates are cleaning fees. You hear a lot of complaints,
Yes.
you know, just anecdotally about them. Where are they going? Are they being passed on to the hosts? How do you make sure that listings are still clean, they still meet certain requirements, but they're becoming more affordable to the guests?
Yeah, I mean, it's really important that you feel like you're not charged onerous fees when you come to Airbnb. And that means that now we have an upfront pricing display. You can turn the toggle on. You can see the total price. About a third of people do that. But we now have about nearly 3 million listings in Airbnb that do not charge a cleaning fee. And over the last year, we've worked with hosts. In 250,000 hosts have either removed their cleaning fee or lowered them. Again, this is all about going back to a bigger idea, Deirdre. We've been listening to our community. I want to be one of those CEOs that's constantly listening to customers. Yeah. And customers tell us they want affordable listings and they want to make sure the service is reliable. So we are continue to make updates.
Right, and you've done that while increasing your profitability. But I guess same question, though, where are the cleaning fees going if they're not now being paid for by the guest? Who's paying for them? Who's cleaning?
Well, the hosts are essentially offering better value. If a host lowers their cleaning fee, what they're really doing is offering a better value for guests. The way the host makes up for that financially is hopefully they get more bookings. They fill up more nights a month. And so hopefully, as I said, this can be a win-win for both. Obviously, we want to provide as good as a value as possible for guests. It's still got to work economically for hosts, and we're not the ones that charge. So it's all about finding this balance.
Right. Brian, I'm wondering if the regulation playbook has changed as Airbnb has become bigger. You know, you're seeing that crackdown in New York. You've seen crackdowns in the past. What's different or not different about it this time? And what's your playbook this time around?
You know, it's quite different. I remember, Deirdre, when we first met years ago, people were asking, would Airbnb continue to exist in a world of regulation? Now they're asking, how is it going to exist? 80% of our top 200 markets have regulation on the book. What I've learned, the thing I'm surprised by, is how different every city is. Every city has chosen very bespoke ways to approach this. But we actually have regulations in the book in most cities. Most cities are pretty stable. I think that we've become a very important part of local economies. We've collected and remitted billions of dollars of hotel tax. So we're always going to be regulated. We're always going to be at the table so long as we're relevant. But I think things are actually calmer than they have been in the past, notwithstanding a couple specific cities.
At the same time, New York City is I believe, your biggest market. Are you optimistic that this?
All right, let's see where we are at.
To hit your supply there.
I mean, I don't think New York's going to be resolved. In New York City, one point, like 13 years ago, was like 70–80% of our business. Now it's a very small percent of our business. In fact, there is no city on Airbnb that comprises more than 1.5% of our business. And New York is not actually in the top 3 markets anymore.
So hopefully
Paris
you guys
and London,
did not waste your
LA
bullets.
are top markets now.
Or at least, you know, whether you
I think
didn't
New York,
waste them, it's like...
unfortunately, is not going to be resolved anytime soon. It was
make
the
sure
first
you,
city we had challenges with in 2010. It may be the
wisely,
last one that
right?
gets resolved.
So Tesla's still
that's
pretty
unfortunate.
strong
The good news
if
is
it's not
there's
frozen.
100,000 cities all
If this
over
is
the
where
world,
Tesla's
and
at
most
right
of them
now.
have chosen to not follow their lead.
So I just
but
ran to
go their
grab
own
her
way.
some food.
Right, you guys have diversified.
It's 12 o'clock.
Brian, you recently added Google's so-called AI ambassador to your board, James Manyika.
Yep.
All right, there's a
Airbnb,
double
I know,
bottom
has
right off of that
long-used
level,
artificial
guys.
intelligence on its platform. When do
give me
we
a
start to
15-minute
see you
chart.
incorporate generative
Let's check
AI?
this shit out real quick.
I think you're going to see some
Pins
smaller
is
implementations
also
next
another one we're
year.
looking
In
at.
2025 and beyond, you're going to see probably
Let's see
much more
here,
profound
Shimacti.
implementations.
So
The basic idea
that's,
is like when you go to
you know, that
ChatGPT
pullback
and you ask
is
it
a
a
lot
question,
lighter.
and I ask it a question, we get
Let's
the
look at the
same
daily,
answer. And the answer is an
because you
almost
want to know
entirely
where,
text-based answer.
you know what I
I
mean?
think
Like,
you come
look,
to Airbnb,
4 hour.
what if Airbnb was like
It's a
the
bit
ultimate host?
oversold.
It learned about
Overbought
you,
or
asked you questions
oversold.
about what
Daily
do you
chart,
want, where do
it's
you want to go, what's your
overbought.
budget, and then
But
instead
you
of
want to
having
bring
this
it down a
simple search
little
box
bit,
with dates,
right? You want to
we
bring
could
this
have
thing
a
down a
much
little
more
bit to be able to get
robust, ultimate,
long.
like kind of travel
You
concierge
know,
that
at
can
least
help you. It'd be a much
have the
more
indicators
visual, richer
let you know that,
experience.
hey,
I think
like if
this
you could
is
have got
where
this thing
travel
down to
could be
50
going. I
flat,
think AI is going
right?
to be an
49,
amazing opportunity
50
for many
down
companies, and I
here.
do not think it's going
Let's
to
see
be
if it
dominated
tries
by
to make
one
another
monolithic
push.
chatbot. I think it's going to
See if
be
it tries to
across
make
the
another
entire
push,
platform.
or it's just going to sit here and
like
trade
an AI
sideways.
concierge. Last
And we'll
question for
short
you,
the
Brian.
bounce.
Our digital
That's already my
reporter,
plan, is to
Hayden
short the bounce.
Fields,
But I
you
want
wrote
to
a
see if
fun
I can get a
story
long
about,
before I
Airbnb's
get that
so-called
short.
party
Right? I want to
pooper.
make some money on the
Nava
long side
Banerjee, who has
and put it
reduced
towards
partying
that
by
short side.
55% in just a few years.
That's
How
what I
did you
want
come
to
up
do.
with this role? How does it work? You're also incorporating
And
AI
I'm not
here.
fighting
Yeah,
the trend
I think
here.
her official title might be
I,
a different title. But one of the
you
things,
know,
it's really interesting.
I'm just,
We obviously had an issue with
you know, it's just
parties
what I think. It's what I
a
think,
handful of
bruh.
years ago. And one
all
of the
it
things
is,
we
it's what
did
I
is we asked
think,
ourselves,
bruh.
can we use AI
It's a really nice hold of this
to
level
better
up here
detect
too, by
parties?
the way.
We had
It's a
over
really
a
nice
billion
hold.
guest arrivals. That's
This
over a
this
billion data points.
263
We're able to
level,
look
it's a
at
very
regressions
nice hold.
of all past trips and start to look at patterns.
I'm sure
when
people are
do,
surprised that
when
it
do
hasn't
certain characteristics
dropped
lead
yet
to a party?
below it,
And it might be
or
such
dropped off
subtle
of
things
it.
that if a human eye looked at, you would never notice. And we basically piloted this party
So it's
detection
saying
technology
that
in Australia. We're able to prove that this technology was able to reduce parties by blocking reservations or asking the people booking, hey, we need more information before you can confirm this reservation. We've now brought it out globally, and it's been very successful. I think this goes to the fact that we are constantly trying to make our platform more secure.
So I
We
was
want to
just
be good for
looking at
neighborhoods. We
something and-
always want to use the latest and greatest technology to create the best experience possible. And we're never going to stop. That's what
looks
today
like
was
it's
about.
trying to get the
We had
bounce
5 major
now.
updates today, based on feedback from the community. That came after 53 upgrades
And they're
last
talking
May.
about Tesla,
and
too.
hopefully you
And
have me
look,
back in
we're
November. I'll have even more upgrades to tell you about.
Yeah, I want to hear about
Let's
that
see
on
if
the host
at
side of
around
things as
12
well.
o'clock,
Brian Chesky,
1,
as always,
2,
thanks for making the time. Talk to you again soon.
we get that bounce back
I'll toss
to
it back to you at the New York Stock Exchange.
Thanks so much, Deirdre Bosa.
that area
Still to
when
come
the
this
Fed
morning,
comes
a look
on.
inside Goldman and Apple's scrapped stock trading venture.
There's a
Plus,
break,
watching
there's a
IBM.
retest.
RBC initiates today at Outperform. You can read more about why they think the stock can jump another third from here on CNBC.com. Stay with us.
There's SPY, guys. All right, so what I'm seeing is, you know, a possible reversal to go back right to where we opened, about around that 1 o'clock time, that lunchtime time frame, as we normally do during a Fed day. I think the more important part of the day is going to come when he starts getting asked questions, especially about the balance sheet. IWM. That's a nice hold of that level right there. Right there. It just started to make it it started to make it resistance, actually. So I take that back. Let's see here. Wow, we got our opportunity yesterday on JP Morgan. I missed it again.
Welcome back.
What
As
do you
part of
guys think?
Climate
What are you
Week,
guys
companies are
thinking for
making big
this
promises
whole
when it
move?
comes to the environment. Now, new data showing who's actually
It
following
feels like to me
through.
we're just
With
gonna
that, we turn to Diana Olick, who's here in
continue to
Bushmont.
bounce
Nice
and
to
put
have
in
you,
a lower
Diana.
high
Nice
and
to be
then
here, and you're right. Companies are
kinda
making
sit
these pledges
sideways.
to reduce carbon emissions, but unfortunately, they're not all putting their money where their mouth is. This, according to a new report from Just
kind of like
Capital,
we
which
did back
ranks
here for the
companies
other
in the
prior
Russell
debt
1000.
agreement.
Despite a
Have you
tripling
guys
of
looked
net
at
zero
that?
commitments in the last 3 years,
This is what I'm
357
talking about
companies
right
in
here.
2024, up from 110 in 2022.
Here.
They say action isn't keeping
Right,
up.
remember how
The
we
companies
sat in
that
this
have
pennant right
committed to
here and it just
science-based
went up and
targets
down?
have reduced their emissions
And then
the
broke out,
most, but
boom, and
still
then we
just
finally got the
26 of
pullback and it bang.
123 disclose actual reductions. Companies
So-
with general or net zero climate commitments have actually increased their emissions.
I'm
Now,
gonna
the biggest
go
emissions reductions were reported
get ready.
by
I'm gonna
Avangrid,
get ready
Owens
for the
Corning,
day.
and Johnson Controls International. I spoke with the chief sustainability officer at Pepsi, who is here for Climate Week New York, about hurdles in just the reporting process.
Every dollar that we spend developing reports or information for somebody is money we don't spend investing against solving the problems. And again, we're all in on reporting because it builds transparency, builds accountability, which ultimately creates trust. And trust is so important. But what we would ask for is, please, can we harmonize some of these standards to provide people the information they need, but allow us to spend the money on doing as opposed to reporting.
And Pepsi is really interesting because, you know, we think of them as a beverage company, but they're really a food company. So they've spent millions of dollars on regenerative agriculture. They just, in fact, announced a $120 million effort with Walmart to work with farmers. That's all on sustainability as well as resilience.
So why are we not seeing more progress?
That is the multi-bajillion-dollar question. Look, you know, it's going to be a long road, and people are making these commitments, and they are committing billions. We see it from some of the public companies. We actually see it more from the private sector, though, and VC funding going into a lot of this. So, you know, we keep hoping.
I mean, I wonder, are people talking about whether governments need to take a bigger role in terms of mandating and disclosures? We know the SEC is trying to get companies to do this, and they're protesting.
Right. Well, that's part of it. But also, you got a lot of IRA funding, infrastructure funding. That has been tremendous. It's also helped bring private money into climate because they see government money is going into it as well. But what a lot of folks are talking about now is higher interest rates. And that, like right here in New York City, where they want to decarbonize real estate, it's much more expensive due to higher interest rates, and that pulls everything
Kind of
back.
explains why the UK Prime Minister is on the tape right now, pushing back some of their EV deadlines.
And it's why solar stocks are down, because higher interest rates make it hard to afford.
Yeah, easier to do during boom times, I guess.
Absolutely.
Diana, thank you. Diana Olick here in New York. Up next, one of HSBC's top strategists weighs in on the impact of this afternoon's Fed decision, the end of the hiking cycle, and no recession. A few of his predictions. You'll want to hear from him next.
All right, looks like here comes the reversal. Reversal coming on in. Coming in hot. Come on, let's go. Come on.
Free consultation.
Let's close out the hour where we started. The Fed decision this afternoon. Our next guest says we've seen the last of the rate hikes and isn't expecting a U.S. recession, predicting we could actually see the Fed start cutting rates toward next summer. Joining us now is HSBC Chief Multi-Asset Strategist Max Kettner. Why are you so sure that this is the end of the hiking cycle? I mean, it does feel like that, but also feels like maybe they could go again before the end of the year if inflation stays at these kind of stickier levels above target.
All right, so
yeah, but look, I guess it
we
won't do an awful lot of good, right,
up
to go another
0.2%,
25 or another
0.2%.
In reality, what we've seen so far is actually there's pretty counterintuitive effect where, you know, particularly the large caps in the US have actually still holding close to record high cash holdings. So they are continuing to really hold these pretty high cash holdings and earning the higher interest on that, whilst on the same time they've extended maturities, right? They've pushed out maturities, and that means they're actually still perversely benefiting from these higher rates. So, you know, ever higher rates won't actually do anything to solve the problem. It's more about what happens in 2024. It's more about what happens in 2025 as well. So really the next 2 years, if we're going to see those kind of rate cuts that are priced in, or whether the market has to take out a few of those rate cuts that are priced in for the next 24 months, that in terms of, you know, the crucial questions for equities, for credit, for rates, that's much more important now.
So it does the returns for equities or the continued rise in equities depend on cuts next year, and how soon and how much?
Partially it does. It does in some parts of the equity market, right? So a part of the growthy kind of parts of the equity market, right? NASDAQ, the tech stuff. I'd be probably starting to be a bit more cautious on those part of the market towards the end of the year, right? To me, it's more an environment now where I want to be, you know, starting to bottom fish in the banks, still pretty constructive on energy, right? So still a bit more constructive now on the value side of things. Overall on the direction, I don't think it does that much because let's face it, what happened last year is very different from this year, right? Last year, rates were selling off and yields were massively going higher in anticipation of that massive rate hiking cycle to actually crush the economy, right? It was in anticipation of things to become materially weaker. It was anticipation of a squeeze in margins, a massive earnings recession. This time around, if yields do move a bit higher, right? If we're wrong and the Fed has to go another 25, well, it's the entire opposite, right? It's the exact opposite. It will be as a reaction of things actually being much stronger than expected. So then if you have a couple of dips in equities or in high yield credit, to us, those are the dips that you've got to be pretty quick in actually picking up and buying those dips, which is very much the opposite from last year, where it was in anticipation of weakness. This time around, it's as a reaction of things becoming too good.
You do like EM, but ex-China, and I'm curious, you know, Yellen said this week you can't rule out spillover effects from China. It doesn't sound like you think any of this data is really showing that they're stabilizing.
Yeah, look, in China, I mean, what we are seeing is really pretty broad-based bearishness. You see that in the flows data, right? You see that in the foreign investor flows data. But let's be honest. So for us, EMX China is mostly Latin America, right? It's the nearshoring story in Mexico. It's also, you know, Brazil. That should be also both of those benefiting from a pickup in manufacturing activity, specifically in the US, right? We are seeing definitive signs really.
Come on, let's get this rip up, TLT. You know you want it. You know you want it.
PMIs perhaps picking up, and that's really where Latin America can benefit, but also other parts of Asia, right? They're not necessarily really only dependent on China. Think about India, right? India's had a pretty good run. Even markets like Korea, like Taiwan, you know, they've had decent years so far, right? They've had a decent couple of months. So that's not just been a China story. And on China, I would say, look, the sentiment has become very bearish, right? It perhaps doesn't need a lot to actually manufacture a couple of upside surprises. And then, you know, perhaps even China can be a buy going into 2024.
Max, thank you very much. Appreciate your take today on a Fed day.
Thank you.
Thank you. from HSBC. For the buzz today, our own Kate Rooney and Hugh Son reporting Apple and Goldman Sachs were planning a stock trading app for iPhones in the spirit of Robinhood before bailing on the idea last year due to the market's downturn. According to sources, they developed the product during COVID in a time of zero interest rates, set to launch in 2022. Apple reportedly backed off the launch, fearing backlash that consumers might lose money with the assistance of an Apple product. Apple and Goldman Sachs have a number of financial tool partnerships already. They've launched a credit card, high-yield savings account, and buy now, pay later offering together. Apple and Goldman both declining to comment on the story. But interesting when that whole retail trading fever hit during COVID that they were developing this idea.
I mean, you think back to the spring of 21, let's say, where it was SPACs, it was memes. I wonder how close Apple and Goldman came to getting sucked into that craze.
There was a lot of interest.
Yeah.
I mean, people were at home, people were
Robinhood.
flush with cash, and there was, remember, it was like prime time for retail trading and investing. Higher interest rates, man. That's the story. Correcting a lot of things. By the way, Carl, Dow's up 200 now, and S&P's trying to push a little higher as well. NASDAQ was negative for part of the morning. It's still negative, kind of flattish. Heading into a Fed meeting. As far as the Dow, it's being driven a lot by some of the strength in the cyclical names, which is what we're seeing today. Industrials are making a little bit move higher. Technology is lagging. Fed decision 2 p.m. Eastern, and then, of course, the news conference at 2:30. We'll be all over it.
Yeah, indeed. Some of the materials are working. Industrials, Caterpillar, one of the best performing down names this morning. Deere is reversing after that downgrade yesterday. Again, I think your attention is going to be drawn to the dots.
The dots and the tone from Chair Powell. And the dots are important because they will set a tone of how hawkish the Fed is feeling. Do they still expect to hike again? That's the dots, the forecast for where rates go this year. Are they still building in another hike by the end of this year? And how many cuts are they really looking at into next year? Last time it was 100 basis points of cuts. Will they narrow that a little bit? And will that be a signal for the markets?
Yeah, be curious to know what their views on unemployment are going into
and growth
in 24. Yeah, as well. Interesting afternoon on tap. West Coast Wapner at one market. Let's get to the half.
Carl, thank you very much, and welcome to the Halftime Report. I'm Scott Wapner, as Carl said, live today from San Francisco. Front and center this hour, decision day and beyond. The investment committee making some key moves today ahead of that Fed decision. Now they'll debate where your money goes from here, no matter what happens in a couple of hours. Joining me today, Joe Terranova, Stephanie Link, Shannon Sakosha, and right here on set with me in San Francisco is Liz Young, SoFi, of course. Let's check the markets. We are in the green, at least for the Dow and the S&P. NASDAQ was. It has, though, turned into the red, as you see. We're watching yields, obviously, today. 10-year, 432. Oil was a big story. It did pull back. It's higher, though, again, as we come on the air here, 12 noon in the East. All right, Liz, here we go. Judgment Day.
Yeah.
See what the Fed says. Not necessarily what
Hey!
it does, and what you all do based on what they say.
Nikki Benz.
Right. Well, every time we do this, we say it's the most important one since last time.
It's my girl. Hold up.
A decent position.
She's been missing for a little bit
because the calendar is sort of giving them
I was getting
a
worried
favor
about
in
her.
the
She's
sense
got a
that
little
they had
tan.
a built-in pause in August. They could wait and
She was
see
out
what
in
the
LA
data
for a
said.
little bit.
They've got another built-in pause coming in October. They can wait and see what the data says. Right now, the data does
She's my
not
kind of girl.
justify a
Somebody's
move,
actually got a brain
either up nor down.
and
It just
a
sort
profession.
of lets them stay on pause.
And is
As
smart.
of this morning, the market says there is a 0% chance of them hiking. So
Actually has-
I don't
has
expect
a
that we're going to get any
responsibility.
big surprises today. But what I do think we're setting
Right
up
there.
for is that a 0% chance today and then only a 45% chance in November is really suggesting that they're done. So if they start to come out and, number one, have dissension among members that say, I think we should keep hiking, I think we should stop, that's going to confuse markets. And if they come out and continue to be really, really hawkish when the market thinks they're done, then we start to see volatility.
Yeah, you mentioned 50-50 basically for November and December. If
You're
they're gonna hike
forgetting,
again
Liz,
this
the
year.
balance
Stephanie
sheet.
Link, I think the words you're going to
You're
hear
forgetting,
often
Liz.
today from the analysts who come
Oh,
on
they
our
got
air
all the
around
women
the
on
Fed higher for
CNBC
longer.
today.
And if that is the
Liz
case,
seems
if it's
angry.
going to be
She seems
higher
mad
for longer,
today.
what does that mean for the strategy
Something's
that you'd
going on.
employ in the market?
Well, I think we've been saying it's going to be higher for longer, or is it just high for longer? Either way, as Liz just mentioned, I've been saying you're in the 9th inning in terms of this cycle, this tightening cycle. But that being said, don't forget that QT is still happening as well in a very aggressive fashion. And so that will be restrictive in addition to these higher interest rates. So to me, though, I step back, Scott, and I say, you know, the economy so far, we've been able to handle higher interest rates. The consumer has been really impressive and goes back to jobs and to wages and to even retail sales from last week. How about housing? There are puts and takes within housing, but new home sales are up 31.5%. That speaks to demand from the consumer.
This might be our bottom
Even
here.
Permits yesterday.
We might start
Single-family housing
turning
starts
it up.
were also up. So there
May
are
try to get
pockets of
back
the
up
economy
here.
that are doing well. Manufacturing, we've talked about, because of the $2 trillion in infrastructure spend, the bills that have been passed, that's helping onshoring and that theme. Agriculture is doing fine. Anything tied to aviation is fine. So adding it all up, you're at above trend GDP, and that is leading to above trend inflation. And I just think that maybe they don't go today or in November. They're still battling with a core PCE at 4.2%, and they want that to be 2. So you ask what I'm doing. I'm not really changing. I do like the my style. I kind of like the fact that the economy and the strength in the economy has led to less bad earnings. I think earnings are going to recover throughout the rest of this year and into next year. And we have seen a broadening out in the marketplace. We've been talking about this for months now. So I have had that broadening tilt to the diversification within my portfolio. I'm overweight energy. I'm overweight industrials. I even liked what some of the financial services companies have said at the Barclays conference in terms of better net interest income, better demand. Oh, by the way, better consumer demand from Bank of America today. So no change in my strategy.
I'm going to go get ready for this Fed meeting. So we're going to have FOMC live right here.
Well, you've made a big
We're going to run through the
as well in your book that we're going to get to in
FOMC,
just a
summary
minute,
of
so don't do
economic
it yet.
projections.
But Joe, you know, to some, it's not so much what the Fed does
like
from
that.
here, it's what they've already done and the impact that is yet to have on the economy and then eventually the stock market. That's what Wolf is talking about. Now, Wolf has been skewed negative for a while, so just put that as a caveat. But they say the next leg down is to be driven by the lagging impact of past rate hikes, the old lag effect of what, you know, Chair Powell has talked about, what many have talked about since the Fed has done, you know, this 525 basis points in 14, 15 months or so, 11 hikes in all, and what it's all still going to mean, Joe.
Well, I think, first of all, that's speaking exactly towards what energy prices will do to the consumer over the coming months, and that is it's going to weaken spending, and I expect that the economy is going to weaken. You know, people are focused on oil prices moving higher and the inflationary effect of that. I think the real effect is going to be that consumer spending is going to weaken. So, you know, I think about today, 10 years ago, my son was stepping on the ice to play hockey. I told him, if you don't move your feet and work hard, I'm not going to let you continue to play the sport. 10 years later, he's still playing the sport, and I'm telling them the same thing. So I think you're going to get that threat, but you're not going to get the actual promise. I think the Federal Reserve has to be hawkish, but I think they're remaining on hold. And I don't think they're going to go in November. And the reason I don't think they're going to go in November is because I do see a weakening economy. I do see a UAW strike that's going to create a little bit of friction for them. And then you also have the potential for an October government shutdown, a low probability, but it is still there, Scott. So I think the Federal Reserve is basically done. You're going to get a lot of talking that's
They're
tough,
not done,
but
guys.
I think they're going to sit back.
They might be done
and I
on
think they should
rates.
just focus on continuing
They ain't
to
done with
unwind the balance sheet,
liquidity.
which they've actually done a pretty
There
good
you
job
go.
of taking
He's
off
talking about it now.
over $1 trillion, taking the Fed's balance sheet back to where it was in July of 2021.
Yeah, they have been
So,
doing
Shan,
pretty
you know,
well at that.
I'm going to come to you in just a second, though. I want to get to Steve Leisman, our senior economics reporter, because he's got a hard deadline here because he has to get obviously ready for the events of today. Our senior economics reporter joining us now from D.C. Steve, it's good to see you. You know, it's pretty striking to me, actually. Joe says they're done. I heard 2 or 3 guests within the last hour and a half or so that I've been watching the coverage suggest
As
Fed's
long
not
as the
doing
data
anything more
supports
from
it
here in
for them
terms
to
of
be done.
hikes.
That's
The question
it.
is, are they going to be surprised?
So what kind
by
of
anything
question is
might
that?
happen
Are they
today?
done?
Well, I think the story is well grasped by the people around the table there. And being done doesn't mean being easy. And I want to put a little nuance on what Liz Young was talking about and what you guys were talking about the immediate future and the extended future for the Federal Reserve. First thing is just look at the probabilities of future rate hikes. And what you see there is 30% chance for November. And they've transferred a little bit of that angst for a rate hike into December now, a 40% chance. And there's that first cut built in, but just barely, with a 43% probability, just barely outweighs the possibility of the Fed on hold. Now, let's look at the next thing and talk about what you were just saying,
That's
Scott,
this right here, guys. Let's go to the November and December contracts he's talking about.
Hikes.
So,
this is
got a
the
70%,
change in the yield
28% for
of the
a
Fed
raise
futures
December.
contract since May, which
Right.
was a low. Can you see how much incredible tightening has been added to the economy? This has gone along with several things: massive issuance from the Treasury, better economic growth, as well as more rate hikes from the Federal Reserve.
I'm going to
and, of
get
course,
ready
those
for this.
rise in Treasury yields that's happened over time. The idea is that a lot of restrictiveness has really
Sounds
just
like-
hit the economy. So when you think about the Fed, will they not hike? Are they done? Yes, they may be done here, but the idea of the Fed being easy is still a long way off, Scott, and much less
in other words,
out there than it was.
Yeah, in other words, you're underscoring what we said at the outset, too, this notion of higher for longer. The question I have for you, though,
Can I just amend that, Scott? I think it's much higher for far longer.
Much longer, yeah.
For far
Well
longer.
said.
That's my new thing.
Yeah, I love what you said, by the way, and I think that's going to be something that we're going to be talking about for some time. Being done doesn't mean being easy.
Right.
I thought that was extraordinarily well said. The question on oil prices, I'm wondering how that factors into what the Fed's thinking about not only the impact on the economy, but impacting inflation. Oil was $78, Steve, which we looked on the last Fed decision day. So it's up 15%, a little bit more than that since then. What are your thoughts there?
It's a Canaan oil drum, Scott, is what it is. The idea being that the Fed has to not finance or monetize this rise in rates, rise in oil prices. But the rise in oil prices has nothing to do with what the Fed is doing, and is nothing that it's going to do that's going to bring supply back onto the market to bring it back down. All it can do is really remain restrictive in the face of this. One of the mistakes
that doesn't make
that
any
was thought
sense.
to have been made in the 1970s was the Fed essentially monetizing, as in not being restrictive enough in the face of that high oil price. Now, there is a difference this time, Scott, that we need to think about, which is the idea that so much more of production in the United States, of our oil consumption, is from our own domestic production. In the week of September 1, we hit a new record for U.S. oil production at 13.7 million barrels a day. The ratio of domestic production to imports is among the lowest it's ever been. So more of that money stays here. Dividends, I guess, to the holders of oil stocks. That's a big part of it. Perhaps more investment. So there is something of a payback to the United States for our large oil production. But ultimately, for low and middle income consumers, it's going to be a tax that will hurt. But also, it'll drive up those inflation numbers and do more to keep the Fed from cutting than it otherwise would have.
Yeah, all good points. Steve, thank you. I'll see you on the backside of the Powell news conference later when we speak with Jeffrey Gundlach and you join that conversation. We look forward to that, our senior economics reporter, Steve Leisman. So I guess, Shannon, the way I'd come to you on this now is, do you think investors are fully understanding what Steve Leisman just said, that being done doesn't mean being easy?
No, I would say based on the multiple expansion we've experienced this year, Scott, particularly in certain parts of the market, they're not. I think an important point is that coming into this year, many folks were concerned about the potential for declining demand. And we really haven't seen that in terms of the consumer. And we really haven't seen that on the corporate side either. We continue to see investment. Enterprise spend has been stronger than expected in the technology sector, for instance. But what we are facing is on the supply side, the liquidity side, the credit side. We're starting to see those delinquencies tick up in consumer credit cards. We understand that much of the debt for corporations, particularly high-quality corporations, investment-grade issuers, they've termed out their debt, and so they're not facing necessarily a refinancing wall in the next couple of quarters, but eventually those higher costs will come home to roost. And I think the challenge here is, as we go into 2024, is there an inflection point where the consumer no longer has that supply? Look at financial conditions. They're really not that tight. So as restrictive as the Fed has attempted to be, there have been other factors that have managed to impress upon financial conditions and keep them slightly looser or significantly looser at certain periods than the Fed would like to see. And so I think looking at 2024, if you look at kind of June, July of next year, we're pricing in, rate cuts in the market over 50% probability. That would really only occur if we saw a sharp contraction in the economy. The Fed has given themselves some buffer to be more accommodative by the fact that they've raised rates so significantly in this short period of time. However, if you're factoring that in and you're basing your valuations as justified on the expectation for those rate cuts, I have to agree with Steve. I think higher for longer and longer through perhaps into 2025.
Yeah. So I've got, conflicting calls, I suppose you want to call them today. Erin Brown, PIMCO, she's a frequent guest on shows on this network. She said a recession, higher oil prices could drive the S&P 500 down roughly 15%, while Bank of America's Savita Subramanian says, don't worry, be happy. That's the direct quote from her note. She raises her year-end target to 4,600, and that's from 4,300. So we are in the S&P, but at least a view that we can continue to go higher from here. So I mentioned some moves at the very outset here. Stephanie Link, let's get to yours. It's a big one. You sold Home Depot. Why?
Yeah, I mean, it's flat on the year. It's actually up 18% in the past year, so I've made some money on it. But and I still like this story very long term. You're going to see low single-digit comps. You'll see mid-single-digit earnings. Upside to margins. However, you're not going to get paid for it if rates stay higher for longer, especially between now and the end of the year, Scott. If you've got like a 3 to 5 year time horizon, I think this is just fine. But I prefer TJX, and that's where actually I have been putting more money to work because I think that off price is in the sweet spot, right? You have trade down, you have excess inventories in the industry that benefits the off pricers. You have the treasure hunt that people like. They like that experience. They have a long-term algo of 2 to 3% in same-store sales and margin expansion. Last quarter, they grew 6% in same-store sales and margins expanded over 254 basis points. So I think that they have just, in addition to easy comps, they just have the wind at their backs at this point in time. I just think that, again, short-term, I'm not going to get paid to own anything housing related, even though the housing data that I cited earlier is not all terrible.
Yeah, but I thought that the whole reason to be in a Home Depot or a Lowe's was because with mortgage rates north of 7%, you're not going to move, but you're going to improve. And that will be ultimately beneficial to stocks like this, even though, as you rightfully point out, it's done absolutely nothing year to date.
Yeah, I don't think you're going to get paid. I don't think you're going to get the multiple. It's trading at 21 times forward estimates. Even if estimates go higher, multiple probably comes down because rates are higher. So the point is it's between now and the end of the year, I am trying to find stocks that I think are really going to outperform. I just don't think that Home Depot is going to outperform in the near term. Long term, really like it a lot, though.
Got you. The other interesting move we have on the committee today is from Joe. As the NASDAQ goes negative late morning, comm services and tech are weaker today. You teased us, I guess, Joe, the other day that you were going to buy the Qs, and in fact, you did. Why was now the right time to do that?
Yeah. Well, I don't know if right now is the right exact time. That's getting into market timing, and if I'm going to say that I'm going to be a market timer, I'm going to be wrong. But I believe
I know, but you know what I mean. I'm not talking about 30 seconds from now. I'm talking about why did you do it now?
Nope. Well, the setup into the fourth quarter is one in which, when I look at my portfolio, I am basically underweight towards where the outperformance has been so far year to date, which is in the mega cap names. And I truly believe if we are going to see a fourth quarter rally into the end of the year, which I have a much higher probability of that occurring than the market actually reversing and going lower, I think it's going to be led by those mega caps. And that's the risk inherent to my portfolio where I just don't have that exposure. And what's interesting is if you look at positioning, let's take Apple as an example. Apple 4 months ago had institutional ownership of 71%. The institutional ownership today in Apple is only 63%. The institutional ownership of Apple in October of 2022, when we saw the S&P below 3,500, was 61%. So I believe positioning has certainly been reduced over the last 4 months. I believe that when I look at my position, I know where my exposure is. My exposure is is that all year I've underperformed because I'm equally weighted. And these market cap behemoths are outperforming. And I think that's going to be the case going through the fourth quarter. So buying some Qs. And by the way, on any further weakness, I'm going to add to the position in the Qs because I'm building the position for what I believe is going to be a fourth quarter rally. Not because I believe 2024 is going to be a good year. It's just for a trade at the end of the year.
I got you. The question, Liz, is much higher for far longer, as Leisman coined as well. Is that going to be good for tech? Even, mega cap names, if we do have elevated rates for far longer than we think?
The short answer to that, in my opinion, is no, but the market hasn't really priced that in yet. So I think if through the end of the year technicals drive prices and we continue with the momentum where mega cap leads and we are decidedly late cycle and large caps should lead in that particular environment, then Joe will probably have a trade that pays off. If we have some kind of event or some kind of credit deterioration, a pullback in consumer spending, or other announcements by companies that lead
then we getting paid, bruh. The rest of that TLT trade
in 2024, then I think that tech and consumer discretionary and communications do have to sort of get with the program that capital is restricted, capital is more expensive, and these valuations aren't really justified. So I'm 50-50 on that choice right now. I think that there's a chance that technicals lead us through this, but I also think that we are right in the moment where these lag effects and some of the things about capital restriction start to affect valuations and start to affect the economy.
Well, speaking of capital, we're thinking a lot about the capital markets these days, aren't we? Because the IPO window seemingly has been cracked open. And we're waiting on another one, the first trade today from Klaviyo. That company will begin trading shortly, we think. Deirdre Bosa here, of course, with us, who's been following all things IPOs for us. I mean, there is optimism.
Look at Tesla. Look at Tesla trending. This is a reverse cup and handle? Is that what we got?
Yeah. We're waiting that first
Look how the trend is low in volume on the handle. This is a reverse now.
Another pop, right? This would be the third.
This is it. It's got to turn itself around. It's got to curl itself down now. Come on. No, come back. Come back, come back, come back.
Instacart's
Come on.
down, what, nearly 5% today after, a huge pop yesterday.
It's got to sell off right here.
IPO. So yeah, there's appetite. Supply for IPOs has been low. What we're figuring out now is demand.
Maybe I'm
especially
wrong.
From retail investors, these floats are small.
Small, right?
Exactly. So we have to see how sustainable
No, it would have
is.
been right
and
here.
if they're already falling, what's going to happen
It's
when
not.
we get to the
It's just
lockup
not there.
expiration, right? And in the case of Instacart, employees are going to be able
That's
to
so
sell
weird. Look
even
at that.
sooner. So when you look at it, I don't think it's clear yet. The window has cracked open. Is it going to stay open? I think that Klaviyo is going to be a better indication of that because this is an enterprise software company. There's a lot more enterprise software companies waiting in the wings as IPO candidates than there are consumer-facing, gig economy apps, even chip makers. So this is going to be really important, and it could be different. This is a company that still has, big top-line growth of more than 50%. Profitability isn't quite there in the way that, ARM and Instacart actually was. So we'll see, but it'll be another important signal.
A lot of questions about valuations, where they are, down rounds, et cetera, when you talk about, Instacart and things like that, where valuations used to be. You suggest that there are still a lot of companies out there that have yet to take their medicine.
Exactly. That's key. They have not taken their medicine. Instacart did, right? They valued themselves. They lowered that. They took that down round internally, and then they did it through an IPO. Klaviyo actually was willing to do that as well. It may actually open higher than that $9.5 billion they were valued at in 2022. That would be an important indication. But you look at the biggest unicorns out there, and some of the valuations, you think there's no way. Stripe actually is one that has taken their medicine. It was valued at, I think, around $100 billion, now $50 billion, but the others have not. Chime was valued at $25 billion years ago. This is a fintech company, consumer-facing financial services app, and you just think of what's happened in the public markets. That disparity is so great. There's no way they're going to go public at a $25 billion. They probably know this, and a lot of the companies on this list as well, a GoPuff, a Discord, a Brex, an Airtable. The public markets have changed, and we know that private markets are lagging. That's fine, but if they want to go public, if they want to raise more money, they may have to take that down round. What we're seeing in the question now that's being asked, is a down round such a terrible thing? Yes, maybe for the VCs that lost money on the Instacart IPO.
Maybe not for the markets themselves.
Exactly,
right?
and it gives them liquidity.
And a bit of a reality check of sort of where we are versus where we were. Bob Pisani made a good point earlier of this, and you underscored it here too, the first day versus the after days. And what was a pop turns into a drop in some of these cases. We'll see what happens with Klaviyo. Dee, thanks.
Thanks.
That's Deirdre Bosa. All right, up next, Double Dow stock coverage in our calls of the day today. The trades on Nike and Boeing are straight ahead. They're movers today. We're back from One Market in San Francisco in just 2
Shit,
minutes.
I'm sitting here talking. You guys can't hear me. That looks like an island reversal, doesn't it? Right here. Come up, gap it down, pull back, gap up, pull back, go in for the long. Apple about to have a bad day, guys. Apple is about to have a bad day. I haven't looked at Goldman Sachs in quite some time either. Let's see here. GS. Yeah, hopefully Liz is okay. I feel like something's going on with her. Hopefully her mom's okay. Like something. Hopefully everything's okay. She's definitely got something bugging her. I mean, I could be wrong. I don't know her like that. It's all an assumption. But yeah, like I said, I'm gonna go get ready. I kind of was just looking at the markets. We'll have an hour, so I'm gonna repost this stream on Twitter. See if we can get a couple people in here to join us. And I'm gonna go through and get all the Fed stuff ready.
Go to fabletters.com.
All right, welcome back to the Halftime Report. We're live today from One Market out in San Francisco. Our calls of the day, 2 Dow stocks are in focus. We're going to start with Nike. Take a look at the stock. It's barely getting a lift today. It's coming off its 3rd straight day of losses. It's the 2nd worst Dow stock year to date. It's the 3rd worst Dow stock month to date, and it's below its 250-day moving averages. Stephanie Link, you want me to stop yet or keep going on this?
Nothing's new. The stock's down 18% year to date, so I think it's reflecting a lot of these bad things out there.
Unless you think it's going to get worse, and I think there are some suggestions, around the way that it might in fact get worse, both from a narrative standpoint. Here's what they say, by the way, in the note. We're removing, this is Morgan Stanley. They removed their position in Nike. They say they're removing it due to execution and industry headwinds that are likely to weigh on top line and margin trajectories. That sounds like a prediction that things are going to get worse before they get better for this stock.
Really, look, the macro is definitely challenging around the world, but the stock is down 18% year to date, and it actually trades at about 24 times forward, which is at the low end. Its 10-year average is 28 times forward. Why does it have a premium, and why should it have a premium? Because this is world-class company. They're the #1 brand in China. Michael Jordan, that brand is growing at 35% constant currency on a consistent basis. They're doing more DTC business, which is margin accretive. I think this company over time has earnings power of something like $650 by fiscal 26. And that's going to be because they actually get EBIT margins to the high teens from 11% today. And how are they going to do it? Lower freight costs, FX, inventory reductions, lower input costs, all those things have been massive headwinds for Nike, and I think that's going to turn it around. And in addition, I think the demand still will stay strong, and I just feel like this is blue chip on sale. It trades at a discount to Lulu. Lulu's at 35 times. I get it, it's a little bit faster growth, but I think that Nike is just, again, world-class, good balance sheet, and I don't think they have execution problems at all.
All right, Joe. Do you want to counter that? Because, you know, this is my bet. This is not you saying it, and I know you're restricted in terms of what you can say. My bet is that when you rebalance your Joe T ETF, that Nike it finds its way in the trash bin. But you speak on it because you said recently something that leads me to believe you disagree with Stephanie Link.
All right, so first of all, Stephanie is defining a fundamental outlook into the future that's positive for Nike. And I don't disagree with that at all. But I do believe that 2023 is a year about technicals, it's about momentum, and it's about positioning. I think fundamentals really don't sit at the top of the factor chart for 2023. And I think that what the entry, first of all, for us into Nike came in April. Why did we enter Nike? And I know, you know, my approach to the market is different than Stephanie, but we got caught up in the technical momentum where the stock rallied from below 85 in October of 2022 all the way above 120. This is a strong company, but it was on the technicals that we got into the stock. And the technicals have deteriorated. They're going to report earnings on September 28th, and I don't see how they're going to be able to reverse it that quickly. There are challenges as it relates to China. We know that. It appears to be troughing. But that trough is not going to reward you, I don't think, as an investor until the coming quarters. And we mentioned Lululemon. And Lululemon is a fair alternative. I had this discussion with Steve Weiss on Monday, and Steve said you can't compare it. I don't know how you can't compare it, because if you're a shopper, you're looking at Nike and you're looking at Lululemon. And if you're a portfolio manager, you look back 5 years and you see Lululemon up 155% and Nike only up 20%. You look back the last 3 years, Lulu's up 33%, Nike's up 15%. I could keep going on with the outperformance of Lululemon. So Lululemon
year to date, or even 1 year, is 19% Lululemon. I mean, I know they're talking about this, but do you guys understand that CCL is up
We're long the stock. On September 28th, I hope
100
Steph's right.
and some percent on the year?
Fundamental positive outlook that she sees in the future, it comes to reality today. But I'm skeptical that that's going to occur, and we'll see what we do at the end of October.
Yeah, I mean, Steph, this note
That's
today, they cite
insane.
margin headwinds from excessive inventory might persist longer. So this seems to be far more than a technical story, like the one that Joe sort of lays out. And look, to be frank, I'm not sure that Nike and Lulu are the greatest comparisons, and whether it's apples and oranges. To me, it's an easy comparison to make for not so obvious reasons. And I don't necessarily think that it's Nike and Lulu in the same basket. Nike has its
a lot
own
of
issues.
volatility there.
It's a big portion, as you said, from China, which is much weaker than I think people had any idea that it would be as we sit here on September 20th of 2023 in the recovery. So I don't know that the Nike story gets better anytime soon. Lulu, to me, is its own thing. It caters to a different customer with a different kind of product, period.
So China is 13% of total revenues, and last week we actually saw some green shoots from China in terms of industrial production.
Guys,
and
look
retail
how green. I
sales
told
that
us
were
that,
double
right? Didn't I say watch and see how green we are?
From prior months. So I think China is going to recover. It's taking slower than expected, no question. But I think the consumer and the pent-up demand from the consumer is actually going to be a positive going forward. So that's number one. Number two, they do have the number one market share around the world in footwear. There's no question about it, a 78% market share. Number 3, the margin story. Yeah, the margins have been getting they've been hit hard.
We
and
might
a
go
lot of
red.
that is inventories. I'm
Right?
not
What
gonna
did I
say
say
that, though,
yesterday?
that Nike is the only
Remember, we
company
seen
that
the
has
shift. Everything was
inventory
this
issues.
color going
Everybody
to
has
light,
inventory
you know,
issues,
the
and
dark
those numbers
green
have
and the
been coming
bright
down
green and
pretty quickly.
red,
And
dark
as that
green, and
happens,
let's see the
Scott,
shift.
margins will improve, and freight costs have been a very big headwind for them. That's going to improve as those prices come down. So, by the way, they also have pricing power. So I get what you're saying. It's not been a good stock, right, year to date. But I do think it's going to be a good stock going forward if I have a 12-month time horizon. And I think that the multiple has come down and it has derated enough that the expectations are low enough that maybe they don't have to put up a great number on the 28th. Maybe it's just in line and they're just going to make progress on inventories. And I think the stock probably would bounce on that.
Joe, lastly to you, because I agreed with Weiss, to be honest with you, on the argument that you guys had the other day. Nike's a footwear company. First, second, and third. Lulu is
She's
like
always
a
laughing, bro. Like,
specialty
she's always
fitness
like
apparel and
chinka. She's
lifestyle
always
company.
stoned.
I don't know why we compare
She's
the
always
two.
like getting ready to burst out laughing.
Well,
Look
I'm
at her.
just gonna, I'm sorry. I'm just
And
gonna
she knows
completely
it.
disagree with you. I think,
trying to
yes,
hold
they're
it
a
in.
footwear company. Lululemon is also a footwear company. They
They're
both
not
are
a footwear
emphasizing
company.
direct to consumer.
They're not a footwear company. They sell shoes. They're not a footwear company.
All right, we disagree on that. And
Okay.
you know, as I said before, as a portfolio manager, when you think about apparel, you think about what your potential opportunities are for ownership. And to me, it's Nike, it's Lulu, it's Adidas, maybe it's Puma as well. I'm not so sure about that. I just, you know, I'm sorry. I just disagree with you.
Okay. To be continued, I suppose. Contessa Brewer has the headlines for us. Hi, Contessa.
Hey there, Scott. President Biden and Israeli Prime Minister Benjamin Netanyahu met in New York today on the sidelines of the UN General Assembly. It's their first meeting since Netanyahu returned to power in December, and they both expressed a desire to ease tension in their relationship, discuss their differences, including President Biden's opposition to the Prime Minister's plan to overhaul the judicial system in Israel. The leaders also committed to work toward diplomatic relations between Israel and Saudi Arabia. West Point is being sued allegedly for considering race and ethnicity in admissions in the wake of the affirmative action Supreme Court ruling. Students for Fair Admissions launched a federal lawsuit against the military academy for setting benchmarks for how many Black, Hispanic, and Asian cadets are in each class. The academy did not comment on that litigation. And
Isn't that what they
California water
want? They
regulators
want to
are
get more
blocking
people of
Arrowhead from
race and
bottling
color
San
in
Bernardino mountain spring
to like
water.
equal things
The
out.
board determined
Everybody's
the
just
company has been
equal pay, equal,
unlawfully taking
equal,
water from the
motherfucker.
springs without valid rights. The controversy
I'm
first
not gonna get
erupted in
started.
2015
I apologize.
when an
I
investigation
apologize. I'm
by
gonna go
Palm
back to what I
Springs
was doing.
newspaper, The Desert Sun, revealed the company was siphoning water without a permit that expired in 1988. Here we are 8 years later, Scott, and now they're just saying, no, you can't take it.
Yeah. Contessa, thank you. Appreciate that. That's Contessa Brewer. Coming up, new exclusive reporting today on Apple's plans to move into retail stock trading. Our own Kate Rooney broke the story. She's here at One Market. She joins me next.
Let's go, Spy. Let's go.
All right, welcome back to halftime today. From One Market in San Francisco, we have new reporting from our very own Kate Rooney on Apple's potential move into retail stock trading. Kate's here sitting next to me. What do we know here? This is an interesting story that you broke.
Yeah, so Scott, thank you. It's great to be here with you guys, by the way, and have you on set and be here at One Market. So this really happened, Scott, in the heyday of the Apple-Goldman partnership. When the credit card was launching, they were talking about launching a stock trading feature on the app. So within Apple, you could think of it in the same way as Apple Pay. The idea, based on sources we were talking to that were inside the room during these negotiations, they talked about this just being a feature. You could, use your extra cash on Apple to go and buy stocks. This is 2020. By the time it was set to launch, 2022, the markets had turned. So the people we spoke to and sources who were familiar with this said they got cold feet and essentially didn't want people to have losses. They didn't want the backlash of users saying, hey, we used Apple to buy stocks and now we're down 50%. So they said, scrap it, we're going into high yield savings. And that actually turned out to be a pretty good pivot for them because interest rates helped that product versus we've seen what happened to stocks at the time.
There are a couple of things here. Number one, sort of Apple's aspirations about where they see part of the future of their business going from a services standpoint, the kind of relationship they want to have, but also a sign of Goldman, too, on how their own retail operations and aspirations have just changed over the years.
Interesting. It does speak to both points. I think on the Apple side, it does speak to their ambitions in finance. It was part of this broader product. But you had the Apple Card launch with a lot of fanfare back in 2019. They've got buy now, pay later. This was seen based on what sources have told us. And by the way, I should mention, Hugh Sun was also a reporter on the story, so teamed up with him on this. But we were talking to people who said that inside the room, they were talking about this as just one of the many products that they could launch. So there was a lot of excitement between that Apple and Goldman relationship. We've seen what happened since Goldman has essentially retrenched from their consumer banking efforts. It also speaks to some of the blurred lines between tech and finance. You've got Twitter, or X at this point, also getting into stock trading, and a lot of the hype around retail trading. So it was at a time when they were probably looking at Robinhood saying, why don't we just launch stock trading? It's the hottest thing. You saw the markets going up, and that was during that retail trading renaissance that Apple looked at it and said, that looks easy.
If you look, there are many arcs to look at. The arc of where, let's say, Robinhood was trading in 2020 versus where it trades today. I don't remember what the peak was in 20, but it's certainly not even close to that in 23. So it all depends on, that was a moment in time that maybe, some companies got caught up in thinking about, it lasting longer than it obviously did.
And in the context of Robinhood, they have now moved into things like retirement funds. But if it's something that Apple can just launch as a feature, it begs the question of, is trading a company? Is it enough to sustain a company on? Or is it just a feature? And Apple just casually getting into this area and retail trading kind of suggests that they do need.
You got something here with DTOC, guys. DTOC.
In the meantime, they've added retirement funds and high yield savings, the same way that Apple has. But
it is up
another sign that big tech
right
is moving into finance, and they really want to be the one-stop shop for everything.
They want a piece of the pie.
Yeah, exactly.
Great reporting to you and Hugh, and thanks for being here.
Yeah, good to see you.
That's Kate Rooney on set with us. Up next, Mike Santoli. He'll join us from the New York Stock Exchange with his midday word. We are back. Look at the Dow. It's up 200.
It's got the volume to
less than a couple
support it,
hours from
guys.
the Fed decision, and then the news conference. And that's what the market's doing at this moment. Dow's good for a little more than 200. Back after this.
One more hour. Excuse me. There's Clavio, whatever, opened up. Just IPOs out the wazoo, right?
Hi, guys. Clavio has opened $36.75, 19.2 million shares. Offering price, of course, $30. Remember, just a few days ago, we were talking about 25 to 27, then upsized to 27 to 29. So here we are, $36.75. Let me just get in John Tuttle over here. John, how are you? John Tuttle, Vice Chairman here at the New York Stock Exchange. Everybody wants to know, what's this a sign of? Is the IPO market actually opening up? We've had 3 IPOs. They've all priced towards the high end of their range and even above. What's going on?
Well, we sure hope so, Bob. I mean, this is a great opening for our market here with Clavio. You know, pricing last night at $30 a share. First trade here at $36.75, and the market staying strong there. Still drifting upward as well. A lot of companies are going to be watching the performance of this company. Enterprise software company. A lot of support. A lot of good investors there, and hopefully this gives us a strong Q4 this year.
It's been said there's 800 tech unicorns that are sitting out there waiting to go public, a long backlog, a 2-year drought that we've seen, and yet investors make it very clear they want profitability and they generally want lower valuations. We certainly saw that with Instacart as well. Are there enough companies to meet that kind of criteria? Are we actually going to see companies really going public with those kinds of investor needs?
We are going to see those in Q4, and they're going to come from a wide sector of the economy, not just tech, which market has been reopening with an opening like Clavio here, but also we're seeing companies from across sectors, whether it be industrial, transportation, logistics related. We're excited about Q4. We're even more excited about 2024.
Okay, you saw it, Scott. 36.75 open, trading 36.35. Clavio open, Scott. Back to you.
Yep, Bob, thank you. Nice pop there. We'll see what that trade does over the remainder of the session. Mike Santoli, our senior markets commentator, is joining us now for his midday word. So let's move beyond the IPO and look ahead to the Fed. I thought there were 2 Leismanisms, if you will, today that give us food for thought. The idea of much higher for far longer, Mike, and whether the markets and investors at large fully understand that.
Yeah, I don't know about much higher. I do think that, higher than we've gotten used to, higher than what the Fed, even on paper, says is the long-term neutral or expected normal rate. I think we've tried to internalize that. Market has had to catch up a few different times. The long end of the curve seems like it's more or less there. If you look at the 2-year note yield, we're above 5%. That does suggest there's going to be a little bit of a slower descent in rates than we've had on the way up. All that being said, I feel like the Fed's in a pretty good spot right here. They're close to their destination. If the debate today is all about, what's the shape of the pace of eventual cutting of rates from the peak level, that's not a bad discussion to be having. It suggests, at least, as long as that persists, that a decent benign economic landing is at least in the set of probabilities the Fed is facing.
Yeah, the other one being, what Leisman said, quote, being done doesn't mean being easy.
Right.
I mean, that all factors in to how we think about what the market may do relative to where rates may go.
Look, to a degree it does, but again, when you get past a couple of 3 months, I don't think the Fed funds futures have a lot of conviction behind what they're saying about where rates are going to go. I also don't think the stock market is on pins and needles needing and wanting that rate cut for it to perform. Okay, the S&P 500 is higher today than it was before the Fed started raising rates in March of last year. We're up 200 basis points from October when the market bottomed. Clearly, under the right conditions,
This might be it for Pinterest. This might be where it starts going higher, guys.
Kind of equilibrium point is.
I think it starts catching a bid here.
Yeah, we'll see you after the decision on closing bell. Look forward to that, Mike Santoli. Yep. Thank you very much. Coming up, we have our other call of the day on Boeing. Industrials having an interesting day, a good one at that. We'll talk about that and some of the other stocks on the move today when we come back.
Pay off. This Red Bull really just started making me tired out of nowhere. Again, I've only got a few hours of sleep, like literally like 2 or 3. So naturally I'm going to be tired, but I'll be alright. We're going to get through it.
meets opportunity.
All right, let's get to the second half of our Dow double play. As we mentioned earlier, Boeing today. So Stephanie Link, they reiterate it as
Oh, they're talking about
outperformed,
Boeing.
but wow,
This thing's
they're
just
looking for 34%
gotten
upside to
clobbered.
their price target, which they bumped. You see it at 204. They think it's going to 274. Buy the dip. Should you?
Well, I own it, and yeah, I would buy the dip. I think the Spirit issues, supply issues are short-term, and they're a short-term headwind for sure. But the demand in the industry is far exceeding supply. Boeing themselves have actually 4,971 planes in backlog. If you add Airbus's backlog, you have 12,000 planes in backlog for this industry. So the demand is absolutely there. In terms of China, and I know people are concerned about China and China relations with the U.S., they don't need China orders to make the 25-26 delivery targets. So I think that the China news or the concern is overdone. That being said, China will be a big positive to free cash flow once they get the 85 planes out of storage in China. That's $2 billion for free cash flow for Boeing. So look, I think the concerns are overdone. You have to be patient with this stock. You have headline news and headline risk, but long term, the fundamentals are really pretty outstanding.
Liz, what about industrials here as we talk about sectors that may do well over the final stretch of 2023?
Well, I mean, third best sector in the index today, right? And I think that's mostly about the market still pricing in and hoping for a soft landing, and that seems to be the consensus call. So industrials would be a likely beneficiary of that. I don't think that that's necessarily the right place to stay or wait.
15th. So if you're out in London, Amsterdam, Zurich, Milan, reach out. You can do that via our website. Otherwise, we'll be in Austin for RMC, where I will be speaking as well. So feel free to reach out. That's October 17th to 20th. Otherwise, kaivolatility.com/news. Reach out if you want to get some of our updates.
Absolutely do that, folks. Thanks for coming as always, Jim. Next, we've got Bob Elliott, the CIO at Unlimited Fund, former IC at Bridgewater, and the all-time leader in useful Twitter threads during a banking crisis. He's a friend of the spaces, so let's give him a warm welcome. How are you doing?
Hey, thanks for having me. Really appreciate it.
Oh,
Hold
sorry
on
about
second,
that. Had
buddy.
a little struggle with the microphone
there's
there.
News going on. I
It's
can't
great
see
to,
your
great to
comment.
be on here. I feel like Joseph and I are
The
following
police
each other
and the
around.
politics. No, I'm just playing.
We did the same media
But
show
seriously.
yesterday, and then here we
I
are
don't know
today.
why I
So
put this
great
on.
to be on with him, plus Jem and Last Bear. Always a fantastic panel. I get a ton out of these things. And
That sounds like a good idea.
you know,
I'm with it.
Wouldn't
I'm with it.
Wouldn't watch a Fed meeting with any other group. So,
I'm with it.
Happy to be here.
I'm with that.
Hey, I'm right there with you, Bob, and I love the discourse you guys
If
all
I could
have
see
when you're
you,
up
I'd
here
be
together.
handing
So
you
I'm
a
pretty
dollar
excited
for that. I
this
like
one.
that idea. I wonder what's going to happen. I always
And
said
last
that.
but not least, we may have some other speakers coming later on as well to be determined. But
I said to my mom, I said, "Do you remember back in the day when there was a change?" I said, "Mom, there's something that's going to be coming that I feel like it's going to be big, like where it could be a change in a currency, or we're going to have just a shift." Now I feel like we're the only reason I feel like we're not going to have that, or like what could happen is if we do have it, is it so a fiat currency, right? We can just continue to inflate prices until it gets to a point where the buyer does not want to buy it anymore at that asset price. And then you have individuals who are forced to buy things like homes and stuff. But I really feel like, we're just going to continue with inflation, and like gas is $3 now. 20, 30, 40, 50 years, maybe it's, $9 to $12, right? Everything is doubled. We're paying $500,000, $750,000 for a basic home in the mid-Atlantic area. And, and even right now, $1 million is not what $1 million was a while ago. It's always been my goal to bring it. Like I've had a couple. I have a number, and I feel like that number needs to be bumped up. But yeah. So I feel like something was going to come from all this stuff, and it's going to be in the currencies and everything. So I'm with you, man. Appreciate you posting, Saeem Kumar. Appreciate you. Saeem Kumar Qatari. Appreciate it. The little girl came in here. So what I'm going to do is I'm going to start getting ready for this FOMC meeting. I'm going to go brush my teeth and stuff. Sorry, my little bean came in here. I wonder if you're going to get a pop off of Boeing. And look at that volume right there, guys. Look at that volume on Boeing right here. Yeah, a huge increase in volume there. I feel like that's... Yeah, we're gonna find out here if Boeing's gotten slaughtered. I'm staying away from that. I'm staying away from it. Let's see here. Let's see here. So AMD has regained that level. Man. I take it that's a failed break, right? All right. I'm going to put CNBC on for you guys. They have the Fed decision and like talks here. All right. So I will get my I'll get my box and everything drawn. Let's see here. What are we going to do? We are going to make a box. Right? We're going to make a box. And what we're going to do is we're going to put the box from high to low. That's our range. All right? So you know when we break in or out of this box, when you are at the bottom end of the box, you should bounce. If you do not break out of it. This is a gap fill. This down here is just price action, this gray one. So don't worry about that so much. Just pretty much like 443, which is this turquoise line. That's our previous support and resistance, and we broke back above it. So if you don't know anything about... So I wish I could... Man, I wish I could bring it back. So what I'm going to do is I'm going to use this before for when the meeting does start. This looks like to be a higher low we're putting in. I want to see if we start selling off. Look at the increase in volume stepping in here. There's the retest. All right. Let's see if it rejects this. See if it rejects right there. It probably won't because we have an hour. And it completely does the opposite. Takes it right back. So that's a double bottom support. Let's see here. And then we also have... There's like so much I can make out of this. AMD is selling off. Nvidia, I'm going to go get ready and I'm going to go get my hair did and all that fun stuff. No, I'm just playing, guys. Dot plot. Any surprise on the dot plot? I agree. I 100% agree. Oh god, I'm getting excited, guys. You guys have no idea. I can feel it. The antsiness. It's happening. It's here. Where are we going to go? Let's take it one step at a time here. All right, nobody rush to ask questions or do anything. All you know, let's single file. Let's all not get excited here and throw in a bunch of questions right now. If you want to, you can, but like, you know what I mean? That was a joke. Right? Let's all not answer the question at one time now. Things like that. So, where are... Give me... Alright, so that is a 15-minute. From where we opened. We opened at 444 flat. Pretty much. We opened at 444 flat. So what I'm getting at, guys, is let's do like a percent. Or not a percent, but yeah, a percent. 0.7%. Or 3/10. I don't know. You guys are going to see what I'm doing here. So Here's 0.23%, and right now we're at 0.2. Let me turn this way. I like this. I like it like that. Let's go to. This really isn't resistance yet. 3, 4, 5. So that would be we're at 30. 30 and 30 would be 60. I still like 447, man. I really do. I still like 447, guys. Which is got something in my eye, and I'm still tired. So that's 0.6%. All right, guys, I'm gonna go get ready, so that I am fully prepared for this. All right, keep it tight. That is your stops. Not sure what you thought I meant by that. Keep it tight, as in your stops. Oh, Kelly, shut the up. We're right where we are. We're right where we opened. So this is the last Fed meeting, if it'll give it to me. Right here. Somewhere right here. You see that? That was the last Fed meeting. Boom! You had, once you had this break and retest, boom! I was on that trade. You know what? And I was on this trade too. Or we was on it. Sorry, I'm just going crazy right now. Just going crazy, guys. I'm losing it. I'm losing my mind. I know. Tesla's been going nuts. Tesla's been going ham. Where's TLT with that yield curve, or that yield, this bond? 2s, 3s, 5s, and 10 years close at the highest yield since 2007. So TLT should get smashed. It didn't. I don't know why I decided to go long TLT, because I didn't want to miss it again. I didn't have that much conviction in it. I did, but I didn't as like a trade. And I couldn't get out. I didn't get out of my whole position. I have time. Maybe I need to calm my tits, but maybe I need to cool my tits, but I still have a lot of time left on that. Tell him, Rick.
Shares of CBS selling off here. Charlie Victor Sandy. Why do you say that? That's quite a decline from where we are today at 4.3.
That's right. I think for all the reasons that Mark was talking about, we are expecting.
All right. There's TLT. Again, guys, if you don't know, I have not had hardly any sleep. Oh my gosh, look at Tesla, guys. That was the target. This line was the target. Oh my gosh. Oh my gosh. Wow. Unbelievable. That's crazy. So what I'm going to do is I'm going to go to the ES. The time is not on our side right now. But that's so crazy. I cannot believe Tesla. Tesla's such an asshole.
And Jamie, because you also share this view that we're at the end of the rate hike cycle, you think that means that cash may no longer be king. What are the ramifications of that? That's a good thing.
Alright, so I'm going to go brush my teeth and stuff. I can't believe that, man. That sucks. If you were on Tesla, great job. This was a pretty nice double bottom. You know, you get long. That was the target. We drew this line here for this morning to show where my thoughts were that we were getting. That was the target. That was the target. So, you know what I mean? That's a pretty good job. You know, I don't know. I wasn't sure how it was going to do it. But it did it. It did it. I wasn't watching. I figured if we got above this that we could get a break and retest of sorts. And what are you doing, Turkey? What, baby? What is it? Come on. I'm going to turn CNBC on for you guys, and I'm going to go brush my teeth and get ready for the day, or get ready for this meeting.
And the big three sticking points shows that inflation worries aren't going away anytime soon. And as we go to break, let's get a look across the markets at the setup into this expected Fed pause. The decision in about 43 minutes time. The Dow's up 229, the S&P's up 8 points. As you can see, the 10-year yield has backed off considerably, 4.31%. We're back after this.
Healthy life.
Welcome back to this special edition of The Exchange, live from the nation's capital on a beautiful, almost fall afternoon.
Lovely.
This is D.C. where you like it. Today's Fed decision, it is front and center, of course, for investors, but don't forget, we are only about 10 days away from a potential government shutdown if Congress can't come together on an agreement. And that looks increasingly unlikely. So what's on the table? CNBC Washington correspondent Emily Wilkins is on Capitol Hill with the latest. Hi, Emily.
Good afternoon, Tyler. Well, yes, we're 11 days away now from a government shutdown, and there is still no compromise on the table for how things are actually going to be moving forward. And look, lawmakers were supposed to depart yesterday, or rather, sorry, tomorrow on Thursday. Kevin McCarthy, the Speaker of the House, has said no. They
See, I knew something wasn't right. I knew it.
They got to
I
get
knew it.
this done. They are still currently negotiating over that potential stopgap Republican plan that would have the government funded from the end of September until October 31st and would include some Republican priorities, things like building the wall at the border and limiting asylum, wall-cutting spending. And McCarthy told reporters this afternoon he is open to any other ideas that members of his party have for what should be in the stopgap bill. Republicans will be meeting later this afternoon at 4 o'clock, and we expect to hear a little bit more about what they're thinking. But really, there's only so much McCarthy can wind up doing here. There are some members of his party that just do not want to pass any sort of stopgap at this point. And even if there is a way forward on this Republican-backed temporary funding bill, there's really no chance that it's going to go forward in the Senate. So a lot of gridlock here in Congress. But we are seeing some progress on legislation that actually passed a year ago, the CHIPS bill. Today, the Department of Defense came out with an announcement. It's the first funding that's really being allocated from the bill, and it's going to go to 8 regional hubs across the country, $238 million there. And really, it's kind of the first sort of signs of this bill that passed so long ago actually getting out into the economy and beginning to influence things. Tyler?
Emily, if I may, I'm glad that you just mentioned that, because on a day when the Federal Reserve is part of its campaign to kind of tame inflation by taking liquidity out of the economy, you're telling us that there's the spigot from Washington is really just getting, maybe not getting started, but consistently heading down the pike here with all of this funding that's about to be doled out.
Yeah, remember, it's not just the CHIPS bill. You also have that bipartisan infrastructure bill. You also have that tax plus environmental plus healthcare package. So a lot of things that Congress is doing are actually really now starting to be seen. And Democrats are hoping that that's going to make a political difference for them. But of course, this rollout is going to take a number of years, and it's going to be quite a while before we start.
I feel like there
seeing
was that was it. Sorry.
All right, Emily, thank you very much. We appreciate that.
Indeed.
Wilkins.
Our next guest warns that a shutdown could trigger an economic data blackout ahead of the Fed's November rate decision, and it would impact two of the most important data points for the Fed before their next meeting, the jobs report and the CPI. For more, let's bring in Alec Phillips, Chief U.S. Political Economist at Goldman Sachs Global Investment Research. Good to see you. It's nice to be with you in person.
Thanks for having me.
Before delving into all of that, can I just bounce off what Emily is saying with the government shutdown?
Yep.
Small overall economic risk, it seems. But is there anything from, we'll get into the data piece of this in a moment, but anything else that you're watching just from a big picture GDP economy interest rate point of view?
So we wrote something recently about what we call the Q4 pothole. So basically, you've got student loans restarting, you've got the auto strike, and then
That's
you've got
so
the shutdown.
insane, guys.
Those three things together, we think, takes growth from probably a little bit more than 3%
I
in
think.
Q3 to around 1% in Q4. So it's going to be a pretty substantial slowdown. With that said, as long as the shutdown lasts for, a couple of weeks, which is our base case, then it should be manageable. If the shutdown lasts for a long time, then maybe not quite as manageable. But of course, it's temporary. No matter what, the government will eventually reopen even if it does shut down. And it's also fairly predictable. We know it's worth about 0.2 of a point off of growth per week. So you can measure the weeks and you
Swear
kind of know what you get.
on everything I own
Whatever
and
comes
love,
out of near-term
I will be
GDP
right
gets
back,
added
and that
in
I
the
am
long run.
leaving here.
So again,
Not that
maybe
I'll be
the
right
most
back, but
impactful
I'm
part of
leaving.
this could be the data blackout.
I'm just gonna go brush
If
my
we have a
teeth and
full
wash my
government
face and
shutdown
stuff,
like
and
we
get
had a
ready for
decade
this
ago,
Fed meeting
no
so I can
reports from Labor
be
Department, from
prepared.
Congress, that's where we get what was referenced. If it's a partial
All right,
shutdown,
let's see here.
like in 2018, 2019, I think it was.
AMD, I'm
did
just gonna
still
throw
get those
Tesla up
reports, but
and leave
is there
CNBC on there for you. They're talking
is there any
Fed
chance
talk
that they
too.
would deem these
Wow.
essential work and
Tesla
kind
up
of let them still put out these
2.26%.
key reports, do you think?
You got
So
to be
right
shitting
now,
me.
the BLS has already said, so on the labor side has
What
already
a whole
said that they
asshole.
will not be able to put out the reports. So the
Tesla's
answer
so mean.
seems
This is a
clear
nice,
enough. Now,
really nice double
if the
bottom. I don't
shutdown
know
were to
how we
go
didn't get
on and
long.
on and on, eventually
Looks
maybe
like you
they
got a
would have
bull
to
flag
revisit
coming,
that.
so I'll be right
But of
back,
course,
guys.
the challenge
Give me 10
is
minutes.
It's all based on surveys. So if you shut down the government, do you have the surveys on which that data report is, based? So, I think the short answer is a brief shutdown means that we get the September reports on employment and on inflation delayed for, probably a couple of weeks, but still in time for the November FOMC meeting. A longer shutdown means that in November, the FOMC is maybe flying blind.
Let's talk about what is at the heart of this disagreement between the GOP in the House, basically, and the rest of Congress, the Senate. I thought that, tell me I'm crazy here, but I thought when they hit the debt ceiling agreement that the spending disputes were settled. But it seems like they are anything but settled.
You're not crazy.
They
should have been.
It should have been settled, but now they are 120 billion apart, or roughly so. And the GOP wants to cut domestic spending or discretionary spending, non-military, not veterans affairs, and they want to move forward on the building of a border wall. These feel like things that are outside of that earlier agreement.
Yeah. So I think
what happened
when we saw the debt limit deal put together, I think there was a general understanding that that was going to be more or less the spending level that we'd end up getting for the coming fiscal year. Frankly, I think that is still basically the spending level that we're going to get for the coming fiscal year. But Republicans in the House have decided that they still want to aim for something lower than that, and they will point out that, in fact, the debt limit deal was a cap on spending. It wasn't necessarily the actual spending number.
They were not, the seeds of this were planted, because I recall when McCarthy kind of suddenly agreed to this deal that those on the further right of his party were quite upset at the time. And it seems as though from that moment they've been kind of plotting to say, we want to cut spending or add this funding, and this is now our chance to do it.
And, to be clear, this is basically what happens every time. The difference is that right now, the folks who are not getting what they want, and nobody gets everything they want in Congress usually, are in a position maybe to stop a spending bill from passing, as long as Republican leaders want to pass it in the House with only Republican votes, because the majority is just that
thin.
Do
you think they'll end up passing it with the Democrats on the contours of what was already agreed to?
I think it's unlikely that the shutdown, if it happens, will last forever. And I think it's unlikely that they'll be able to get President Biden to sign a bill into law that has unanimous Republican support. Therefore, I think it's likely that ultimately there's a bipartisan deal to probably reopen the government after it shuts down at something similar to the spending level that was in the debt limit deal earlier this year.
And will it be most Democrats voting for it and a few Republicans, or most Republicans and a few Democrats?
I think if Speaker McCarthy were to get what he probably wants, it would be, a little bit more on the Republican side. But it's going to have to probably be split pretty evenly.
How endangered is Speaker McCarthy as a factor of this?
After all the celebratory articles that were written just a few short months ago, let's remember.
That's a good question. And I think there's a good chance that we'll never actually find out the answer, because ultimately the answer is, can he survive a so-called motion to vacate? That motion may come. I am personally a little skeptical that he would be removed through that kind of a motion. But I'm also a little bit skeptical that we'll ever actually get to that point. I think the way this gets resolved is we have a shutdown. We probably don't see that motion come ultimately. And then the government reopens maybe with a small sort of token gesture so that Republicans in the House can feel like they got something out of the process.
All right.
All right, Alec, thank you very much. Great to see you.
Yeah, thank you.
Alec Phillips. And coming up, a government shutdown isn't the only looming risk to the economy. As the UAW strike enters its 6th day, a key wrinkle in the negotiation shows that the fight against inflation still has a long way to go. Just over 30 minutes now till the Fed decision. We will be back in 2.
By Joanna Gaines.
Welcome back. We've got some breaking news on the UAW strike. Let's get straight out to Phil LeBeau with the latest. Phil?
Kelly, as expected, General Motors has idled its plant in Fairfax, Kansas. That is just west of Kansas City. That's where they make the Cadillac CT4 as well as the Chevy Malibu. That means that they will be laying off approximately 2,000 workers there. And as you take a look at the latest developments regarding the UAW strike, we will likely see more of these types of layoffs. Stellantis today announcing that it has begun layoffs at some of its facilities, the most notable being in Toledo, where they are laying off 68 people, expect to lay off another 300 at facilities in Kokomo, Indiana. Automakers are pushing back on messaging. We are increasingly hearing from them that the messaging coming from the UAW is misguided and wrong. We'll talk more about that in a bit. Remember, there's a deadline Friday at noon Eastern where the UAW wants to see serious progress towards resolving these issues and getting a contract in place, or else they could announce more layoffs. Let's go through each of these. Stellantis, it's going to be laying off 68 employees in Toledo. They expect to lay off approximately 300 more at their facilities in Kokomo, Indiana. As for General Motors, as you take a look at shares there, I talked about the layoffs happening at its plant in Kansas. The GM president, Mark Royce, out with an op-ed today in the Detroit News saying that there is a flow of misinformation coming from the UAW. Remember, GM is offering a 20% wage hike to the union. And finally, you've got Ford. It has reached a tentative agreement. Ford of Canada reached a tentative agreement with the union up north of the border. Unifor is the name of that union. So now we see what happens with GM and Stellantis. They still need to negotiate with Unifor. Bottom line is this, guys. We are nowhere close to seeing a resolution to this disagreement over a contract between the UAW and the big three automakers.
Is there a scenario, Phil, and how likely is it, of a nationwide strike by the UAW against the automakers? Right now, they seem to be targeted shutdowns and targeted shutdowns of factories.
It is possible, but they've already said that they plan on these strategic strikes. And the strategy here, Tyler, is essentially them saying, we want to keep the automakers guessing. We're not going to shut them all down at one time. And we are, theoretically on Friday at noon, we will hear about another plant, another 2 plants, maybe another 3 plants where they have decided, you know what, we're going to walk off the job there. Doesn't shut down the entire company if you're GM or Ford or Stellantis, but it adds pressure. And that is what the UAW is looking to do here.
Economic point, I think these workers would be able to get unemployment benefits, maybe be counted and as unemployed, whereas striking workers, not so much. Phil, for now, thank you very much.
Correct.
We appreciate it. Awesome. Okay, good. We're always looking for that impact. If we get the reports for October in particular, which will show the fuller effect. Let's get to Contessa Brewer in the meantime for a CNBC News update. Contessa?
Kelly, Tyler, President Biden is expected to announce tomorrow a $325 million military aid package for Ukraine. The announcement coincides with President Volodymyr Zelensky's visit to Washington. The weapons package reportedly would include more short-range air defense systems and a second round of those controversial cluster munitions. South Korean police are accusing American soldiers of smuggling and distributing synthetic marijuana in the country. 17 soldiers allegedly imported 12 ounces of the drug through the U.S. military's postal service. A detective in the case said all the soldiers were allowed to return to the military base after questioning, but one is being detained within the base. Companies on Facebook and Instagram soon will be able to buy a blue check to get exclusive features and support. Businesses can buy verification for $22 a month on one platform, $35 for both. They'll get added account security features and troubleshooting, and also reportedly would get increased visibility into searchers and the ability to have multiple employees chat with and respond to customers. So that's what's happening on the social platforms. Tyler?
All right, fascinating stuff. Thank you very much, Contessa Brewer. Still ahead, it is no secret that mortgage rates have skyrocketed in the past couple of years as the Fed has raised rates. But if you're still looking to buy a home right now, you will not believe how badly that has hurt your buying power. We've got the shocking number next. Welcome back to our special Fed coverage for this historic day. The historic pace of rate hikes certainly pressuring the consumer. From credit card interest to mortgages, the cost of living has gotten a lot more expensive. And drilling down on housing, the current rate on a fixed 30-year mortgage sitting at 7.3%. 2 years ago, that number was 3.03%. To talk about what those rate rises mean, let's bring in Ted Rossman, Senior Industry Analyst at Bankrate. Ted, welcome. Good to have you with us. So that jump from 3% to above 7%, what does it do to purchasing power for a home buyer? How much does it cut it?
It cuts your purchasing power by about 40%. So in other words, if you could afford a $375,000 house at 3%, now with rates over 7%, you're probably looking at something like a $225,000 house. And there aren't that many of those. That's another key point, is that low inventory plus high rates, we're talking high prices, high rates. It's a tough situation.
So it's a tough situation. So I guess if I were in the market to buy, what I would be doing if I were faced with that dilemma would be looking at adjustable rate mortgages, where I can at least buy some time at a lower rate and maybe get into that $375,000 house, even though I would not have the certainty of a 30-year fix. Is that what's happening?
Some people are talking about dating the rate and marrying the house, as in you're betting on refinancing down the road. I still think, though, that the 30-year fixed is the best gauge of affordability. I mean, it may not always be the best product for everybody, but it's just a slippery slope. You know, if you're betting on refinancing, and what if that doesn't work out for one reason or another? Rates don't move as expected, or you lose your job, or you have to move and sell the house. I think there's some risk here. Another thing we're seeing is that home builders and sellers are sometimes offering incentives, like rate buy downs, for example, to cushion the blow for buyers.
So, Ted, we've been focusing on the impact to the housing market. The auto market is a little bit different, but it's still massive. I think the second biggest in terms of outstanding debt, and we're seeing many more cracks there already than we are on the housing side of it. What's going on with autos?
Subprime auto delinquencies are actually worse now than they were during the Great Recession. And I think that speaks to the impact of higher prices. The average new car price is approaching $50,000. For a lot of people, that means a monthly payment around $800. And with people getting squeezed by inflation in other areas of their lives, not to mention car-related categories like car insurance, which is way up, gas prices have started to tick up. This is why people are falling behind. It's tough to swing that $800 a month payment.
Wow.
Can I come back to housing for just a second, Ted, and ask a question? I remember a time, which shows my age, when mortgages, fixed mortgages, were often assumable by the person who's buying the house. Why is that no longer the case? Did the banking business just decide, hey, this is a bad deal for us, we're not going to let people assume mortgages?
It's actually prohibited on conventional federally backed mortgages. It is allowed in some isolated instances with certain FHA loans and VA loans, but we're talking about a much smaller slice of the market. It would be nice, though, to take over somebody's 3 or 4% rate, because that's a key point. 80% of current homeowners have a mortgage rate below 5%. That's why people don't want to move or trade up right now, because that 3 or 4% rate is going to become 7 or 8.
Well, Tyler, you should head out to, there is a company called Roam, R-O-A-M, that was just profiled in the Wall Street Journal that's trying to get the ability for people to do just that.
To do that, to assume mortgages.
Assumable mortgages.
Interesting.
Bingo.
It's a rather antique thought, but there it is.
I think they're joining us on the show tomorrow. In fact, thank you guys. Appreciate that.
Cool.
Ted, thank you as well. We appreciate your time today, Ted Rossman. And that's the consequences of what happens with the Fed in just a couple of minutes here. We're used to some pretty big market swings on these decision days, but actually, Susquehanna's Chris Murphy says the implied move for the S&P today is less than 1%. That's the lowest for a Fed day in nearly 2 years, which takes us back before the current hiking regime began. Let's ask Dom Chu what to make of it. Hi, Dom.
All right, so what we have right now is a market that is very much in tune with this idea that rates are going to stay fairly steady here and that the Fed is going to at least take a pause. If you look at the Dow Industrials, the S&P, and the NASDAQ, this is the typical wait and see that we are getting ahead of that big Fed rate announcement and certainly before the press conference from Fed Chair Jay Powell. At the highs of the session, we were up roughly 18 points in the S&P 500, up 5 points at the lows. So generally trying to bounce back from yesterday. 44.48 your level in the S&P. The Dow Jones was up 0.5%, 180 points, and the composite index for the Nasdaq down about 0.2%, 13,652. Places that we will keep a close eye on with regard to the broader market and what's happening right now. Take a look at some of those Treasury sides of things. You see the Treasury yields for the 10-year note yield specifically drifting slightly lower to 4.32%, a la your conversation right now about housing and rates. If you look at some of the industry-specific moves that we are seeing, take a look at some of those moves that we're looking at with regard to sectors.
What up?
If you look at those, check out what's happening with crude oil on the energy side of things. Just about flat on the session, 91.15 though, but still near cycle highs. They're going all the way back to November of last year. Keep an eye on WTI crude. And then watch some of those stocks and sectors on the move. We always talk about real estate, utilities being more rate specific here, financial.
Every time I wash my face,
also
it's
kind
a
of
party.
rate sensitive. Communication services and technology, the laggards here on those higher
I'm going to share this non-event.
And we'll get a quick check on
real
the IPO
quick.
with Tyler Kelly. The hot one, Klaviyo, today, coming off of its highs of the session so far right now, but ARM Holdings, $53.08
Join us for
a share.
the non-event.
Right now also down. Remember,
Copy.
Instacart priced at just around 30. ARM Holdings at 51. So again, a little bit of a take back here in some of the profits we've seen. Tyler, I'll send things back over to you.
All right, Dom, thank you very much. From student loans to striking auto workers, consumers being
Hey,
pressured.
join us
on
live.
multiple fronts. Brookings Institution David Wessel will tell us what
Come
that
on.
means for the Fed's next move after this quick break.
For the non-event FOMC meeting. Now watch it bite me in the ass and it goes nuts. Let's do it. So let's go to the Fed site. Let's go holler at the Feds. Let's go look at the. This was the minutes. No, I don't want the minutes. I want previous FOMC. Whatchamacallits. Y'all know what I'm talking about. Summary of economic projections. Summary of economic projections. Summary of economic projections. If you guys could, if you could be so kindly as to hit that fucking like button, it'd be greatly appreciated. You know why? Because we don't charge a damn dime for this, and that's the way. It's a way to show me that you guys appreciate this stuff. So, projection, materials, PDF or HTML. HTML. We'll go with HTML, bro. Core PCE, Core PCE. This is the Red Bull, by the way. Just so if y'all didn't know, I just got me my little Red Bull and shit. And I'm hype. It's time. It's time. So let me find what it is I'm looking for.
Welcome back to CNBC's special Fed Day show. We're in Washington and just minutes away from the decision on interest rates. Our next guest says he's not expecting a surprise today.
Sorry, guys,
We
give
will
me 1
likely see a
second.
pause, but it's what the Fed plans to do moving forward.
You guys
that
have
will
any
be
questions
key.
or what?
Here with
What's
us
up?
is David Wessel,
What's
Senior
up?
Fellow in Economic Studies at Brookings. Great to see you again.
Good to be with you, Kelly.
And this, we mentioned it off the top, but I think we should drill down on it once again. Right now, the market is pricing in
Guess
about
what?
88 basis points of cuts. Yes, we're talking about the cuts next
I
year.
just want
because
dollar
for the
bills,
long end
actually.
on rates, it really is is going to come
platinum,
down to
gold,
do they
all
confirm
that shit.
Okay, 3 or 4 cuts
Give me
next year.
dollars.
What if they dial
I
it
want
back
paper.
to 2? You know, like
I want worthless
and
paper.
It's, just to throw this in the mix as well.
All right,
there's
guys,
been
it's getting ready to
massive
come
shorting
out. Let's
amongst
get
the hedge
real.
fund community
Oh,
of
man.
rates
Shit's about
to
to
the point
get
at which regulators
so
are kind
real.
of taking notice. So a lot is hinging on what we
That's
learned
right.
today.
So you're absolutely right that there's not much suspense about.
I'm gonna
what
make
they're
sure
gonna
that we
do at
have
2
everything.
o'clock. Takes all the fun out of covering the Fed. It's like covering the World Series when they tell you the score before the game, you know? So everybody is going to be looking at what they say going forward. Last time, there were a number of people seeing rate cuts at the middle of 2024. I'm not sure whether they're going to do that again. They have to be careful not to get the markets too giddy.
Oh, my God.
Because if the markets start to expect rate cuts and then they may get more juice for the economy than they'd like to see. So it's a tough call for them, and a lot of it has to do with what their forecast is, both for inflation and economic growth.
No, you're right, and it's exactly what Jamie Cox told us at the beginning of this hour, where he said once they know that the rate hike cycle is over, you start to see yields decline.
Remember this number, y'all.
He's
All
like,
right,
cash will no longer be
2023,
king. People are gonna pile
2024.
back into stocks.
Here's
You know,
your
financial
whatchamacallit.
One of the things that makes this interesting for us who've watched this for a while is
So,
there's always been this question about how long are the
Goog.
lags in
Let's go to
monetary
Goog.
policy. And I'm sympathetic to the view that
Summary
the lags
of
are shorter
economic
now because
projections.
they tell you so much, all this forward guidance, the bond market reacts very quickly. So they have to be careful about how they calibrate that when they put their SEP together and what the chairman
much?
says.
We just put a little comment up there saying inflation is
21st.
cooperating.
Is today the
with the
20th?
Fed. How much?
Today's the 20th.
Really? A
7
lot?
minutes ago, I got
Or
a
a
missed call.
I think it's
Give me 1
cooperating
second,
a lot
guys.
in that it's coming down. That's what they want to see. And people seem to have looked at the last number, and if you thought inflation was coming down, you pointed to the half of the indicators that said it was, and if you didn't think it was coming down, you point to the other one. It was. It's kind of one of those mixed reports. So I think it's cooperating a lot in that all they want to see is it's coming down. What they don't want is unhappy surprises of it going up. Now, the big question is how quick.
People don't seem to feel it coming down.
Well, that's true, but that's a different question.
It
the
is a
Fed is
different
trying
question,
to
but it's
steer
an important question.
It's particularly politically.
Yes.
Yes. Like, I don't think people are convinced that inflation is coming down. And also, people look at the level of prices.
For sure.
They don't recognize that if it's going up at a slower rate, that's victory. So what makes Jay Powell happy may not make Joe or Jill Sixpack happy. And that's a big political problem. But from the Fed's point of view, if inflation continues to come down gradually, the pace of the labor market slows a little bit, they can afford to be patient. What they have to worry about is that doesn't happen. And there's this other wrinkle about oil prices. If oil prices are up, you know headline inflation is going to go up. And the Fed wants to look through this, but they can't seem like they're not paying attention because, you know, I have to buy gas. I don't buy core.
Not to get super wonky about this, but
Kelly heavens, not to get super wonky.
if only we really focused on nominal GDP, that would help clear up a little bit of the confusion, right? Because the difference between the way that energy and food acts like a tax and maybe it's supply. The point being, nominal GDP was growing at almost 14% at the end of 2021. That 14% is an astronomical number. We're down to like 4%. So that just tells you how much potential we could really have for inflation and all the rest of it going
right.
forward.
So, you know, there are economists who advocate that the Fed should have a nominal GDP target. And I think the counter has been it may be hard to explain to people that
and to track.
And yes, because GDP gets revised and all that. But I think that part of this is what do you use to steer the economy? And you want to look at things like nominal GDP. And then how do you communicate with the people and the markets? And I think where the Fed has been successful in holding down inflation expectations is by suggesting they have a lot of resolve to keep inflation coming down. And we, in a sense, we're in an inflation targeting regime now.
All right, you guys got that right?
But that's what
y'all got that right? What's up, Chris? What's up, Chris?
You know,
sorry to
when
shout.
I started covering this stuff, people weren't so sophisticated about inflation expectations. There was a lot of M2.
Yeah, right here, bro.
Right.
Just
No,
go, just Google the Fed.
The people who still want M2 to come
lag free. Just go to the federalreserve.com.
Yeah.
That's it. It'll be right on the front page.
It will, but
all right. So look, go
I
to
think
Google.
Things are breaking the right way. I'm not sure. I'm not confident. I wouldn't. If I were the Fed, I wouldn't bet on it.
Federal Reserve, and it'll be right on the front page. If it's not on the front page, say it should be right here on the front page. It starts at 2:30.
We are about 6 minutes away from the Fed decision and about 40 minutes from the chair's press conference.
This still may be a little laggy for you.
Quick break.
Then real time, you may see the market move before you see this. see or hear him say something, but you could try like Bloomberg Radio or something like that. Or just watch it right here. All right, we got 5 minutes, so remember year-end target. Let's see, Fed funds rate 5.6 2023, 4.6 2024. So let's see if this year-end target starts to change. 2023, you have a like a median and average, which is 5.654, same thing. No problem, bro. Yeah, yeah, here's the thing, bro. I think I don't want to be the bearer of bad news. I think we might not get much. Just gonna be honest. All right. Just a couple more minutes here. I think that the market's going to be more concerned with this debt ceiling for the government. The only way that the market cares about this, whatever comes out, is if the numbers change and or, you know, the way Powell talks. So there's got to be something in here that's a surprise. We already know we're getting, like, we should get one more 25 basis points. Do we get a pause and then the 25 in November? Or are we going to get it today? And then a pause? And then another one? Or are we, you know, what's going on here? So, I feel like we're getting one more. And this is what you guys want to watch. You want to watch November. You want to see the rate of change for November. This is going to be important. It's going to be important.
Welcome to a special
decision
power lunch from Washington, D.C. I'm Tyler Matheson. Kelly Evans right here with me in Washington. Just a few minutes away
didn't
now
I
from
get
the release
calls
of the Fed's
here?
decision
Now I got to
on
lower
interest
this
rates, top of
freaking
the
box.
hour, and we'll see what our panel is predicting. But first, let's check on the markets and where they stand. As you can see,
So
the
that's the
Dow
low,
is about
443.
3/5 of a percentage point higher. The S&P higher by about 1/5 of a percentage point, but NASDAQ roughly flat. The 10-year note yield at 4.319. Let's get to our panel. CNBC contributor Stephanie Link of Hightower, John
guys, we
Bellows
got
of Western
3
Asset
minutes.
Management, David Kelly of J.P. Morgan Asset Management, and Greg Ip of the Wall Street Journal. Welcome to all of you. Stephanie, let me begin with you. How close is this Fed to being done raising interest rates?
Very
and
close.
Could this be it?
Very close. What you mean, bro?
Yeah, I've been saying for a while that we're in the 9th inning in terms of this rate cycle.
The hell kind of question is that, old
and
man
I still
boots?
believe that to be the case. So
I'm
whether
just
they
playing,
go,
guys. I'm
probably
sorry.
not
It's
today.
the Red Bull.
Whether they go in November or not, I think we're
not me, it's the Red Bull, I
close
promise.
to the end. That being said, Tyler, the economy continues to have a lot of momentum. We're seeing above-trend GDP growth led by the consumer, led by pockets of manufacturing, and that's leading to continued
Kind of curious about my
inflation.
TLT position.
We've made progress. We went from 9.1% CPI to
Guys,
8.7.
one more time, the move
but it's not close to
will
where
probably
the Fed
be at
wants to go.
2:30
We know
when
that
Jay
core
Powell
PCE
comes
number is
up
really
to
what
the
they pay
stage.
attention to at 4.2%.
It's probably
Still
not going to
much
be
too
the
high.
release.
So rates stay
I
higher
hate to
for
be the
longer,
bearer
and
of
that's
bad
what we have to
news.
live with.
John Bellows,
why
do
am
you
I
buy
on
that,
Twitter?
Argument, rates stay higher for longer, but the
Twitter
Fed stays where it is right,
All right?
now. We're
Twitter.
near the end of the cycle.
I'm just playing.
You know, I actually think we're a little bit closer than what Stephanie just said. If you look at the inflation numbers, for instance, you know, on a 3-month basis, they're
I almost
actually
blew
much
my
better than
speakers
on
out.
the 1-year basis. And what that signals is that the more recent progress on inflation has been
One
substantial.
more minute, guys.
I think
All right,
similarly
let's
for
do
growth,
this.
you know,
Let's
we've had a
refresh,
good
refresh,
growth year,
refresh.
but
I'm going to
more
read everything
recently,
out
what
to you
we've
guys
started
as
to
we
see
get
some
it.
cracks in that. You know,
Here is
housing
the last
starts
one
this
we
week
got.
is
Fed
notable
funds
for
rate,
having a
March
big turn.
projection
So I think we're
5.1.
much closer in
Fed funds
terms
rate
of
5.6.
inflation being closer to target. I think we're closer in terms of seeing
PC
some
change
slower growth.
GDP.
As a
So we're going to want to
consequence, I
watch
don't
all
think
this
the
stuff.
Fed
We're going to
needs
get
make
these
much
numbers.
change today. I think you can
GDP,
read
unemployment,
interest rates
PCE.
unchanged and leave their
All right,
forecasts
where does it
unchanged
change?
because a lot of progress has been
All right,
made.
let's do this.
You know, and that is
I'm going to
proceeding
leave this
carefully
on
today.
and turn up the...
Greg, what are you watching?
So, you know, in the old days when I started covering the Fed, in the statement they had something that was called the bias or the balance of risks. And essentially what this was saying was even though we may not have changed rates today, what we're telling you is where we think the likelihood is of moving in the future. And that was in essence talking about whether they were more worried about inflation being a problem or more worried about unemployment being a problem. And essentially for the last few years, the balance of risk has been to tighten further, that all else equal, it was more likely that they would go again, that they would not
it's
go.
out, guys.
In the last few weeks, I think, starting with Chair Powell's speech at Jackson Hole,
it's unchanged. I thought so. Come on.
Back towards not quite, but almost to a neutral balance of risk.
Come on.
And I think that what I'm especially
Here we go.
looking forward
Finally,
to,
it's up.
The press conference for is to hear whether he ratifies the view that rather than being in the position of we're going to raise rates unless the data says otherwise.
5.656.
I'm looking for a comment that
Same.
says, we're going to keep rates where they are.
Same. 5.1. Look for 2024. Look, 2024 has went up. Man, fuck these guys. These guys don't know what the hell they're talking about. 3.9 for 2025. That's obviously too far out. We don't know. 3.4. Everything has been rose. The rates have risen. This is not good. Markets should fall. That's not good. Shit. That's not good for my TLT trade. Damn it. They're saying higher for longer. Fuck. That's it, guys. We get a retest of 443. My ass is grabbing puts. That's all. We don't even need to hear from Powell. The paperwork told us everything we need to know. Shit. So again, 5.6, 5.6. It hasn't changed, but what has changed is 2024, from 4.6 to 5.1. All right. We don't even. I guess it's still here. 3.9. Everything has went up. Let's see. 2023, 5.4, 5.6, 4.6, 5.4. Real gross amount projection measures inflation percentage change. Come on, where the fuck is the remote?
3.9% at the end of 2025, 2.9% at the end of 2026.
I don't even know where my remote is to listen to Steve Leisman. I know we should fall higher for longer. I want to retest though, guys. I want to retest. Where's the remote? Shit. Where the fuck did the remote go? Are you kidding me? Did my cat take it? Oh my gosh. Come on, where did it go? See, they're saying Fed funds is unchanged. No, it is not unchanged. They've raised the target for next year, guys. That's why we're falling.
We're seeing yields spiking up here. I think the fourth quarter is going to be very, very hard to read. Everybody was asking me today about what are they going to say about oil's been up, yields have been up, dollar's been up, resumption of student loan debt. That's what people are talking about down here. So it's going to be very hard to figure out how to call what's going to happen in the fourth quarter because people are expecting the economy to slow down, but you sure didn't see it.
Come on, come on, come on, come on.
All right, let's go out to Rick Santelli. Rick, what's your spin?
Higher for longer. And that's what he's saying. Fuck. Guys, I want to see if we can get a test of 443. And this will give us our reason for the downside. Let's go through it. I gotta watch these charts though. Here it is. The monetary policy midpoint target range, target level for Fed funds rate. 2023, guys. They're all up here at 5.5, just under 5.5. Or, I'm sorry, just above 5.5. All right. So, longer run, 2.5. All right, so I get it. I get it. I get it. Change in real GDP right here. Median project. They released this, by the way. I think they release it. I'll have to get back to you on that one. 2018, 19, 20, 22, 23. Median projection 70%. Sorry, let me. I know you guys can't see it. I apologize. That's, I don't believe. Yeah, that's down to 1. That's doable. Why? Yeah, that's why they're going to be lower in rates back in 2025, 26. So let's see. Man, what? Come on, give me the damn pullback. Sorry to yell. I apologize. Fuck.
Only 1 or 2 cuts instead of 3 to 4. Their median rate forecast is now 5.1 instead of 4.6%. How much of this is what David Wessel just said, which is that they're afraid of letting the market get too far ahead of itself and getting excited about rate cuts? But do you think they're actually still going to do as many rate cuts as they previously thought was likely?
You really have to heavily discount any projection for what they're going to do more than a few months from here. They actually have no idea.
Yeah, they don't have any idea.
I would say that part of this, I'm going to guess, might have been
All right, Tesla's still bouncing. Tesla's green. Wow, man. Fuck, guys. All right, I'm going to give it a minute. This looks like the face pattern, guys. Look at the nose, right? It is! It is! It's the same pattern! Look at this. I'm sorry to yell, guys. I do apologize. Look, you see this nose? There's the mouth right here. There's the chin. Let me show y'all some shit. I'm about to show y'all some shit. This is why y'all need to save charts.
This is essentially the trade-off. We don't need to go higher, but we need to keep our foot at least depressed on the brake.
This is why you guys need to start saving charts and saving Fed days, guys. Look at this. Y'all about to go crazy. Let me see here. Pitches. Where's pitches? Because this pattern's pretty insane. Let's see if they're both bullish or bearish patterns. Come on. Let's go. Files.
But I think that if you're the Fed, what you say is even if the inflation numbers are doing what they're supposed to do, they're coming towards 2%. All of our models, all of our muscle memory says that good news on inflation cannot endure.
I'm going to show you guys something. You guys are not going to believe this. Dude, I just want my damn pitches.
And so, well, we don't feel like we have to raise them now and push the economy into recession, but this is an economy that given the
pitches.
And the resistance
Give me pitches.
tightening in trade says we need to basically maintain again the degree of restraint for longer than folks thought. And by the way,
UAW says Stellantis has made a new contract offer. Sandy Sangolima Alpha, STLA.
You know, foreshadowing what the Fed just told us.
Stephanie Link, let me turn to you. Does this feel to you like a Fed that is close to done with this cycle?
Yeah, I do. I mean, first and foremost, I'm glad that they paused. Not a surprise. They have risen rates 11 times, and plus they're doing QT, and they're going to continue to do QT, which doesn't get enough press in my opinion. So now we wait and we see, and we're now all data dependent. And the dates to keep in mind are on October 11th is the PPI number, and October 12th is the CPI number. Of course, we get the jobs number on the 6th. So we're all going to wait to see on that regard. I also thought it was interesting that they did revise GDP higher, and it's because we are doing better as an economy, much better than what most people expected. A lot of people at the beginning of the year, Tyler, expected us to be in a recession.
Come on, man. All I want is my pitches. Come on, bounce back up, please.
Again, a reiteration of the 2% inflation target. He said it a lot at Jackson Hole, and they're recommitting to it again, and they're not going to come off that 2% inflation target, and we have a ways to go in terms of core PCE.
David Kelly, were these the hawkish sounds that you expected to hear out of the Fed?
Yes, they are, but I think we should be careful about this forecast. I completely agree with Greg that they don't know what they're going to do with rates next year. And what I'd say is this is not so much a soft landing forecast, it's really a soft landing scenario. If we have a soft landing, then they will only cut rates twice next year. And I think that is a reasonable forecast. But, you know, I take very seriously the drags that are gathering here. Student loan repayments. I think that higher energy prices, higher gasoline prices drag on the U.S. economy. I think the UAW strike is troublesome. I think the possibility of
Trying to show you guys something real quick.
Higher interest rates is on the banking sector,
Real quick.
on lending. All of these things are building pressure on the economy. So even though the third quarter is going to look spectacular in terms of GDP growth, it's going to slow.
So that's a double top.
And I think the Fed is not out of the woods in terms of having a recession in 2024, even though this forecast would suggest no recession in 2024.
Greg, you want to jump in?
Yeah, there's one point I want to make is that we're going to hear from Powell soon when the press conference begins. And as you and I have talked about in the past, he will often sometimes...
Come on, give me the face. Where's it at?
That you get from this statement.
I don't know why it's not on here. I feel like I'm losing. Couldn't open...
Projections for the federal funds rate. When Chair Powell really wants to drive a point home and he thinks that the SEP, the projections are helping him that, he will align himself. He'll cite the projections. When he actually wants to subtract from that, he'll often say, well, that's not necessarily a promise. It's just a bunch of people putting numbers down. So does he align himself with that more hawkish out-year forecast, or does he play it down? That's what I'm looking for.
John Bellows, jump in here. To what's just taken place.
Never mind.
You know, a lot of our
I don't know what I did with it.
It does seem like the Fed has responded primarily to the better than expected growth. But I wouldn't want to over extrapolate the good growth that we've had. You know, a lot of that has been for kind of very pandemic or post-pandemic specific reasons.
Unbelievable.
Fiscal impulse on top of that. But those aren't things that you can extrapolate forward. So as you try and put your forward thinking on, you know, I do think you need to take into account the lags of monetary policy, the restraint from restricted monetary policy. And so I wouldn't want to over extrapolate growth. And so when I look at this,
All right, guys. I'm gonna pray that we're able to get a bounce back and talk and hear from Powell. That's what's gonna matter. Right, that's what's gonna matter. Yes, I'm glad you didn't. Remember, bro, higher for longer. Higher for longer. Because we do have asset prices getting a little bit inflated. I'm so glad you didn't get hurt, man. I'm so glad you didn't get hurt. I actually thought myself about buying both ways, but there for a minute I'm like, we probably don't even have, this will be like a non-event. But no, it was an event. All right, I'll be back in 2 minutes. I'm just going to use the restroom and grab something to drink, and I'll be right back. If we get up here, I'm going to grab some longer dated puts if we're able to get up to 443. All I need is that retest. That's all I need. That's all I need. And I'm telling you right now, we get up to like here, I'm getting it. So the year-end target's pretty much the same, but next year, 2024, has risen higher for longer. And that doesn't mean that that's where it's going to be. They don't know. Anything can happen, right? Events can happen, wars, anything. You know, maybe the labor market, like we just fall off a cliff with the economy or something. So, all right, guys, good luck. Listen, I'll be right back. Right? You know what I mean? This is my game plan for the SPY. I want to get short here, but do I want to get short the SPY or do I want to get short tech? Probably want to get short tech. All right, interest rates more so affect that industry than anything else. All right, and I'm not just talking about mega cap tech. I'm talking about, like, you know, technology companies like well, you can't hurt Roblox anymore. It's pretty much gotten, you know, beaten to within an inch of its life. You know, things like Uber, it didn't even sell off. I don't know. I'll have to look at some names. MSFT. I'll just do the Qs. Yeah, look at Microsoft today, guys. Slaughtered. Bye-bye. NVIDIA, AMD, things like that.
My sister told me so much about you. That's why it's more than advice worth listening to. It's advice worth talking about. Ameriprise Financial. Looking for Bitcoin returns in an ETF? Available now. The world's largest Bitcoin-linked ETF. Bitto.
I think they're getting in early, guys. They're taking this trade.
Nothing really. I was ambitious. My first job was in Mexico City as a sales representative, selling to mom and pop stores. I had no idea, no clue that 24 years later I would be the CEO of the company. Success is about having the support and trust of people. Success is also about will, sheer will, and never losing that ambition. I wanted to do great things in this country.
All right, here we go. We're trying to get a bounce here. This is a pretty nice flag you got going on. All right, this is the face. This is the nose, mouth, chin, and the neck. All right, give me that neck, girl. No, I'm just playing. 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 Playing. So there's your flag. Fuck. Excuse my language. I'm sorry. I did not mean to cuss. But that stinks, man. This is why it's easier for institutions because they have that, like, they're able to get that move quick because they have computers that scan it. They know exactly where things are. They know exactly what they're looking for. And they know exactly. They say, this comes out, the computer's doing this. If this comes out, the algorithms are doing that. And if you don't know, there are algorithms, guys. Like, there are not people that are trading this. There are people that are, you know, monitoring what buy and sell orders the computers are doing. Algorithms. Right? We could say, we could just put all kinds of them in there. I can put in some algorithms. I could say, buy a fucking 1,000 shares at the SPY at 449.51 with an increase of, it's got to be at least, you know, 1.4 million in volume on a 3-minute candle. That happens, it's going to buy. It's not going to think of, it's not going to get emotional. It's not going to care. It's a computer. It's going to do what you tell it to do. All right, here we go. Let's see if we can get a nice pop. Please. I might be asking for too much here to get this thing back up here. We'll have to see how Jay Powell does at 2:30. I'll be right back, guys. All right, guys. Sorry about that. So we got it. We got it, guys. You know, higher for longer. Higher for longer, team. What I'm going to do is I'm going to wait for Powell. And I'm going to let this trade. I'm going to let this trade go on for a couple days here. Let's look at GDP forecast. Actually, I want to go to economic projections, risk GDP growth. I got to back it out just a little bit. That's too much on me. It's too much of my eyes on that big screen with that white. Projections for PCE. Oh, S&P's commenting now, guys. State Street's commenting. All right.
We're just about 6 minutes away from hearing from the Fed chair himself. Jay Powell's press conference begins at 2:30. We'll take you there live as soon as it starts. There's more of our CNBC special, the Fed decision.
In the U.S. starting within the next 12 months has moderated since the beginning of the year, but remains elevated at 30 to 35%. That's from S&P.
We empower those who act, those who see the correlation between predictability and probability.
Come on. Sorry, I didn't mean to yell in the mic, guys. Risk.
Flawless execution, timing, and accuracy. Identify the goal, match power with precision, reach new heights. CME Group, where risk meets opportunity.
It's payback time. All these years you worked hard, you fixed it, you looked after it. Maybe it's time for your home to start taking care of you.
If you're 62 or older and own your home, a reverse mortgage can put more money in your pocket by eliminating your monthly mortgage payments, paying off higher interest credit cards, and covering medical costs.
Turn this down. All right, guys, we got 5 minutes till Powell comes out. I'm going to really pay attention to this, guys. Really pay attention to this. Let me go to the stream. Boom. Thank you guys for joining. If you guys are new here, if you guys could, welcome. I'm happy to have you guys. If you guys could hit that like button. How is the sound? Comment any questions, anything you guys have. You know, even if I can make this, like, things that I can do to make this stream better. That would be greatly appreciated.
We work face-to-face with our students. We make sure they get all the support they need because there's nothing better than that aha moment when it clicks. Start your child's journey to loving math with Mathnasium.
What if we could connect people to new possibilities?
Higher for longer. Higher for longer, team. All right. Let's get Powell up. We have summary of economic projections here. I can always go back to it.
To reach better decisions faster, to accelerate progress. Together, let's make a new
Come on, where's it at? Where's the number at? I need 100. Come on, you gotta be kidding me. Back.
Economist Jason Furman, breaking down the Fed decision, market reaction, the health of the U.S. economy. Closing bell over time, 4 p.m. Eastern.
As we wait for Fed Chair Powell, let's get some final thoughts from Greg Gibb of the Wall Street Journal. I'm just going to go ahead and pick up where we just left off. We're in Washington after all, Greg. How much is structural higher deficits?
1 second, guys. Give me 1 second. I'm getting everything ready to go, making sure. Come on, stop being so slow. If you haven't pressed forward on the
Futures off the lows 44.90.50 ahead of Fed Chair Powell speaking. That's coming up in 2 minutes.
Alright, so he's not live yet. patient when I grab these puts, but I think I might grab. I just don't want to get shot and get destroyed, guys. You guys got to remember that volatility. You know, you want to buy right. You guys got to really understand what you're doing if you're playing options. Come on. Come on, refresh. What's going on here? All right, we got 1 minute till Powell. 1 minute till Powell, guys. Man, these puts are so beat. They're changing everything, I feel like.
Fed Chair Powell begins the
All right, we're on, baby. Let's get it. Let's go. Let's go, guys. Let's do it. Let's do it. Here he is.
Powell says squarely focused on dual mandate.
And stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly. Good afternoon, everyone.
This is so behind.
My colleagues and I remain squarely focused on our dual mandate to
No.
maximum.
Guys, the feed is behind.
Walks into the room at the Federal Reserve on the September decision. My colleagues and I is the responsibility of the Federal Reserve. Without price stability, the economy
Everyone's
does not
behind.
work for anyone.
Damn it.
In particular, without price stability,
They don't want nobody
we
to
will not
make any
achieve a
money.
Sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy.
But we have the squawk.
We've raised our policy interest rate by 5.25 percentage points.
That's
and have
why I didn't
continued
want to grab
reduce
puts
our
right there.
securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we are in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing
Let's see if we hold
assessments
this
of
low.
the incoming data and the evolving outlook and risks. I will have more to say about
That's
monetary
the
policy
dual
after
mandate.
briefly
We want to wait
reviewing
for the questioning.
economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been
Higher rates have been
particularly
weighing in on
robust.
business investments.
Activity
Can
in the
you
housing
guys hear
sector
the
has
squawk
picked up
box?
somewhat,
That's what I want to
though it
know.
remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year.
Let's go
particularly for
TLT. Let's go
individuals
TLT.
aged
My
25
dog.
to 54 years.
My dog.
Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Their data, we estimate.
So we're above 443 now, guys. See if we hold it.
Of 2%. Their data, we estimate total PCE prices rose 3.4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations.
Just wait, man. Higher for longer. You just broke 443. Oh, nice. Great job, bro. Great job. I was getting ready to grab some puts. Great job, Chris. Great job, Chris.
Nevertheless, the process of getting inflation sustainably down to 2%.
Just give me 1 second. I'll put Powell back up.
The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
This was a pre-written statement, just so we're all aware.
That high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. Target range for the federal funds rate.
There's the balance sheet. The balance sheet.
5.25 to 5.5%, and to continue
They're
the
willing.
process
They
of
want to keep
significantly
winding down the
reducing
balance
our
sheet.
securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity.
There's the bullish factor.
As well as the balance of
They're going to have to, they're weighing out the risk.
Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account.
I feel like this is a, we gotta either hold this or the market's probably waiting to see the questions. Is why we're still back in this box.
Inflation,
see why I do this?
And economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reduce to set the stage for achieving maximum employment
and stable prices over the longer run.
Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal childcare funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided
balance
to
sheet
maintain the
again
target
brought
range
that
for
up.
the federal funds rate where it is at 5.25% to 5.5%.
They're winding down the balance sheet. He's making it a point to say that, guys.
Committed to achieving and
Letting you all know he's sucking
stance of
liquidity
monetary
out.
policy that's
So
sufficiently
other than
restrictive to bring down
interest
inflation
rates,
to
that's their other tool that they
2%.
have.
But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that
this was probably a bad idea, but I ended up grabbing puts, guys, for Friday.
That we will,
I'll stop out
that
if
will
we
be
get
appropriate
if we get
for
like
us
an
to raise
extension or
rates one
something,
more
which I
time
think we might get. Oh
in
no!
the two
Oh
remaining
no! It
meetings
just
this year.
wait. That might have been good.
Others believe that we
Shit.
have already reached that.
Hold
so
up.
it's something where we're not making a decision by deciding to about that question, by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
Bang! Let's get it.
We're not
Let's
saying-
go.
no, clearly, we're
Let's
just-
go.
what
That
we
was a
decided to do
nice
is maintain
one.
the policy
That's
rate
one
and
piece
await
off.
further data. We want to
Let's
see
go.
convincing
Let's
evidence
go.
that we have
Right?
reached the appropriate level, and
Let's
you know,
go.
we've seen progress, and we welcome that. But you know,
I
we
got
need to
those
see more progress
Fridays.
before we'd be
There were
willing to
45. I got filled at 44
reach
cents.
that conclusion.
And just on the
For the
2024
20
projections, what's
seconds.
behind that shallower path for interest rate cuts?
438s
The need for real
maybe?
rates to be 50 basis points higher.
Right. So I would say it this way. First of all,
I don't remember what they were.
Real interest rates are positive now. They're
They're
meaningfully
free now.
positive.
We
And that's a good
start
thing.
breaking
We
back
need
above
a
here at
policy to be
VWAP. We break
restrictive
VWAP, then I'm
so that
out
we
of
can get
these.
inflation down to target. Okay.
Nice trade
And
there.
we're going to
Needed
need that
that.
to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone
I'm
expected.
still waiting.
And so what you're
I
seeing
still
is
want
this
to
is
hold
what people
some, but I
believe
kind of
as of
sized
now
up there, which was
will
really
be
stupid.
Appropriate.
Right? Let's
to
go.
achieve what we're looking to achieve, which is
443 is broken. You're
progress
going to watch this
towards
443
our
level. See if we make
inflation
this
goal, as
resistance
you
and we
see in
start
the
going down.
Hi, Chair Powell. Rachel Siegel
There
from the Washington
is-
Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah,
I might
so
grab,
the proposal at the meeting was to maintain our current policy stance, and I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think, and you have some.
I'm
saw,
kind
I
of
think,
cautious
7 wrote
here.
down
Just
no hike.
I
at
may
this-
miss
at
it, but
this
that
meeting,
might
or
be it.
between now and the end of the year.
Higher
and
for
I think
longer.
12 wrote down another single hike in one of the next 2 meetings that we have between.
I want
so
to,
it wasn't like we were arguing over that.
I
People
want to
just
grab
stating
puts
their
right now,
positions.
but
And
I
really
got
what
some
what
profit.
people are
Like
saying
this
is,
a
let's
nice
see how the
profit
data
there.
come in.
I don't want to
You know,
get
we wanna
snaked out
see-
again.
You know what we want to see.
Might get
We
a
wanna
test
see
of
that-
VWAP.
That this these good inflation readings that we've been seeing for the last 3 months. We
Gotta
want to see
wait
that it's
for what
more
he
than just 3
says.
months, right? We want to see, you know, the labor market report. That
See
we
what I'm
received,
talking about?
the
See
last
what I'm
one
talking
received,
about?
Was
What'd
a
I
good
say?
example of what we do want to
I
see.
knew we would get
It was
a pop.
combination of
They're gonna mess
across
around
a
with you
broad
guys.
range of indicators, continuing rebalancing.
So let's
of the labor
let this
market.
play
So
out,
those are the
and
two
then
things. Those are our
let
two
the
mandate
market
variables,
digest
and
it.
that's the
Sorry, I know I'm
progress that we
talking
want to see.
over
But
a
I
lot
think
of stuff
people,
here. I
they
do
wanna be
apologize.
convinced, you know, they wanna
Let the
be
market
careful
digest
to
everything.
Not to
Be patient.
jump to a conclusion really
Pick
one
your
way
spots.
or the other, but just be convinced that the data, you know, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, what would, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you know, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. You know, we've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, you know, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been
guys. Just so you guys know, I do have the 437 puts for Friday. Okay, I had the 437 puts for Friday already up on my screen, so all I got to do is enter the trade. I'm watching these options compared to what he says, and here we go. I think that was the break and retest of 443. Let's see if that was it.
What
but
is
I don't,
it saying about
you know,
the committee's
just letting you guys
view
know
of
that's what options I'm looking
inflation
at.
dynamic in the economy, that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell you that? Does it tell us that the committee believes inflation to be more persistent, requires more medicine, effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you.
That should be a killer right there, but I think we'll get a slowdown.
Here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, you know, we know it by its works. We only
No.
Okay, I think that's why you're getting reaction right there. He doesn't answer neutral rate. He kind of said, he just said there's a possibility it's higher. He might backtrack now that the market went down.
well, that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that you know, that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard. Howard Schneider with Reuters. Thank you. So you've said several times that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment. And that's because we're seeing that rebalancing in other places, in, for example, job openings and in the jobs worker gap. You're also seeing supply side things. So that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase. And, but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path is narrowed and it's widened, apparently, ultimately.
Those puts are already almost 100%. I failed to grab them back at that retest at 443.
I do think it's possible, and
I will get them in a bounce.
This is why we're in a position to move carefully.
Notice
again,
what's going on.
That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that, and we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive.
Nice, bro. I'll see you there, Chris. I don't know what happened.
Again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates.
Great job today, Chris. So I'm gonna be looking at these when they come back down. They already went up 100%.
Pandemic-related demand.
Looking at the RSI MACD, you put in a new low with the higher RSI, higher
suppressing
MACD.
demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods.
But thanks for stopping by, Chris. I appreciate you, bro. I'll be talking with you.
Non-housing services as well. So we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think Confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can, for now, decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say if we get to that level. And then the question is, how long do you stay at that level? And that's a whole other set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet.
Inflation projection for this year, and even then it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last 2 meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Gina. Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year, as we see inflation, kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're, as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And there's so much uncertainty around that. When we, in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Neil.
Thanks so much, Chair Powell. Neil Irwin with Axios. I wonder, how do you think about the question of whether the strong GDP growth that we've been seeing is driven by excess demand versus supply-side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, I mean, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So
I think that was bullish what he just said, not just now, but the question before.
Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's the government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other, but we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation, but that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain, and we'll be learning, I think, over the course of the next intermeeting period. We don't comment on that. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time. A sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Greg Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime-age labor force participation moving up, where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming
they get
back,
these
and
idiots
the
on.
Fed
Some of
coming
these
in
guys
and
are
tightening
idiots,
again and
right?
again. So the best thing we can do for everyone,
2010,
we
you didn't
believe,
have
is to restore
rampant
price
inflation.
stability. I think now
Price stability
today,
is
we
more
actually,
important than maximum employment right now.
We have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result?
We got to go up. If we're going to go up, we're going to do it now.
Low-hanging fruit.
Let's go up, or we're going to go down further,
chain
guys.
snarls and other pandemic disruptions, or is it more a broad inflation, a disinflationary trend? that involves most goods and services across the economy. Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Michael McKee from Bloomberg Television and Radio. What would justify that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significant unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last three readings are very, very good readings. It's only three readings. We were well aware that we need to see more than three readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the three buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But these are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think?
Well, I think we have come very far, very fast in the.
And what could justify moving in the future if you think?
Well, I think we have come very far, very fast in the rate increases that we've made, and I think it was important at the beginning. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided, and the risk of over-tightening and the risk of under-tightening becomes more equal. And I think the natural common sense thing to do is, as you approach that, you move a little more slowly as you get closer to it, and that's what we're doing. So we're taking advantage of the fact our way to the right level of restriction that we need to get inflation back down to 2%.
Jennifer. Berger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge, and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was it? What factors?
The base factors.
Base factors. Okay. So On that, we're looking at just monthly, right, you can look at just monthly readings and see what the increase was from the prior month. So you're right, when you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible, if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
But would you feel more comfortable on the base effects that as those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation and things like that. That's just things we have to monitor. So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing record credit spending.
So he's bringing up the debt question.
Manage that debt at higher interest rates now, and are you concerned about a debt bubble related to that?
So, to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully, but at this point, these readings they're not at troublingly high levels.
The next question is about high yields, like 10s, 2s, 20s, and he's asking what's his opinion.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks? And how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things. Either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American banker. Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were.
I wonder how many sell side
So my
we
question
have here
is
once
how
we
much
crack
of the effort to
wow.
tame inflation, both as it's
Damn
measured
it.
and felt by the broader public, hinges on housing supply? And
Remember
then,
what I said
as
about
far
Tesla
as
the other day,
constrained
guys?
housing supply
Remember how I said
being sort of
Tesla's the
exacerbated
last
by
one to
this
go?
sort of lock-in
It's
effect
still
of mortgages
damn
being
near,
higher
well,
now
it
than
just
they
broke
were
the
at their recent
previous,
historic
you know,
lows.
initial morning high.
How is that going to impact
So,
future thinking about taking interest
if
rates
you want to
that
play
lower
the SPY,
bound?
you could always look at Tesla. And again,
So
on the
supply
daily, it's
point,
still oversold.
Of course, supply is
in
very
my
important over
opinion,
time
or it's
in,
overbought.
in setting house prices and for that matter rents. And so, supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level
we're still not past yesterday's low.
It won't be
I'm
that
not
much
worried
higher.
just yet.
A year ago, it would have been much higher than it was a year
actually, I
before.
might
Now
be.
it may be below
Look
or
at
the
this.
same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages and roll in our future decisions in a future loosening cycle about whether we would cut rates. No, I don't think it would. I mean, I don't think that's, I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis.
I was thinking if it was up there.
You have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road I wouldn't think so.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
Thing. Here's what you guys got to understand. I can't even be mad. I can't be mad, and I'm going to post this on the live.
It's a good thing that the
because we are at a completely new low, and these options are still lower than where they were.
The only concern, it just means this.
They just hit 100% again. Two different 100%.
That just means we'll have to.
I mean, these contracts were sitting here, and the premium the theta just got ate up.
Yeah, and I guess on the other hand,
this is why I say catch the momentum move.
Slowdown or even a recession.
I'm going to cover it on the live tonight.
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So. That said, of course,
God damn it.
We also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed-rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed-rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So why? I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household.
Yeah,
balance
I'm not
sheets
even mad. I can't
and
even
business
be
balance
mad.
sheets have been
Okay, they're
stronger
at like
than
you know
we
71
had
cents
understood.
now, but
And so that's spending is
Unbelievable.
held up and that kind of thing.
Unfucking
We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. That could be, it could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question, your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%, you're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are living on credit cards and borrowing are going to feel that more. They are, and of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-growth Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? And just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly we're suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy's terrible, but at the same time they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be, but I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
All right, we have Jeffrey Gunlock on CNBC right now. I got to turn him on. This is my guy from Double Line Capital. We got to listen to him. He's a very smart bond guy who I respect and always listen when he talks. Looking for a call. I'm looking for, not yet. Hold on. Let me get myself straight.
Many times. The Q&A. I think there was something in there for everybody. I think this is really one of the best
The rejection of that pennant
that we've had in a while.
See how it pinned right off of the 9 EMA and this pennant.
Is wrapped around the
that yellow line there.
That
Pay attention to it.
525 basis
Google
points.
got smashed, guys. Google probably made the biggest move,
with Stephanie
I
Link, I think
from when
prior
I
to
was
the
looking
Fed decision,
around.
I think correctly pointed out, doesn't get enough play that QT continues to happen. So, they did upgrade the forecasts for next year. Unemployment not as bad. Economy a little bit stronger. So I think he's right about all this. I think that it's the right thing to not raise rates. I think it's the right thing to wait. We have a lot of indicators that are looking at softness. A lot of people are making a big deal about
Google was beautiful.
The consumer resiliency. I think a lot of that's due to high prices. And you see that in credit card gains. There was a big drawdown a couple months ago, but it's back up. So we see a lot of debt in the economy.
We should get a bounce off this area, guys, because if you guys look at the
with
daily
economy
chart,
there's been
this
so
should be
much
an area of
increase
support.
in interest rates for
We should get an
the
area of
Federal
support.
Reserve
Let the
and
market
Treasury
digest it.
Department. In other words, the interest on the debt.
Maybe
is
we can
really
get a
going
gap
up
down
lot.
tomorrow, or
And
we
it's
get a
gonna go
bounce
up
back.
every month.
Because on the
If
daily,
rates
we're going to want to
stay
retest
at
this level,
5.25
possibly,
to 5.5
or this level
and
right
obviously
here.
go up faster
441.
if they do another hike or two,
441
which
for the.
they're certainly contemplating or have the door open
If you're
to.
thinking
We've
short,
already
that you
had
think we're going to
hundreds of
get back
billions of
down here
dollars
to
of
this
increased interest
437.
expense, and it's going to go up a lot more with these interest rate levels, and it's creating a lot of bond supply. And the bond supply has been one of the reasons interest rates have been going up, in addition with the quantitative tightening. The good news, I guess, on interest rates is at least taxes are going to get paid here in California in October
If you
15th.
look back-
One of the reasons the deficit is so big is there's been
I want to
deferral
listen to him.
of
I'm
tax
sorry.
payments. That's going to go away. In fact, it's going to get a lot worse because here in California, we're going to have to pay 2 years' worth of taxes unless they change the rules for the 2023 tax payment and push that forward from April 15th. we'll have October 15th, 2023, and April 15th of 2024. That's 2 years worth of taxes paid in 6 months. And I know that some people, you know, are prudent and plan for that. I know I have. But a lot of people, they adjust their lifestyles. And that has to do also with a headwind on the student loan payback. Because we know a lot of people, when they weren't paying their student loans, they spent the same amount of money, or they
We got to
borrowed money. They
retest
paid the amount-
441,
they paid the
guys.
same
That's what
amount
I'm
of
watching
interest
for.
by ramping up their credit cards.
441 on
and
the
that's certainly been the
S&Ps.
case. So we have a lot of cross currents right now in the economy. I kind of see it in a transition. And the data is extremely non-reliable right now because of all of these distortions from the government money and now the payback of, and now the drawdown in those excess savings, now the payback of loans. And now we have these strikes showing up. So we have cross currents.
This is going to be a mess
regarding
that they're
the
in,
inflation
guys.
situation that it makes it very prudent for the Fed to have a wait and see attitude. These
Gotta
strikes
have a
are
wait and
obviously
see.
inflationary. The oil price going up 30% since June is obviously inflationary, right? So all these things are happening. But at the same time, the shelter component of the CPI is definitely coming down. The owner's equivalent rent lags badly. If you look at the Zillow and apartment list rent roll indices, they lead the owner's equivalent rent or the shelter component by about a year, and they're basically flat year over year. So a lot of
Here we go.
cross-currents
Let's get a
and
nice
it's
bounce off of
absolutely
here.
appropriate to wait and see for
I
the
feel like
data.
this
So
is
they did the
a
right thing.
risk off.
You know, Chair Powell said based on the outlook
Event.
that it was, quote, more likely
really
than
do.
not, as I've already said, that they'll raise at one of the 2 remaining meetings. You made the case repeatedly recently, including just last week, a few hundred miles down the
If we
coast.
bounce here, all it's trying to
from
do
here
is
with
kill
me, that You
premium.
thought the Fed's done. Do you still maintain that view that they are finished raising interest rates?
Watch Tesla.
I think the probability of rate hikes is higher than what I thought before this oil spike happened.
Absolutely.
The oil spike is really going to be problematic.
Absolutely.
We already know that the base effects, the roll-off of the CPI, is going to lead to very likely inflation going back up, kind of staying where it is now in a sticky way, maybe even going to a 4 handle on the headline CPI before it comes down with that shelter component effect. And so I think the chance of a rate hike is higher because these oil prices are going to be a real problem. My gasoline station, over the past few months, the price has gone. I get Supreme gas, 91 octane. It's gone from $5.50 to $7 a gallon already in just the past few weeks, and that's not going to go down with West Texas Intermediate above 90. So those things lead to a little bit of a headwind against the idea that the Fed can cut rates or stay on hold. And I think that it's appropriate that the Fed sort of downgraded the so-called rate cuts because of this these cross currents of inflation. So I do think there's a better probability that we'll get a rate hike than I thought, say, 2 months ago.
Steve Leisman, of course, was in the room, asked a question to the chair, as he always does. He's stepped out now and is going to join our conversation. You know, Steve, I want to hone in on an issue that you raised earlier and a point that you underscored in your question with the chair, as asking why a more restrictive real rate next year than this, to which he was explicit, where he said, because of the stronger economy. And I just want your perspective, because what I feel is now interesting to talk about is it seems to me that the chair's biggest problem now is not where inflation is, it's where the economy is. And he is afraid that because the economy is, as he said, much stronger than they thought it would be, that inflation is going to come back. He doesn't trust necessarily that it's going to remain on the trajectory that it's been.
Yeah, I mean, Scott, let me just point out from the Vulcan mind melding department that is the exact quote that I brought to you here, was his answer to that question. So I'm going to let Chair Powell say what he said and answer the question. And if you don't mind, I'll comment on the back end of that.
Rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity.
We just,
now, just
you know,
to understand
we broke
what he was
yesterday's
answering,
lows.
the question is, he even surprised me. I was on Scott's show earlier today saying, I think higher for longer is going to be what we're going to hear today. But it surprised me
Just
that from
grabbed.
a real rate perspective, take
was
the
just
Fed's
grabbing
inflation forecast,
435s.
take their funds rate forecast for next year,
Fuck.
the Fed becomes relatively
Now it's just
more
gonna melt
restrictive
down,
next year. I
guys.
thought maybe it would pivot
Damn
a
it,
little
those
bit
430
higher, but
they
in
went
fact,
from-
what happened is they kept the inflation rate the same, but they added a half a point or took away a half a point of rate cuts that they had previously penciled in. And Scott is right. I think the stronger economic growth is part of it. I think there's also a persistence to the service side of inflation that may be a part of it. But look, here's the thing. Even though the forecast, Scott, is one that is relatively more hawkish, the overall forecast is more bullish when it comes to GDP, when it comes to unemployment. And I think I take Powell at his word today. He's going to be careful in getting there. Just because you have a plan, even sometimes, Scott, if that plan is a little reckless, doesn't mean they're going to execute it. So the idea that they're going more slowly should give you a little comfort, even if the direction of travel is one that is ultimately more hawkish.
I was going to ask you that, too. The idea of those words, proceed carefully. As I noted at the outset, I counted at least 5. It's probably a couple more. Jeffrey himself raised it very much at the top. Do you want to just opine on that, why he felt it so necessary to underscore those words?
Well, I think the reason is because, look, he did an awful lot of work. 500 basis points is a very historically aggressive rate hike cycle.
I don't know if I should attack
to a point
Tesla.
where there's not obviously going to be a recession at this point. He has a chance to stick a soft landing, and he now has the luxury to take a little bit more time. I think the idea of a pause this month made a lot of sense. It may be they pause again. In fact, Scott, if you look at the probabilities, I'm sorry, I haven't looked at it since I came out of, since the 2 o'clock announcement, but it was higher for December. So they pushed it ahead. They said, you know what? I think November is likely to be a pause. And it's not even at the 50%. So Jeff could be exactly right. They are done with somewhat higher probabilities that they're not. But the odds-on call right now is that they are done. And the focus now is this: how high for how long? Today we learned longer. But I think Powell's also saying, you know what? If I don't have to be, maybe I will take some back.
Yeah, good stuff. Steve, I appreciate it very much. That's Steve Leisman, our senior economics reporter down in Washington on the backside of the Fed Chair's news conference. Back to Jeffrey Gundlach, who's clearly still with us, too. Jeffrey, your reaction to that, what Steve Leisman had to say about, the economy being sort of, this
tonight,
too
guys.
strong economy in some respects, being an issue for the Fed Chair?
He really bought himself some time in a very clever way, Jay Powell did, I think. He basically said we're mindful of economic strength that, like GDP now it's pretty high at the Atlanta Fed. It's got downgraded recently, but it's still, I think, in the 4s, maybe the high 4s. So it's a hat tip to that. They do the clever thing of buying themselves time. They make a forecast for, the future, 6 months from now, 18 months from now, and they leave rates unchanged because they're cognizant, rightly so, of the potential for all of the accumulation of this tightening. Between the 525 on the Fed funds rate and the quantitative tightening to date, I'm going to go back to the old shadow Fed statistics, where there was a study done where they said if we didn't do this quantitative easing, quantitative tightening, if all we did to manipulate monetary conditions and looseness and tightening was the Fed funds rate, where would the Fed funds rate have to be to equate to the Fed funds rate tightening of 525 plus the QT? So if we didn't do the QT, this study shows that they've raised rates, they would have had to raise the Fed funds rate by 730 basis points, is what they've effectively raised the Fed funds rate. That's a lot of tightening. And the Fed needs to realize, and of course Jay Powell said so explicitly, that the QT is continuing. So those rate hikes really are not rate hikes, but it's tightening of monetary conditions. That's going to go up to 800 basis points. So it's very clever to say we're respecting the potential for less of an increase in the unemployment rate, but at the same time we are going to buy ourselves time. Really good stuff. I think it was an excellent way to handle this meeting. I agree with Steve completely that I think the narrative is going to develop that there's going to be no rate hike in November because they need more data. They need more data, maybe December. But the other thing I want to tell the listeners about, this is really an interesting thing. I always talk about the yield curve being inverted as a warning signal, if you will, puts you on watch. that a recession might be coming, but it doesn't happen imminently. It takes time. And so it's usually about 14 months to maybe 18 months after the twos, tens inverts that you start getting a recession. Well, that was last October, so we're coming on a year on that one. And one way to track this, the best way, one of my investors sent me a note the other day that I found very interesting. Just look at the 30-week moving average of the twos, tens spread. When the yield curve de-inverts by crossing back above its 30-week moving average, that's a really strong signal of a recession. And that's very close to happening. Also, the unemployment rate is now up by 40 basis points off of its low. It's probably going to go higher, in my opinion. And so with that, you're going to get a crossover on the unemployment rate. And also, the unemployment rate is going to cross over its 3-year moving average in the first quarter of next year by our assessment. These are really strong recessionary indicators. So it's starting to pile up. I think that the problem that we have, government shutdown looming, student loans being paid back, taxes being paid, I think the economy could slow down fairly quickly once we get in the next, say, 4 to 6 months.
But all that said, did bonds just become more attractive today? Because we think that, especially on the short end, you see that the 2-year is obviously up. Stocks, by the way, are at the lows of the session at this very moment. But if we think that, rates on the short end are going to continue to rise for a bit before perhaps, if your projection comes true and the economy weakens and then theoretically rates would go down, did bonds just get more attractive to you?
I think Treasury bonds are attractive. I find them quite attractive at this moment. Not for the long term, though, Judge. It's really for the short term on economic gyrations, which I think are going to be weaker economy and probably weaker inflation than people are forecasting. But the problem is the long term for interest rates is getting increasingly unattractive because we have all of this interest expense that's piling up. And the deficit's already at 8% of GDP. And under a certain scenario that's not a very pretty one, you could go to 12% of GDP on the deficit. That's a ton of bonds. And so we have two really long-term secular indicators that turned twice in my career. The first time they turned was in the early 80s. And that's nominal GDP, a 7-year moving average of nominal GDP, peaked in the early 80s and fell for 40 years. So that has turned up, it formed a bottom between 2016 and 2020. And that's a interesting indicator. Also, the core PCE 7-year moving average has exactly the same look. Peaked in 1980, bottomed around 2020. That's also going up. And so that suggests to me that the next bond rally, which will come in a Pavlovian response to recessionary conditions, will not last. I think that the response to the next recession will be the same response that we've had in the last 20 years, and that's slashing interest rates and then probably quantitative easing. And this will be an inflationary policy. The deficit is going to get so bad in the next recession that we're going to have radical policy changes. Just like the elections of the presidency keep getting wackier every 4 years, the responses by the Treasury Department and the Federal Reserve need to be more extreme all the time because the debt acts as a tractor pull. And I'm afraid that in the next recession we'll get a bond rally that doesn't stick because the response is going to have to be inflationary. So we're in sort of the eye of the hurricane situation relative to the general trend, I think, in bond yields. For the time being, though, when you have to think about managing money actively, which of course we do every day, we have to respect the fact that we think we're looking at a bond rally. Even the 10-year Treasury yield is basically double topped from where it was a year ago. It's made us a minor new high, but I think we're getting near the end of this rate rise on the 10-year.
Well, speaking of slashing rates, we learned from the outlook that we're, going to get 2 fewer cuts coming next year, at least based on the outlook, which, isn't worth much more than the piece of paper because it's not a prediction. It's just that obviously an outlook. But you've been looking for cuts. Yeah, you've been looking for cuts next year. I mean, are you rethinking your outlook for rate cuts based on what the outlook today said?
Not at all. I think it's quite likely there's going to be rate cuts in the first half of next year, and I think they're going to be bigger than the Fed thinks as their base case. So I think we have real rally potential in the long in the bond market. So the way you positioned, Judge, is really pretty simple. It's the same that I've been advocating now for a while. You want that profit potential at the long end of the Treasury market to help hedge your risk positions. But where you really want to be in bonds is not T-bill and chill, which is the new rhyming phrase that people use about investment strategy, because you can buy the 6-month bill at 550. But I wouldn't do that. I would go more into a 2 to 3 year type of portfolio in credit, where you can get 7.5%, 8.5%, 9% yields. I mean, bank loans in the double B sector, they have yields that are up in the high single digits. And the Fed not cutting anytime soon means you're going to earn that yield for a while. So this is a market where you want a long-term position, kind of a core position in treasuries for a fixed income portfolio. And then you want 2 and 3 year, because that's the peak of the curve, the 2 and 3 year in the securitized credit markets, where you get these big yields. And so you can end up with a pretty sleep at night type of portfolio that throws off income that's probably triple, if not 3.5 times that of the equity market. The equity market is really overvalued versus the bond market based upon risk premiums and stuff like that. Back a year and 3 quarters ago, bonds were stupidly overvalued, and as rich as stocks were when they began that bear market, they were cheap to bonds. That's changed by a factor of 4. So you've gone from bonds were doubly rich to stocks, now bonds are doubly cheap to stocks, so it's been a 4x shift. And I think that that should be respected in portfolios. So I think 25% long-term treasuries, 25% not in cash, but in this short-term, not terribly low in credit, but not pristine credit stuff. And then you want 25% in stocks. And at this point, I think there might be a case for building a position in commodities, which have moved above their 200-day moving average in a way that's becoming quite convincing. It's mostly energy. But it seems to me that there's momentum behind this move in the commodity sector.
So it's you read my mind. I was going to ask you how you would break up 100% into which holdings to have. But let me end then. If you think that it's worthy of having a 25%, let's just say, in commodities, you assume you must then that what has been dollar strength is going to turn into dollar weakness as the economy itself weakens?
Yes, I think that for sure the dollar is going to weaken in the next rollover of the economy. It's going to weaken pretty mightily, I think. And that's one of the problems that the bond market's going to have, too. So I think that's going to happen. What's happened recently is we've had dollar strength recently, and that's been a little bit at odds with real interest rates, frankly. Well, not with real interest rates, but at odds with sort of financial conditions broadly, I think, with the deficit. But that's going to change.
Jeffrey, I appreciate it, as always. It's good Fed day when we have you on the backside of Powell. I appreciate it so much. We will see you after the next meeting, I'm sure of that.
Okay, sounds good, Judge. Good luck, everybody.
Right. Yep, you be well. That's Jeffrey Gundlach, of course, with DoubleLine, who joins us every Fed day right when the Fed chair is done with his news conference, and you'll hear that again after the next meeting. Let's get to our results of our question of the day. We asked how many times will the Fed cut rates next year? The majority of you said less than 2. Maybe that changed a bit. Maybe you had to rethink that after the outlook today from the Fed. Coming up next, SoFi's Liz Young. She joins me here on set at One Market. We'll get her first reaction to the decision. Plus, we are getting you set up for earnings in overtime, a rundown of what to watch when FedEx's numbers, they'll hit the tape in just a few moments from now. We're about 14 or so minutes away from overtime. All that and much more. We're going to take you inside the market zone next. Here now in the Closing Bell Market Zone, CNBC senior markets commentator Mike Santoli and SoFi's Liz Young here to break down these crucial moments of the trading day. Plus Frank Holland. He shares what to expect from FedEx, those earnings out in just a few moments in overtime. Liz, I turn to you first. Was this what you expected from Powell?
I mean, I didn't expect them to raise rates. So, yes, I think a lot of these messages end up being very anticlimactic by the time we get to the actual meeting. The carrot got further away, right? But it's still a carrot, in my view. And you're looking at the expectations and their summary of projections that say, okay, inflation maybe a little bit cooler this year, growth a little bit stronger, unemployment a little bit lower. After I really try to play that out, it doesn't track entirely, right? So we've got a Fed funds rate that we're expecting to be 5.6% by the end of the year, stay above 5% for all of 2024 without hurting the labor market, without hurting growth, even after Chair Powell has said over and over again, we will need to see a period of below trend growth in order to fix this problem. If we have a period of below trend growth, we're probably going to have a rise in unemployment. We're probably going to have some weakening in demand and further weakening in margins, in company margins. So some of this just isn't entirely tracking. I think part of it is that they can't forecast that there's going to be a contraction. They can't forecast that there's going to be a recession.
So Gundlach would say, who we just obviously talked to, Jeffrey Gundlach would say that's exactly why he thinks that stocks are, in his words, wildly overvalued relative to bonds, for the very scenario in which you say elevated rates and economy that's going to come in as a result.
Right. So I think the soft landing expectation is taking what's going on today and extrapolating it out into the future and acting as if nothing's going to change. We're just going to stay on this trajectory. As we know, and as Jeffrey rightfully pointed out, the lags and even yield curve inversions, or what you point to whatever indicator you want, this is the period where it usually starts to be a problem. So declaring victory and saying a soft landing is just going to create a scenario where this all continues, I don't think is likely. It's going to have to inflict pain, and that has been reiterated by the Fed. It's going to have to inflict pain. We've seen a little bit of pain, but not quite enough yet to take care of the inflation problem. I am absolutely with Jeffrey on the idea that I think we'll see cuts before the market thinks we'll see cuts. And I think we're going to see more cuts before then, because I don't think that it's sustainable to expect rates to stay at this level, expect the yield curve to stay this inverted, and that everything else just sort of carries on its merry way.
Well, I mean, Mike Santoli, even the Fed chair himself wasn't willing to call a soft landing his baseline scenario. He knows the lag effects that are still to come. He knows that by keeping real rates higher into next year, that the economy is going to slow and the labor market is going to come even more, in his words, into greater balance. The question is, what are investors to do with all of that?
Well, their forecasting ability, as he conceded, is really no better than the market's collective ability to see ahead. I think what he did say is he's willing to allow himself and the Fed to get lucky if that's the way it goes, and not necessarily try actively to short circuit the economy from here. He was very diffident about the potential for another hike this year. Yes, that's what the committee projects. We leave it open because we're so close to the end of the year. That means one meeting out of two, we make it a hike. But beyond that, I think it's much more about he's going to make use of all the latitude afforded to him by the fact that the rates are up around where they need to be. The economy still continues to be somewhat stronger than they anticipated. And the long end of the Treasury curve and perhaps energy prices are doing some of the job they otherwise might seem to do. So, yep, stocks have a little bit of a colicky response as the two-year note yield does go higher, which is we have the higher for longer medicine being applied. But I don't think this was a game changer today, and I don't think he wanted it to be a game changer. Look, the collective projection is for unemployment to go above 4% next year. They're not saying it's going to stay perfect. It is for a step down in GDP growth. But I think also the fact that they don't have inflation going to their target until 2+ years from now gives them the ability to stay patient. So the market is perhaps you have to see what happens at the close and tomorrow for the real response.
The great, question, Mike, remains valuations. You heard, Gundlach suggest in his words, stocks wildly overvalued relative to bonds. The debate has been relative to where rates are, where the economy seems to be heading, where earnings, may in fact come in relative to expectations, whether stocks even, right now are just overvalued.
It's a much longer conversation to decide how much the level of Treasury yields matters for equity valuations or not. It's obviously something that's in everybody's mind that it is a little bit, too tight right now. But I don't think that that's necessarily a clinching argument, especially outside the top 7 stocks.
Yeah, Liz, real quick to you. Dollar going to weaken, take a position in commodities, maybe 25% of your portfolio, as he sort of, broke it down, 25, 25, 25. Bond stocks, cash and commodities.
I think in the near term, we're going to see dollar strength as rates continue to rise. And I think that inflation, given where oil prices are and just given where expectations are, that inflation probably comes in either at or slightly above expectations again, either next month, the following month, or at least for a while here. So I think the dollar strengthens before it weakens. But if I play my own scenario out, the dollar does weaken as the economy starts to show signs of stress. And that's when you don't want to be overly exposed.
Yeah, sounds like that's exactly what Jeffrey expected to happen, too. FedEx shares, we talked about them. Earnings are coming in overtime. Shares are far outperforming rival UPS and the market year to date. There's Frank Holland with more on that for us. Frank, what are we expecting?
Well, Scott, I think you're really hitting on one of the important things. FedEx is really outperforming rival UPS in the market. As investors, they are clearly supporting its broad cost-cutting and transformation plan that began just about a year ago. So the key thing to watch on this will be the call and any commentary on new business and also any possible updates to guidance. So FedEx recently announced a general rate increase starting next year and surcharges for this holiday season. A lot of analysts are watching for any comments about winning business from UPS during the Teamster negotiations. UPS itself estimates it lost more than 1 million packages per day in volume during those negotiations. Also, any gains in freight volume from the bankruptcy of Yellow. FedEx Freight is the largest LTL carrier in the nation. Yellow was in that same space. The influx of volume in both areas at higher prices is expected to give margins a boost. Evercore recently raised its EPS estimates for FedEx. There's a lot of speculation the company could also raise its EPS guidance. Back over to you.
Thank you very much for that, Frank Holland. Mike Santoli, what are your expectations here?
Yeah, I mean, this is a management that's not been shy about calling out macro challenges when they see them. You could say that they're kind of blaming global conditions sometimes in past quarters. So I would be interested to hear their characterization of the macro, of pressures like, I know they pass along fuel costs, but what that's doing to demand. Now, earnings expectations for the current quarter have come down pretty significantly in the last several months. So in theory, I think the market kind of expects them to hurdle the latest print. But, it is a much more in favor stock than it has been, I would say, in a couple of years.
Yeah. So let's turn back to the markets, where I mentioned before we were at session lows, and that's where we are now. But Liz Young, let's focus on those two words that took prominence today. Proceed carefully. And, investors are going to have to make up their minds in the days ahead, how they view where the Fed's going to take rates and what their policy is going to go, how many hikes there are going to be, if any, when the cuts come, et cetera. But proceed carefully. Something to hang on there if you want to see things more positively?
Sure. I mean, this was one of those meetings where we get the dot plot, right? I think if you look over time at what the dot plot suggests, you find out that the dot plot is not good at predicting what they're going to do because it just has risen over time. And if we hung our hat on that earlier this year, we would have wildly undershot where rates ended up. Carefully, I think, is the right word to use. And all it does, though, is make us just as data dependent as them. And we're watching the same data come in. They're watching the same data come in. As we move through fall, I do think another hike is more possible now because of what consumers are dealing with and because of the persistence of inflation. But again, I don't think that another 25 basis points really changes much. It just sends the message that they haven't given up the fight, and that's the important message.
I mean, the question, Mike, is whether it changes, the appetite, if you will, for growth stocks. I know it's not the number one factor, but it's an important one, and the Nasdaq's down 200 points. It's down 1.5%. At the short end of the curve, the rates are up. It's a factor, and it's an important one.
All right, guys, I'll see you all on the watch list.